thinking of.
All right, welcome back to Worldwide Exchange. Market flash for you. We're watching shares of Boeing and another potential hurdle in getting past its current crisis. The Wall Street Journal is reporting 737 MAX customer China Southern Airlines is planning to conduct new safety inspections of its current Boeing fleet. Those checks come as China Southern awaits new jet deliveries from Boeing. At the same time, China's aviation regulator is reportedly urging other airlines to inspect their fleets of 737 MAX jets. Currently, no Chinese airlines that fly the MAX 9 variant, which is flies the MAX 9 variant, which was involved in that Alaska air blowout. The Journal also reporting a Boeing memo on Monday saying the company plans to conduct additional inspections of its 737 production line that will include work done at its contractor, Spirit AeroSystems. All right, 2024, it may be the year of elections, with roughly half the world's population heading to the polls. First up, Taiwan, which elected Lai Ching-te this weekend as its new president. Lai is currently the vice president of the ruling Democratic Progressive Party and is not viewed favorably by China for past comments about Taiwan independence. Eunice Yoon joins us now from Beijing. Eunice, good morning. So far, it's been a relatively muted response from China.
Yeah, that's right, Frank. Lai won, but it wasn't a crushing landslide. It was a three-way race. He got most of the votes, but not a majority. And his party, the DPP, actually lost ground in the legislature. Beijing, though, is still very much fixated on the fact that Lai did win, as well as the DPP. Beijing believes that both of them at some point want to declare independence for Taiwan. Lai has not said that he has no plans to do this. Even so, the response from here has been the Chinese government saying that the DPP doesn't represent mainstream public opinion in Taiwan, that the DPP win doesn't change the trend, they say, of the motherland eventually being unified. State media has gone a little bit further, saying that the DPP must accept the inevitable trend of what they describe as reunification with China, because the Communist Party argues that Taiwan is part of China. Now, for investors, most people here expect that we're going to see more of the same and a continuation of China's policy towards Taiwan under the DPP. So for the next several months, especially until the inauguration in May, expect to see more military intimidation, hostile rhetoric, likely not a whole lot of dialogue, if any at all, with the DPP, and then potentially some economic steps as retribution for the election results, Frank. So all of that leading to potentially more conflict if you're in the government or in business.
So you mentioned there's potential for more conflict, but I want to ask you, the ruling party, DDP, it lost some ground in these elections. What does that mean for the relations with China?
You know, it's really interesting because it does say that the DPP hasn't been as interesting for the population. At the same time, we still don't really know what this means for Beijing. Probably not a whole lot, since Beijing is still very much fixated on how much they loathe the DPP, Lai, as well as the current president, Tsai Ing-wen. So likely they're not going to really change, but at the same time, it's unclear how the DPP would govern, because the third party has gained some ground, so we could potentially see the DPP working with the third party as a coalition partner, so they could still govern the island the way the DPP wants.
All right, Eunice Yoon live in Beijing. Eunice, thank you very much. Let's talk more about the potential impact of the election on the relationship between China and Taiwan leading up to the new president's inauguration in May. Also, how this election could have an impact on relations between Beijing and Washington. Dewardrick McNeil is managing director and senior policy analyst at Longview Global. He is also a CNBC contributor, friend of the show. Dewardrick, great to see you. Happy New Year.
Good morning to you, Frank. Happy New Year.
All right, so let's just really touch on this. Again, the new president won't be inaugurated until May, so there's some time before that happens. How do you see this impacting not only Chinese-Taiwan relations, but also longer-term U.S.-China relations?
That's a good question, Frank. I think in the short term, as Eunice suggested, we're seeing moderate responses from China. I think that we're in what I call a wait, watch, and warn period, Frank, leading up to the May inauguration for sure. And there's plenty of time for things to go off the rails, but I think we will see China really moderate its response in the near term. And a lot of that, Frank, is because they don't want to destroy the spirit of San Francisco, as I call it, which is the agreement between Biden and Xi made in San Francisco to maintain open communication, to maintain high-level dialogues between the U.S. and China. So I think we have some conditions in place for a muted reaction response over the short term. But for businesses, Frank, to Eunice's point, over the long term, this does nothing to change the uncertainties around the Taiwan scenario. So businesses should...
Following that spirit of San Francisco, sorry to cut you off, Wardjim, we saw again, as you mentioned, a muted response from China in response to these elections. The U.S. Being very vocal about its support for the elections there. At the same time, we saw kind of the Taiwan weighted index close higher. Today, it's lower. Give us a sense for investors. Where does the risk come in as this whole situation sorts itself out?
Well, I think over the long term, Frank, if you're dependent on the Chinese economy for any of your production, manufacturing, there are various Taiwan scenarios that can still disrupt what we see in terms of global supply chains, chips being key among them. We could see China respond in many ways to Taiwanese companies in China. Foxconn, for example, we've seen all sorts of issues with respect to China looking for reasons to punish Foxconn for taxes. So I think there are a lot of different scenarios that still at play here. China holds a lot of cards. I think investors should be aware of the possibility for China to strike back.
According to your data, 40 national elections this year, they represent about 41% of the population, 42% of global GDP. The U.S. election here in November included in that total. How should investors just view this election outlook throughout 2024?
Well, look, this is a time where geopolitics remains key for investors to focus on. To your point, there are a lot of elections. A lot of these elections, I think, could, in some ways, cause some stability issues when you look at least the U.S. election in November to the global economy. So I think investors have to keep this in mind as we move throughout 2024.
All right, Eduardo Neal, great to see you as always. Thanks for your time and for your insight. All right, coming up here on Worldwide Exchange, with rates pulling off recent highs, a housing check is on what's now the country's fastest growing market in terms of home prices. A check on the real world economy with our Diana Olick. That's coming up next.
happening.
All right, welcome back to Worldwide Exchange. Taking a look at the current mortgage rates right now. We're seeing the 30-year fixed mortgage right now is 6.69. The 30-year fixed jumbo is 6.98. The 15-year all the way down to 5.95, under 6%. All right, the calendar may say January, but the housing market, it appears to be heating up. We're seeing signs that the usually busy and very critical spring season may be starting just a bit earlier this year. Our Diana Olick joins us now with the very latest. Diana, good morning.
Good morning, Frank. Yeah, we started hearing from agents a little over a week ago that there was a surge in interest from both home buyers and home sellers, likely because of that recent drop in mortgage rates. The 30-year fixed hit a recent high around 8% in October, then began coming down slowly in November and more sharply in December. It's now sitting around 6.69%. So despite 4 inches of fresh snow and freezing temperatures over the weekend, buyers showed up to this open house in Detroit on Saturday. The renovated 4-bedroom, 3-bath home is listed at $254,000, well below the national median price, but well more than twice the Detroit median. Nikita Bell, who's currently renting, said the drop in rates got her out looking.
I have a home in Georgia. That finance rate I got way back when the market crashed, and it's at 4%. So I know I'm never going to get 4%. But what I don't want is 9, 10, 11, and 12. It is not a credit card. It's a house.
Now, a recent Fannie Mae survey found a record share of consumers think mortgage rates will drop even more this year. That may be why they're out looking now, trying to get a jump on the competition. There's still not a lot for sale, but agents say they are expecting to see sellers get in the game, also because of lower rates.
Because rates have changed somewhat, so sellers are feeling more comfortable now with putting more homes on the market. It's not going to be as reflective right this moment, but as we inch and get closer to the spring, you'll definitely see more homes coming on the market, as we've already seen over the last few weeks here, especially in the beginning of the year.
Now, the wild card is prices. They're still rising and the gains are accelerating. Detroit is now seeing the fastest price appreciation of any major city in the country. It beat out Miami for the first time, Frank.
You know, that might be surprising to a lot of people. I know Detroit very well. The whole city having a huge renaissance there. Diana, I do want to ask you, rates are coming down, but so are rents at the same time. How does that impact demand for new home sales?
Well, it gets more competition out into the market, of course, because people are able to save a little bit. But it also says to people, well, if I don't have to pay the higher rents, maybe I don't need to get into a home right now because, again, home prices are still high. So it's kind of on both sides. It depends on the market. In markets where rents are still quite high, people might want to try to get into a home. But if rents keep coming down, it says, maybe I don't jump in right now.
All right, Diana Olick. Diana, thank you very much. All right, let's get a check on more of this morning's headlines with NBC's Frances Rivera. She's in New York with the very latest. Frances, good morning.
Frank, good morning to you. Let's begin in Iowa with the first results of this 2024 election cycle. NBC News projects that Donald Trump has easily won the Iowa caucuses, completing the first step toward putting him on a path to a rematch with President Joe Biden. NBC News also projects that Ron DeSantis has won the closely watched race for second place, narrowly defeating Nikki Haley. Meanwhile, the fourth-place finisher, Vivek Ramaswamy, has announced the end of his campaign. Ramaswamy used his speech overnight to endorse Donald Trump. A deadly deep freeze continues to plague much of the country. Winter storms have been linked to at least 10 deaths. Today, there are already more than 1,000 flights grounded after over 3,000 were canceled yesterday. And the Eagles will not be making a return trip to the big game this year in the final matchup of the wild card weekend. The defending NFC champs had their wings clipped in Tampa by the Buccaneers. Philly found the end zone just once, while Baker Mayfield threw for over 330 yards and 3 touchdowns in the dominant playoff performance. You're up to date for a Tuesday morning. Frank, we send it back to you.
All right, Frances, thank you very much. All right, as we had to break, taking a look at FedEx, the company announcing its new FDX platform at the NRF conference over the weekend. FedEx is calling this a first-of-its-kind data-driven commerce platform that will give sellers increased visibility into the package while in transit and also streamline returns. However, the company says it is not a marketplace like the services that Amazon and Walmart provide, but still, FedEx has not provided more details on exactly how FDX will work when it officially launches this fall. FedEx is currently under a corporate transformation to turn the logistics giant into one single operating company. The first phase is expected to be completed by June 1st. Much more Worldwide Exchange coming up in just a moment. It is just before 5:30 a.m. in the New York City area, and there's a lot more ahead here on Worldwide Exchange. Here is what's still on deck. Economic data and Fed speak. Wall Street will spend this week digesting that three-course meal. Markets coming off a winning week. However, futures right now, they're in the red. Also, sounding alarm on the global economy. Economists at the World Economic Forum, they're highlighting rising risk and geopolitical tensions that could take a real bite out of growth. And in Washington, the race is on to get a stopgap funding deal just over the finish line with just days to avoid a potential government shutdown. It's Tuesday, January 16th, 2024. You are watching Worldwide Exchange right here on CNBC. All right, welcome back to Worldwide Exchange. I'm Frank Holland. Let's get you ready to start your day. As always, we pick up the half an hour with a check on U.S. stock futures, with the NASDAQ riding a 6-session win streak and the S&P trading at its highest level since January of 2022. However, you can see right here in the red across the board, the Dow hitting its lows of the morning, looking like it would open 200 points lower. The NASDAQ, the hardest hit percentage-wise, down about 0.75%. We're also checking the bond market this morning. The 10-year yield just back above 4%. Ahead of a busy week of Fed speak and key economic data. You see the benchmark at basically 0.01% right now. We'll have much more on that in just a moment. We're also looking at the oil market. We continue to watch the latest developments related to Houthi rebels in the Red Sea, causing a rise in oil prices. WTI, the U.S. benchmark, up almost 1%. Brent crude, the international benchmark, up 1.25%. It is early. We'll continue to watch this action. Okay. That's your morning setup. We're now turning to Washington, D.C. Lawmakers are racing to get a stopgap spending deal to keep the federal government funded and to get that deal finalized ahead of this weekend's deadline to avoid a potential shutdown. Our Emily Wilkins joins us now with the latest on where congressional leaders stand. Emily, good morning.
Good morning, Frank. Well, Speaker Mike Johnson, he said he did not want another short-term spending bill to keep the government funded, but turns out he wants to shut down even less. And with 4 days left to go before part of the current funding lapses for the government, Johnson announced over the weekend an agreement to kick the can further down the road, buying Congress more time. It would fund part of the government until March 1st and the other part until March 8th. And that's going to allow lawmakers to decide exactly how to spend $1.6 trillion in funding, how to divide that up between thousands of government programs and agencies. Now, Johnson told House Republicans that the delay is, quote, required to complete what House Republicans are working hard to achieve: an end to governance by omnibus, meaningful policy wins, and better stewardship of American tax dollars. Now, it's not clear yet exactly which policy wins Johnson will be pushing for in an overall spending bill, but anything that can't get the support of at least some Democrats has no chance of getting to President Biden's desk. Still, Johnson's really under pressure right now from the hardline members of his conference to secure a win for Republicans. The House Freedom Caucus tweeted over the weekend that the plan to pass yet another stopgap is, quote, what surrender looks like. Senate Majority Leader Chuck Schumer is also supporting the delay to early March and is planning to begin the process to pass the stopgap measure today, so long as the weather in D.C. cooperates. Now, of course, this agreement doesn't mean that a shutdown has been averted. Both the House and the Senate are going to need to move quickly to beat a Friday night deadline. Otherwise, Frank, we could potentially see a short shutdown that goes at least into the weekend.
All right, so a lot of questions, including these, Emily. Where does it leave us when it comes to funding for Ukraine, Israel, or even our southern border?
That's a really great question, Frank. We still have a group of senators that's been working away trying to find that bipartisan solution on immigration, on border security that will unlock the votes they need to move Ukraine funding. But honestly, at this point, that's kind of not where the spotlight is. There's this urgency to keeping the government open, and the fact of the matter is that if no additional funding passes for Ukraine or Israel, that's not the primary concern right now. It's certainly something that's being worked on. It's something lawmakers still want to see. It's just a matter of priorities and time, and I think it's still a huge question mark whether or not we do see an emerging agreement there.
All right, Emily Wilkins in D.C. Emily, thank you very much. All right, turn our attention to the Middle East and another developing story. Houthi rebels are continuing their attacks in the Red Sea, despite airstrikes last week by the U.S. and its allies meant to stop the aggression in the region. The latest target, a missile strike on a U.S.-owned ship just off the coast of Yemen in the Gulf of Aden. This marks the 29th attack by Houthi rebels since the Israel-Hamas war began. This as Iran's Revolutionary Guard also steps up its influence in the region, attacking several targets across Iraq and Syria. Iran is claiming it destroyed Israel's spy headquarters in the Kurdistan region of Iraq. The latest tension escalation in the region only adding to an uncertain global economic outlook for 2024. That's according to a new World Economic Forum survey showing 56% of economists expect the global economy to weaken this year. 87% of respondents expecting geopolitical developments to increase global economic volatility over the next 3 years. Join me now with much more is William Lee, Chief Economist and Executive Director at the Milken Institute. Bill, good morning. It's great to have you here.
Thanks for having me, Frank.
Bill, if you don't mind, a lot of global stuff going on. I want to start with the U.S. So according to your most recent research, the idea of 150 basis points in cuts by the Fed this year, it's realistic. The only question is it good cuts or bad cuts? Please explain.
Absolutely. In fact, the markets have pretty aggressively priced in a lot of rate cuts, more than 150 points, but they haven't really priced in the distinction between good and bad cuts. A good cut would be where interest rates come down because the inflation rate comes down, expectations of inflation are stable, and we have a nice reduction in the real interest rate, inflation-adjusted interest rates. But if we had the kind of situation that you just talked about, where geopolitical risks start to fly, the supply chains get to be threatened, energy prices are destabilized, and the economy starts to tank because of stagflation, rising inflation, and high unemployment rates, then the Fed's going to have to cut very aggressively to try to keep the economy buoyant. And that is a bad rate cut because that's the sort of rate cut where nobody wins.
I do want to ask you, the Fed's mandates about inflation and employment, in your mind, I know you might not have an exact number, but how big of a factor are some of these geopolitical tensions, again, the Israel-Hamas war, the Ukraine war, and what we're seeing in the Red Sea?
When economists really talk to each other, especially in the policymaking tables, geopolitical risks are things that you leave at the side, at the very end. Oh yeah, we got to remember the following things. But right now, the Houthi attacks are showing that the U.S. is not able to really keep this shipping through the Red Sea safe. And because of that, supply chains get threatened. We're not going to be able to get stable energy prices if this thing continues, and the costs of importing goods start to rise. That becomes a frontline issue. It's no longer the thing you relegate to the back.
So, Bill, I want to broaden this out just a bit. On Monday, the PBOC, they left a medium-term policy rate unchanged. That kind of defied market expectations. Then yesterday, we heard from the ECB saying possibly no cuts at all in 2024. How did the other central banks, how do they digest that, and how do they factor into some of this volatility that we could see in 2024?
That's a great question, because the central bank in China, the PBOC, has recognized that pushing on a string just won't get your economy reviving the way you have to. You really have to get some deep structural reforms in the property market. ECB is saying, we don't have 2% inflation rate, so don't tell us that we're going to be cutting, because we're not going to cut until we see 2% on the horizon, even though Germany's economy is weakening like crazy. So the central banks around the world are keeping interest rates high, and if the U.S. starts to cut aggressively, that will depreciate the dollar and really start to destabilize prices on the import side.
So, Bill, I want to broaden this out also to some of the elections that we saw. We saw the Taiwanese election over the weekend. I had another guest earlier that said about 40% of the world's population, about 40% of the world's GDP, those nations are having elections this year. How does that factor into all this?
I'm so glad you mentioned that, because the Taiwanese election, in some ways, has eased off the tensions with China, because even though the DPP party has been calling for independence, the fact that they lost the parliamentary majority means you've got a split government. And when you have a split government, it's good news to everybody, because that means inaction. So the rhetoric may be there for independence, but I don't think the real action is going to be there to threaten the point where China's going to have to do something. And all the other elections are raising these political risks as well. Sometimes, by the way, they're really good results, because in Latin America, you start to see capitalism reviving slightly. And so in that sense, I think the markets are seeing a slightly more friendly environment in certain key spots around emerging markets.
So, Bill, I want to bounce off some breaking news off of you. This just crossing the wires just right now. China's economy grew 5.2% in 2023. However, that's the lowest growth rate in just about 30 years. What do you make of that news coming out of Davos from Chinese Premier?
I think that means that they have really pumped the economy as much as they can with public spending, because if you actually dig into the numbers, you find that private sector spending is starting to crash like crazy, and they're making up for it with a lot of public infrastructure spending. The Chinese economy is not healthy.
All right. Bill Lee, Milken Chief Economist, always great to have you. Thank you for your time and for your insight. Also, be sure to catch CNBC's complete coverage from Davos, the World Economic Forum, a number of high-profile interviews coming up on Squawk Box, including Bank of America's Brian Moynihan, Bridgewater's Ray Dalio, Intel's Pat Gelsinger, Chevron's Michael Worth, and Qualcomm's Cristiano Amon. All right, coming up, bracing for another round of big bank results, the concerning signals facing the sector, and which bank our next guest thinks is best positioned to ride out any storm. Much more Worldwide Exchange coming up in just a moment.
To answer.
All right, welcome back to Worldwide Exchange. Goldman Sachs and Morgan Stanley set to run out the wave of big bank results reporting in just under 2 hours. Key to both reports will be the state of investment banking after revenue in that division fell 27% last quarter for Morgan Stanley, with Goldman posting similar losses. Investors will also be listening for any commentary from the bank's leadership. Goldman CEO David Solomon, he's been under increased shareholder pressure due to a series of strategic missteps, while Morgan Stanley will present its first strategy outlook since Ted Pick took over as CEO. Let's discuss this further with Nancy Priel, co-CEO and senior portfolio manager at Essex Investment Management. Her firm also owns several bank stocks. That includes Goldman Sachs. Nancy, good morning. It is great to have you here.
Good morning. Thank you. Nice to be here.
So Nancy, as we see the second week of bank earnings, what are you looking for, and what did you make of what we saw last week?
So particularly with the big banks, Morgan Stanley and Goldman Sachs, we're really looking at what they have to say about the environment for deals going forward. One of the things we heard last week from JP Morgan was in fact some optimism on deal flow picking up. And we know that deal flow was very bad last year. We know the numbers from the third quarter down in the mid 20% rate. But what we've started to see is an improvement on the M&A front, particularly in healthcare and some of the energy areas. And we think it's likely that we'll hear some optimism about that, and perhaps even some optimism on the IPO front going forward. That would be very good for these stocks, as that's an excellent business for them. In addition, from Goldman, we want to hear what they have to say about their consumer business, where they've made, as you said, a lot of missteps, and we need to hear how they're getting out of those businesses.
You know, you mentioned their consumer business. One key metric, of course, is net interest income. What are your expectations when it comes to that? And as you mentioned, the consumer business, Bank of America, their net interest income came in probably better than some people expected, obviously a big consumer bank. What do you make of that?
Well, the consumer right now is pretty good, and the banks certainly are not having as many issues with their mix between deposits, assets, and liabilities as they were earlier in the year. We've seen that improve sequentially, even though it's still negative. However, we are concerned with all the banks that the expectations for 2024 might be ahead of themselves for when net interest income is going to bottom. We're particularly concerned on the regional bank side as they seem to be a little more aggressive with expecting rate cuts and expecting that net interest income to turn around sooner. We think it will continue to improve modestly, but it's probably a second half of the year as opposed to a first half of the year phenomena.
Let's talk about the holding of treasuries for all the banks. That was obviously a big story last year following the collapse of SVB. What's your outlook when it comes to unrealized losses in that area now?
Well, it shouldn't be as big of a problem right now. Obviously, the inversion in the yield curve has subsided quite a bit, and certainly it seems as though we're heading towards a more normalized yield curve, hopefully because the short rate comes down with inflation continuing to come down. So we think there's less of a risk right now. We are keeping our eyes out very much on what is happening on the inflation front, because that is what could cause that inversion to steepen again, as well as potential weakness in the economy. And that could be very negative with the holdings of treasuries that these banks still have. Again, not expecting anything dire right now, but it's something to watch.
Yeah, we got mixed reads when it came to inflation, slightly hotter than expected CPI, slightly cooler than expected PPI. But you're really leading me into my next question. How does the Fed factor into your outlook when it comes to all the banks? Where a lot of people, the market's expecting up to 6 rate cuts. The Fed is guided to 3. How important are those cuts to your outlook and the investability of banks?
Well, today that is important because over the fourth quarter, we saw a very nice rebound in most of the banks. And we've seen those expectations come up where these banks do seem to be discounting that 6 rate cut expectation on Wall Street. We are more in the camp of believing the Fed that there will only be 3 rate cuts. And although valuations in banks are attractive, we don't think we will see any multiple expansion until we really start to see that net interest income improve, which would be a back of the end, as I said, back of the year-end kind of phenomena as opposed to a first half phenomena. So we think that the short-term risk in banks is, might be a little bit more on the downside. We would stick with the very high-quality banks is what we would want to play here, particularly a name like JP Morgan.
All right, Nancy Priel, always great to see you. Thank you very much. All right, ahead here on Worldwide Exchange, we have the one word that every investor needs to know today, plus send in the bulls. The signals our next guest is seeing, suggesting a solid year for investors ahead. And if you haven't already, follow our podcast. If you missed Worldwide Exchange, check us out on Apple, Spotify, or other podcast apps. Much more WEX coming up after this.
Washboardjim.com.
All right, welcome back to Worldwide Exchange. It's time now for your WEX wrap-up. We begin with the Wall Street Journal reporting 737 MAX customer, China Southern Airlines, is planning to conduct new safety inspections of its current Boeing fleet. Those checks could reportedly delay expected deliveries of more jets from the aerospace giant. Also this morning, even more trouble for the stock as Wells Fargo downgrades Boeing from buy to equal weight, citing the new FAA audit. Shares of Boeing right now, they're down just over 2.5%. All right, Apple is planning to remove its blood oxygen sensing feature from Series 9 and Ultra 2 Apple Watches to get around a U.S. sales ban of those devices if its appeal of that ban fails. British telecom giant Vodafone striking an agreement with Microsoft to invest $1.5 billion over the next decade to develop a range of businesses that include artificial intelligence, digital payments, and the Internet of Things. Separately, starting today, small businesses that pay for Microsoft's 365 Business Premium or Business Standard can now also subscribe to Copilot for $30 a month. Microsoft overtook Apple Friday as the most valuable publicly traded U.S. company and is set to open up at that level this morning. Also, some Tesla news. Elon Musk vying for more voting control over Tesla, saying he's uncomfortable growing the business without having an approximately 25% stake. Musk already owns 411 million of Tesla's 3.2 billion shares. That's roughly a 13% stake. Uber is shutting down its alcohol delivery app Drizzly after acquiring it for more than $1 billion in 2021. In a statement, Uber says Drizzly will cease operations in March as the company streamlines its business into one single app. And this weekend's Dolphins vs. Chiefs game setting the record for the most watched event on a streaming service with an average of 23 million viewers on Peacock, NFL Plus, and NBC's local affiliates. The numbers blowing past the previous record of 15.3 million during last November's game between the Seahawks and who else? The Cowboys. All right, here's what to watch this week. Earnings from Goldman Sachs, Morgan Stanley, Charles Schwab, Taiwan Semi, and Travelers, among others. And then on the economic front, retail sales, housing starts, and existing home sales data all on tap. Then in D.C., a potential government shutdown looming with select funding expiring on Friday night. And the big event of this week, of course, the Davos World Economic Forum. CNBC will have live coverage of the event, including interviews with the CEOs of Bank of America, NASDAQ, Intel, Chevron, and Qualcomm. All that starting in just a few minutes on Squawk Box. All right, ahead of all that, let's get another check of how the new week is shaping up. Take a look at futures right now. As we mentioned all morning long, they are in the red. Looking at the Dow off of its lows, looking like it would open 180 points lower. The NASDAQ also under pressure this morning. Joining me now is Courtney Garcia, Senior Wealth Advisor at Payne Capital Management and a CNBC contributor. Courtney, good morning. Great to have you here.
Thanks for having me.
All right, we're seeing futures under quite a bit of pressure this morning. With that in mind, how do you see today shaping up? What's your WEX word of the day?
Yeah, actually, this perfectly describes my word of the day, which is skepticism. I'm sure you've heard before that the markets are born on pessimism. They grow on skepticism. They're going to mature on optimism and die in euphoria. We're clearly going into that skepticism phase where we were definitely pessimistic last year. When you're seeing with investors, they're showing that their investor sentiment optimism levels are actually high, but they're not putting their money where their mouth is. There's still a lot of cash on the sidelines, and cash levels actually went up last week, showing that investors are not yet ready to put their money in. That's what you're seeing right now is markets are having a hard time really starting the year off this year after such a strong end to last year. But I think that's all the more reason that we have this cash on the sidelines. As if inflation does in fact come down, you're going to see that come off and go back into the markets. And I think it's all the more reason the markets will eventually go higher this year. Okay. It's just having a little bit of a false start here.
All right, so you see the markets going higher long term, but important to note, the S&P kind of peaked into positive territory last week. Now it looks like it'll open up negative for the year when the open to bell comes if the trend in futures continues. What does that signal to you? And really, what happened to this broadening of the market that so many people were talking about?
Yeah, you're definitely seeing this consolidate here, which I don't think is that abnormal. We had a really fantastic run from the end of October through the end of the year, and you're now starting to see that pull back a bit here. And especially now you're seeing earnings are starting, and that's going to be the focus this year where there's a lot of optimism, especially with artificial intelligence. And now you're going to want to see that actually reflected into earnings, reflecting into profits. And so you're going to see investors, I think, are taking a little bit of sidelines until we actually see how earnings are shaping up. We're already seeing that starting here, and I think you're going to start to see some more reflection of that as we go forward. You just need to see some more numbers coming out here.
You know, Courtney, you're saying investors are a little bit on the sidelines. According to the latest data from the investment company, it's about $6 trillion on the sidelines, so it's more than just a little bit. With that in mind, as you see that money come off the sidelines, I'm sure some of your clients are in that group. Where would you allocate money to? Are there certain sectors that you would put money to? Are there others you would stay away from?
Yeah, we're making sure that we have broadly diversified portfolios, but we are actively taking profits from those large, the Magnificent Seven companies that did really well last year, and we're adding to things like small caps, things like energy, things like real estate, some of those interest rate sensitive sectors. We're making sure we're taking profits and adding there. But also, we are seeing a lot of people with cash on the sidelines. That's not what we're recommending right now because we do anticipate interest rates to come down this year. And the first thing that's going to reflect downward are your money market funds. So you do not want to be sitting those forever. You're going to have that interest rate risk where you're going to eventually be reinvesting those into lower rates. So on the safety side of your portfolio, you do want to start to look to extend some of your duration on your bonds just to make sure that you're locking into some of those rates that are available right now. Sitting too much in cash is really not a good long-term strategy, and we're actively talking to all of our clients about that right now.
Yeah, according to your data, since 1925, so almost 100 years, the S&P average return in an election year over 11%, so you definitely don't want to have that money on the sidelines. Courtney Garcia,
Absolutely.
it is always great to see you. Thanks for being here.
Thanks for having me.
All right, one more look at futures before we let you go. As you mentioned, futures have been under pressure all morning long. It looks like right now the Dow would open up almost 200 points lower, still off of its lows of earlier this morning. The NASDAQ also under pressure, but off of its lows of earlier this morning as well. We'll have to see how the action starts at the opening bell. As we always say, it's very early. We're going to leave it there. Again, futures solidly in the red. Squawk Box and Davos coming up next. Thank you for watching.
Good morning. The future is slightly in the red at this hour to kick off the holiday shortened trading week. We have two big reports coming from Goldman Sachs and Morgan Stanley. Apple dropped some medical features for some watches to get around that patent dispute. It also has a rare discount plan for the iPhone. The details are straight ahead. And former President Trump takes Iowa, and it wasn't even close. It's Tuesday, January 16th, 2024. We are in a land far, far away. Spark Box begins right there.
Good morning, everybody, and welcome to Squawk Box right here on CNBC. We have a special edition for you this morning. We are live from the World Economic Forum in Davos, Switzerland. I'm Becky Quick along with Joe Kernan and Andrew Ross Sorkin. And guys, a little chilly, but it is
Welcome back to Davos.
Yes.
That is not a green screen.
No,
Not a
it's
green
not.
screen. It's beautiful
See that?
out.
There's a good reason.
You can see our breath.
We sometimes ask, why outside? This is why.
Because it's beautiful.
This is why outside. It's worth it.
It is.
We get
It is.
heaters. We'll make it. Got
And
some-
hot tea. So we're
some
okay.
thermals on. You wearing some thermals?
I got some thermals, and we got a lot of guests. And this guy we're going to have on in a moment. He doesn't wear thermals or he doesn't wear a coat. Brian Moynihan's going to be on in a moment.
JFK.
Manly man.
Right.
That's right. We're going to kick off a huge week of coverage for you in just a moment. But before we do, let's take a look at what's been happening with the markets as we are opening up after a holiday weekend once again in the United States. Let's take a look at U.S. equity futures this morning under a little bit of pressure. Dow futures actually almost down by 200 points, decline of 190 right now. NASDAQ futures are off by 128. The S&P futures down by about 30. If you take a look at Treasury yields, last I saw the 10-year was yielding just above 4%. I think if you check things out right now, you're going to see that we are, the 10-year is at just above 4%, the 2-year just above 4.2%, and then you've got energy prices. And with all the talk of what's been happening with the Red Sea, Houthi rebels now saying that they will attack U.S. and British-based ships as well as just ships that are involved with Israel, either Israel flagged or headed to Israel. You can see that WTI this morning is trading up about half a percentage point, just above $73 a barrel. Natural gas is down by about 8.5%. Andrew?
Meantime, while it may be freezing here, it is really freezing there. Voters in Iowa braving ice and snow, giving former President Donald Trump a landslide victory in the Iowa caucus. Trump getting 51% of the votes, followed by Florida Governor Ron DeSantis coming in at a distant second place. Former South Carolina Governor Nikki Haley grabbing third place. Vivek Ramaswamy coming in fourth place. He's now dropped out of the race. The candidates now take their battle to New Hampshire. And guys, I don't know how much of a conversation you've had here about what's happening there. That seems, what's happening here is one conversation, but seems to be very related to what may happen in the United States.
It's not a new conversation.
It's not a new conversation,
But it's not just U.S. CEOs either. I would say it is countries around the world waiting to see how things are going to shake up come November in the United States. A lot of other countries will take their cues from that as well.
There are some policy changes that you would see that would affect people here in Europe. And they're hearkening back, Christine Lagarde hearkening back. It's like, this is not conjecture. We saw in the 4 years in his prior presidency certain things about NATO, certain things about trade. So
well, President Zelensky's here. I'm actually going to be talking to him later today. And him too. And clearly, we'd see. I don't know. I don't know what you think a President Biden versus a President Trump would be like, and what the impact would be on Ukraine.
Iowa has not been necessarily the place for the Republican caucus where the eventual nominee was the winner. I think this year we need to throw that playbook away. Probably, I don't know. Anything can happen.
There are people who are suspecting that this will be wrapped up in a number of weeks by the time you get to South Carolina.
I think maybe Santorum.
You're not putting much stock in this.
I'm not putting much stock that in the past Iowa has not been. I think.
So you are putting stock in it.
Yeah,
yes,
I think Trump is likely going to be the nominee, and New Hampshire we'll see. Haley made some inroads there, supposedly cut it to single digits. We'll see whether that, whether this changes based on the inevitability of it. Meanwhile, on Capitol Hill, lawmakers, striking a stopgap spending deal that would keep the federal government running into March. So we got that going for us, which is nice. Senate Majority Leader Chuck Schumer, House Speaker Mike Johnson agreeing to cap effective spending for the 2024 fiscal year at roughly $1.6 trillion. That number is about $70 billion more than far-right conservative leaders wanted. Lawmakers have until midnight Saturday to get that package approved.
And in corporate news, Boeing planning to add more quality inspections for the 737 MAX after the mid-air blowout of a cabin panel in an Alaska Airlines 737 MAX 9 earlier this month. The new developments from Boeing came after the FAA extended the grounding of 171 MAX 9 planes indefinitely for safety checks. The Wall Street Journal reporting today that the long-awaited delivery resumption of 737 MAX jets to China could face fresh delays after the Alaska Airlines incident. China Southern Airlines was ready to receive Boeing planes as early as this month. Let's take a look at Boeing shares this morning. Again, the pressure that we've seen the last couple of weeks continuing this morning. It's down another 2.5% to $212 a share.
Meantime, Apple saying it's going to be removing a blood oxygen sensor from some of its smartwatches to avoid a patent dispute for their sales disruptions. We've been talking about this story now for quite some time. The tech giant halting sales of some watches models briefly last month. This after a U.S. import ban went into effect, stemming from an October ruling by the U.S. International Trade Commission, the trade agency, finding Apple had violated the patents of the medical technology company Masimo related to their blood oxygen tool. The U.S. Customs and Border Protection Agency, which is responsible for enforcing import bans, approved technical changes to the watches, including the removal of the blood oxygen sensor. So a big step down for them. Unclear how much of that's going to impact the watch sales themselves. It's obviously only one component of why people buy those watches. Meantime, separately, Apple offering a rare discount on its iPhones in China. Company planning on a promotion Thursday through Sunday. The price cuts up to $70 right in time for the week-long Lunar New Year holiday, which begins on February 10th, which of course is a traditional time of gift giving in China.
Who wants to know their oxygen level? That helps for, yeah. I know, but I would think it's mostly for people of a certain demo that don't buy Apple Watches in the first place.
Well, not necessarily. You have more people who've been buying
if you're
the
running
watches.
Or something, if you're exercising.
Yeah, but you also have people who've been buying the watches for the health products that are in them.
Right.
I'm thinking of
but I'm just saying, I've never.
My mom bought one for it.
If they were, I would not notice removing that feature from my watch. Right, I have never.
Well, you watch them wear them for different reasons, but I think there's a lot of people who are. This is supposed to compete with Garmin. This is supposed to compete.
I know,
people using it for
what
that.
do you actually need your blood oxygen? It seems like maybe if you're, I don't know, if you have certain
medical
medical
cardiac
condition,
issue, if you have a cardiac issue,
medical condition,
but
it usually comes on later.
Tim Cook has been looking at the health aspects of the watch as being the big future for that. So it's a setback from that perspective. My guess is that they will correct it quickly.
Right.
Well, the question is, can they correct it quickly because they don't have the patent?
Yeah, come up with
an alternative. Are you back to your Apple Watch?
I wear one occasionally. I sort of go back and forth between different watches.
The best thing about
no watches, just having the phone.
The best thing about it when you have it on is you can get an email and feel it or something. Is that the best thing? What's the best thing about it when you have it on?
Best thing
come up with it. You can't come up with
it. It just makes it so much easier. No, if I don't have,
that's what I mean.
You know what it is? If you're in a meeting. You don't want to have to get out your phone and look like you're not paying attention. A little glance down. Looks like you're looking at the time.
Looks
maybe
like I'm bored with this
else.
conversation. What time is it?
Well, that's true too.
I'm bored with this conversation. So when we come back, we're going to kick off a big lineup here in Davos with Bank of America CEO Brian Moynihan. And over the next 3 hours, we've got the CEOs of Lazard, Accenture, NASDAQ, Intel, Chevron, and Qualcomm, plus the founder of the world's largest hedge fund, Ray Dalio. Squawk Box will be right back. As we kick off the World Economic Forum here in Davos, we want to look ahead at the global economy in 2024 and get a preview of what we can expect this week right here in Davos. Joining us right now for that is Brian Moynihan. He is the chairman and CEO of Bank of America. And Brian, it's really good to see you here.
It's great to kick off again here in Davos in this beautiful setting. It's nice and warm out today. And
it's not bad. We've got the sun, so we're taking that and we're running with it. Brian, you're our first guest here, and I was hoping you could kind of lay the groundwork for what to anticipate from the WEF meetings here this week. One of the huge issues that's come up is the lack of trust in institutions, big institutions, in governments, and in NGOs. There was an Edelman survey that just came out this week that showed something like only 22% of people have faith in those big institutions and NGOs. What does this brain trust here do about that?
Well, I think it's a message to them to act and get things done and act in unity. And we'll have over the course, there'll be the trust question. AI will be a big theme here. President Zelensky just came in and talked to a group of us, and and it was about how the private sector can support the Ukrainian economy that is actually growing last year, which is pretty amazing.
It was 5% or something.
Yeah,
right?
it was 5. Well, he actually corrected somebody who's above 5%, so I think it's 5.5 or something. And so you think about all that, and so those themes are there. But what people want from institutions is certainty and execution and getting stuff done, and not the usual food fight that goes on. And this is a great place just to have those dialogues, learn from people, and then go back and try to do something good.
Let's dig in a little deeper on what you heard from President Zelensky. I mean, this is a critical time for what's happening in Ukraine. What's been amazing is that their economy is growing while they're in the midst of this ongoing war.
I mean, it's a classic definition of walking and chewing gum when you think about it. They're fighting to the death, and the first time they came in 22, all of us were just stunned by how resolute they were in terms of fighting the war. And on the other side, they've opened the Black Sea so they can get the grain out of the country, and they're producing that in the economy. Our teammate Bernie Menza went there on Friday with Secretary Pritzker, and he said, you're in Kiev, you go to a coffee shop, it feels like a normal city, there's traffic jams, and then all of a sudden the missile warning come in and stuff, so it's much different. But his message was they've got to straighten out the country, and the reforms have to go through while they're fighting a war too, to get the anti-corruption and the things that they were working on as a country. They have to keep working at it, because otherwise you can't put the money in at the level. So he knows that, and it's fascinating to hear him talk about it, because he's flipping from military defense to anti-corruption to military defense to grain production to military defense. It's really kind of fascinating.
In terms of the global economy, one of the issues that you've talked about recently, you just came out with earnings on Friday. One of the things you said is that there is less demand for commercial loans. What do you see happening? Well,
so that's more of U.S. commentary, and at the end of the day, the consumer's been relatively strong. They've held in there. They continue to grow their spending. So demand's there, but businesses have gotten more and more cautious, really facing this question. If you're told that there's going to be a decline in the economy, soft landing we predict, but still from a 4 to 5% growth rate to 1% growth rate is a steep slowdown. They're being cautious. Their cycle shortens, their thought process shortens. And so what we need is just to kind of get through this change in the rate structure in the U.S. and around the world. We need to get through a little more certainty and a stabilization at a level, and then we can work out from there. But right now you're in the twist between a very a rapid tightening of policy, knocking down car loans and the housing industry and things like that as intended, and now you got to come out the other side, and businesses react to that. So their line usage went from 40% pre-pandemic to 30, back up to 36, and now it's bouncing around a little bit low. That against an economy that's growing, you'd expect them to be back up to normal, frankly.
Go ahead.
Sorry, we still see, I don't know about you, but some of your competitors still refurbishing the bank rescue fund, but can we put that behind us? So that really was a one-off. A couple of banks that got caught with their pants down in terms of duration risk, but we thought maybe that everybody had a duration risk problem. That was not. Now rates are starting to, they come down. But maybe they come down. So we dodged that. That was a mini little thing.
Those companies are very unusual companies. They're very different. If you put a 10-point scale, what's a bank? It's 10 would be ourselves and Wells and people like that. And if you went to them, they're in the 2, 3, because it was a very different business model, and that business model suffered. And it's been contained. And yes, the group of us, we were $2.1 billion in the fourth quarter to reimburse the fund. And so the FDIC, everybody thinks is the government's money. It's a government guarantee, but it's a bank insurance fund behind it. We pay for it, and we paid for that, for those costs of liquidating those companies. But Yeah, that has been behind us, and the rest of the industry's strong. They have a capital. That's why we are not really thrilled with these new capital rules, the liquidity tests, the stress testing we've been doing for 15 years.
No iceberg underneath
But
of
I was
hold the
going to ask you
maturity
about
of
commercial real estate, because I don't know if you
That's
saw
the
it,
other.
probably a lot of people back home may have seen it. There's a big 60 Minutes piece
Yeah.
just this Sunday, all about commercial real estate. And there were a lot of prognosticators on that program saying, look, all of these things are going to roll, and when businesses actually have the opportunity to get out of their leases, they're going to, and this is going to take the whole market down.
Everybody's...
The whole commercial real estate market down, which might have larger implications.
So there's a couple things that the commercial real estate loan product, for lack of a better term, is more outside the industry than industry, and then in the industry, it's more of a localized product, and so those of us that are larger don't have as high exposure clearly than we ever did. We had 100 billion going into the financial crisis. We have like 60 now, and of that office is like 15, and so across $1.5 trillion alone, $1.05 trillion.
Are you going to change your own footprint?
In terms of
your own the real estate, the real estate the Bank of America has, because a lot of people are looking around at businesses saying, 2-3 years from now, when these leases come up, are people going to keep them? Are they going to shrink?
We've shed 30 million square feet of real estate in the last 15 years.
Already,
from about 100 million, almost 40 now, down to 60.
Why? Because you didn't like it?
Just space consolidation, efficiency. There's a long-term trend in the hoteling and all the different office space, and then the pandemic hits, and then we learn about 3 days a week, 4 days a week, and all that. Which actually, make it simple. There's 5 work days. If you have people in the office 4 days, that's either 20 or 25% savings in real estate costs. But it takes you time to get.
Is it really? Because don't you still need the same space? I mean, if people are coming in 3 days a week,
that's the hoteling and stuff that went on. Remember, we work and all the different things we talked about? That went on before. That trend line was already going. What happened was we only got about 25% of our space positioned that way. And then the pandemic hits and everything changes, and now you can go do the rest. And that's the long-term trend. The commercial real estate, look, at the end of the day, the revaluations are going through as we speak. And you're seeing that come through provisioning and reserves and charge-offs, but it's relatively modest. But it takes a long time because this is a slow burn of change, as opposed to, as Joe talked about, 5% rate rise in 12 months. That's a quick change.
But if it's not a problem for you and some of the other big banks, is it a potential problem for some of the smaller banks that do focus much more heavily on commercial real estate? And what does that mean for the FDIC and the potential assessments down the road?
That's where I say these are. If you were around in the late '80s, which I was, the commercial real estate and the real estate issues around the country, those things are slow liquidations. The system knows how to handle that kind of bank failure. 4,000 banks have failed in the country over the last 40, 50 years. So it's not a big event. And most of that concentration, smaller banks, they'll be fine. And they know the clients. It works through local communities. And so, yes, it's going to be disruptive, but it's a little different than if you have what we had in the financial crisis, where the whole mortgage industry went completely overnight, and that affected all kinds of things. It's just the leverage is not quite the same.
You believe in the market's forecasting of how many rate cuts we get next year? And the reason I ask is there's always a worry about crowding out of the private sector at $34 trillion, and it started happening, and then the supply was too much, and the auctions weren't going well. Suddenly, we're going to get everything's fine, 6 or 7 cuts, no more worries about that. We're clear sailing.
I wish the day that you all would stop talking about the Fed and they would be off to the side, and the entrepreneurs and the capitalism.
They won't let that happen.
Because the U.S. economy drives by you're going to have 80 CEOs, I think, over the next year. They're going to talk about what they do and how they invest. That's what drives the U.S. economy. And so the Fed's got to get normalized and then get out of the way. But if you think about, we have 4 rate cuts, not the 6 or 7 in the market for this year, 24, 4, and 25, which leaves you the 3% plus Fed funds rate. Probably have a 4 handle on a 10-year. That'd be a normal rate curve for those of us who've been around a long time. It's just for the 15 years or so since the financial crisis.
Keep it around. Yeah.
Nobody's seen a normal rate curve, so it's going to take a while for the system to adjust to that. The reality is we got to get there. We got to get the rate structure in a way that has more flexibility up and down. Is not so glued to the floor that we can't get up. And so I think you'll see that play out. Hopefully that'll play out, because that would be better for the U.S. and ultimately better for all the countries around the world if we get the U.S. sort of situated with a dynamic of growth and inflation that's much more normal. And that's what the Fed's trying to engineer, and they got to be careful they don't overshoot right now.
You mentioned some of the capital requirements that are coming for the banks, some of the changes that are anticipated in Basel III. It has been a move that you and a lot of other big bankers have been very vociferously kind of stepping up and saying this is going to hurt competitiveness. It looks like they may be changing some of those requirements, or they're at least considering it.
From the public dialogue, they're working on it. When we say competitiveness, some people say, well, it's about you guys just want to make more money. We've made $100 billion after tax since the pandemic. So we're going to make money in any environment, and my colleagues will do it too. This is about competitiveness in mid-sized businesses. If you have a business in Europe and a business in the United States, both engaged in the supply chain for autos, and we have twice the capital requirements that they do in Europe, which is what could be the result of this. We're going to have a higher cost of capital for that mid-sized company in the U.S. that produces the auto industry, sells to the great auto companies around the world, than the company in France or Germany. And that's the competitiveness issue. Yes, does it make us less or more competitive in the biggest banks? But the American banks are great, so they'll figure out a way around it. But it makes the mid-sized businesses less competitive. And that, we're into a trade negotiation on this thing. And that it's not, the playing field's not level now, and it will get more on level. And so we're saying be careful of this, because frankly we're well capitalized. As Joe said, we made it through a quote banking crisis last March, and life went on. We've been stress testing and all this work we've done, and you're throwing it all out on a different theory. And we're saying, is that wise given the impact on the American economy?
Do you have a preference in who wins the election?
I told Becky, somebody asked that. The answer is, we've been around since 1784, Joe, so we've been around a lot of elections, a lot of things. Somebody will win, we'll figure out how to operate, we'll go to try to help them be successful. That's what companies have to do.
Good answer.
Brian, I want to thank you very much for joining us, for kicking off our coverage from here. It's great to see you.
Thank you.
And
Enjoy. Stay warm.
You're not cold, are you?
No, not yet.
He's not cold. That story. Thank you. Coming up, Elon Musk. Elon Musk wants more control of Tesla before moving on with some other big plans. That story next. And then in the next hour, quarterly results from both Goldman Sachs and Morgan Stanley. We'll break out the numbers. We'll get the instant reaction. Squawk Box live from the World Economic Forum in Davos. We all flew commercial. We'll be right. Well, can't speak for everyone here. We'll be right back. Tesla CEO Elon Musk wants more control. That's possible, of the EV maker. Musk says he wants about 25% voting control over the company. He currently owns around 13% of Tesla, which is about 411 million shares. Who's counting? Who's counting? That's the company's last filing. Financial filing was in the third quarter of 2023. Musk wrote on X, in his words, "I am uncomfortable growing Tesla to be a leader in AI and robotics without having 25% voting control. Enough to be influential, but not so much that I can't be overturned. Unless that is the case, I would prefer to build products outside of Tesla." Interesting. Musk's post stood at odds with remarks that he previously made suggesting that Tesla is already an important AI and robotics company.
It's an interesting one because, you know, if the company's already an AI company, I'm sure their shareholders are going to say, look, I thought you were already going down this road. Now you're saying you're going to take, and then the question is, are they going to, people are going to claim he's trying to take IP from this and that, and it gets
in studying
very complicated.
If everyone we're going to talk to, from Qualcomm to Palo Alto, and honestly, you know, if I read about molecular biology, every acronym, I know everything, I understand everything. When I'm reading about Palo Alto or Qualcomm, it takes me a while.
Yeah.
You know, I don't know if you, I mean, it's very, very arcane, and it's difficult. But one thing they're all saying, it's all about AI, but we have no idea at this point how to do AI. They're all saying the same thing. It's the most important thing, but it's the most daunting. Julie Sweet's going to be on. Accenture's telling all they want to talk about is AI, but they're scared.
Pat Gelsinger is going to come on from Intel today and talk about how AI is hopefully the future for the chip industry too. But with all of the changes,
I mean, these CEOs actually need to do something now.
And they need to know something.
Yeah, they need to know something.
Yeah.
When we come back, we're going to talk to another CEO. We'll talk a little AI too, I imagine. Lazard CEO, it's a different business though. Peter Orszag joining us right after the break. His expectations for the Fed, his outlook for deal making in 2024, and everything he is hearing on the ground right here in Davos, Switzerland. And later today, here at the World Economic Forum, an exclusive interview with Secretary of State Antony Blinken. That is today at 10 a.m. We are coming right back.
What are you waiting for?
Joining us now in an exclusive interview to talk about the markets, the Fed, and so much more right here in Davos, Switzerland. Peter Orszag took over as CEO of Lazard just 3.5 months ago, back in October. Previously served as director of the Office of Management and Budget under President Obama. It's great to see you.
Good to see you guys.
To help us kick things off on day one. We always think of Davos as sort of, sometimes we think of it as a contraindicator, sometimes we think of it as a signal. What are you hearing? What are you seeing? We're trying to, I think, all sort of get a test here of where things are going.
I think a fair amount of constructive optimism on the U.S. economy, a lot of concern about Germany and the UK from an economic perspective, and then massive concern about politics.
The politics, I mean, I saw you last night. The politics of what's happening in the U.S. and how that affects the rest of the world, or you think the politics of what's happening vis-a-vis the different crises and wars in Ukraine, in Israel and such?
All of the above, but disproportionately, what will happen in the U.S.
Okay, so let's go to that. What do you think is going to happen in the U.S.? We've been talking about Iowa just in the last half hour. Clearly, it seems like former President Trump is going to become the nominee. What do you think happens then?
Well, first, I think it was very likely that Trump was going to be the Republican nominee before Iowa. It's more likely now, but it was always very likely. I think it's going to come down. It's going to be a close election. Every election in the U.S. is going to be close because of how polarized the country is, and it comes down to fundamentally age versus abortion, with African American turnout, and then all the cases surrounding Trump as auxiliary players, with the tip may being the economy, and the economy is seen as much worse than it is, but that can change over the next.
Can I ask you about that, about the perception of the economy? And I've heard you talk publicly about how good I think you think the economy is. People get a lot of blame when things are bad, right? So when you see gas prices go up, people say it's that guy's fault. I don't know whether people get credit if you see gas prices go down.
Well, I think what's happening here is three things. One, there's a lag, so it takes a while before perceptions of the economy catch up to the actual economy, so that needs to kind of play through. The second is there's clearly a deep partisan split on this issue. Republicans think the economy is much worse than Democrats do, and as the country polarizes, that gets worse. And then the third thing is there's new evidence out, and I don't mean to harp on the media, but that given GDP, given inflation, given the stock market, the news sentiment is much more negative than it should be. Disproportionately
let's give
relative to
people
history.
some credit for how they feel about their own personal finance. So I would say that gas prices, when they come down but are still up 40, 50, 60% from where they were when Biden took office and said he was going to put fossil fuels out of business, that's a problem. That trickled through to inflation across the board, whatever you want, supply chain problems. I'll grant you that it wasn't all Biden's fault. But when it slows to 3% from 8 or 9%, the 8 or 9% for 2 years is still in there. So people are spending, since Biden came in, 35% more for groceries, and they feel that. Real wages didn't start growing until the beginning of 2023. For 2 years, you were underwater. You're still below where you were when he took office in terms of actual wages. People have enough to be able to say, I'm not feeling great, and it's not the media telling. And believe me, the media would like to give Biden the benefit of the doubt, and you can't. People feel this, and I get tired of people saying, it's too bad that you don't understand the economy. You're not bad off, and
No, I don't think it's that. I mean, I agree. There's a lot of pain. Look, step back. I mean, you want to talk about frustration in the United States? 2/3 or so of the American population has seen flat or declining life expectancy over the past 15 years. You want to talk about a core issue? It's completely understandable.
That's pandemic related.
No, it's not. No. This is deaths of desperation. It's low, and even I said 2/3. I mean, it's up to the middle class too. This is deaths of desperation. This is people frustrated with their
coming across an open
outlook in life.
Coming across an open border.
So it's completely there. Now, we can debate the most recent macro indicators, and I'm not denying that many people are still in lots of pain, but the most recent macro indicators are first of all, they're really good relative to what you would have thought at the beginning of the pandemic. We've come through this much better than one would have thought. And secondly, there is a disconnect between at least the macro indicators and how people are talking about the economy.
Peter, let me ask you about how businesses are feeling. I mean, that's how consumers are feeling. You talk to CEOs all the time. You're looking at the potential for the Fed to start cutting rates.
We'll talk about that.
Okay, you don't agree with that?
You're not a believer.
Now, look, first, I think people misdiagnosed inflation. It was mostly pandemic coming and going. That having been said, I do not think the market expectation that the Fed is going to start cutting rates anytime soon, at least until like very late in this year, is likely to play out. Just look at what Jay Powell's saying. A. B. They're going to be concerned about cutting too aggressively during an election. They will claim that they're not, but they will. C. They really do not want to have to go back to quantitative easing. So holding the rate higher for longer means that you then have the opportunity to cut rates. And then finally, why cut rates? What's the impetus for cutting rates when A, you want to make sure that you've really stamped out inflation, and secondly, the economy's not in recession.
So what does that mean for the economic outlook, and what does that mean for businesses potentially getting back into M&A and starting to move again?
First of all, for M&A, high rates are a negative, but stable rates are a positive. So high and stable is not so bad, and I think what's happening, the reason the M&A market has started to turn is exactly that people have seen the kind of pivot from the Fed, and that's created, along with some losses in court for the government on antitrust, a renewed effort at M&A. And then with regard to the economy, fundamentally the labor market remains, in the US at least, not in Germany and the UK, the labor market remains pretty good, and the consumer, although there are some signs of fragility, including in default rates, the consumer's held up pretty well.
I go back though to this, I don't know if it's a conspiratorial view, but people talk about it. Would the Fed lower rates in an election year? How does that work? You said they would do it later in the year. Don't you think that the closer you get,
the closer
you get to the election, actually it's even harder.
Yes.
And so to the degree that there's something going on in people's heads about how do we do this in the context of an election, you almost have to, if you think you have to go late, you almost have to go early.
Or literally into 25, which I think is the more likely scenario. I think, look, he's been very clear. He's going to hold these rates, higher for longer. There's no immediate impetus to cut. He keeps saying that.
Can't you do a Taylor rule that tells you that we're too tight right now if you believe that core is at a certain level? I mean, you can do it if you did purely mathematically and didn't think about.
Or the University of Chicago says that you're looser than ever.
Yeah, I think I'll be blunt here. I think the inflation problem has, despite the fact that prices are higher, as you correctly noted, the inflation problem is basically solved. If you take out housing out of the index,
then we're too tight.
You're at right at about target. Doesn't mean you're necessarily too tight, but you're about target.
Stay tight if you don't have to be, right?
Peter, we want to thank you. We appreciate you helping us kick things off today.
It's great to be with you guys.
Great to see you. Thank you.
Coming up, the CEO of Accenture will join us next on how her firm is helping companies in dozens of industries adapt to new technology. There's like almost 1 million people at Accenture at this point. I can't believe it. 750,000, could that be true?
Yeah, it is.
Unbelievable. All about integrating artificial intelligence, so there will be 400,000 after that. And a reminder, get the best of Squawk Box daily in our podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. We'll be right back.
a member.
Corporate leaders say technology led by artificial intelligence is the #1 disruptor for businesses, according to a recent survey conducted by Accenture. Joining us now is Accenture CEO Julie Sweet. I don't know if your ears were buzzing because I was talking about you earlier, Julie, because reading all the surveys and all the research your company conducts, everybody knows this is the most important thing. And everybody is just scared to death of whether they're going to be able to maximize the potential of it. And it's not a given. I mean, you really need to, you probably need Accenture to help you along the way, I would think is what your sales pitch would be.
Yeah, well, Joe, you're absolutely right. And it's funny, we have 150 leaders who signed up this year at Davos to do workshops. So not show up and listen to a panel, but to actually roll up their sleeves and do workshops. And we did that because the single biggest differentiator between who's going to win and who's going to lose is actually not the technology, it's the leadership. Because in order to not be afraid, you have to know more about this technology than you've ever had to know about technology, because you didn't have responsible PC, you didn't have responsible cloud. And in 3 decades, I've never stood in front of a client and been able to say, this technology will change everything about your business positively if you do it right.
I mean, think if you're a CEO, and I remember the day we started talking about ChatGPT. It was like, we flipped a switch, and like these CEOs, the day before, never said AI, or it was something off in the future. Suddenly it's here and now, and you better be up to speed or you're going to lose. Right?
You're absolutely right. In 2022, we put out the big pronunciation. If to succeed in the next decade, you have to use tech, data, and AI. And like almost no one said, yes, you're right, Julie, I want to come talk to you about it. ChatGPT comes along and they finally understand it. And there's a big pivot though, because right now, if someone comes on and says, I have 400 things I'm doing, the first thing I say is, you should be doing 3. Because we're at risk of everybody spending a lot of time piloting and experimenting and really getting it wrong.
What are you doing personally? Is there something you do using AI today that you think has fundamentally changed the company, something tangible that you talk about?
Well, me, not my company personally.
Either you personally or Accenture, just broadly.
Well, so we are completely redesigning how we're doing software development. That's just table stakes, right? Today I have AI that allows me to just ask my financials information and get questions back. I did not have that a year ago.
That's like an internal chatbot you built for yourself.
Yes. Okay. Right. And it's getting better. It's not always accurate, by the way.
Well, that's
but
what I was going to say.
better,
Sam Altman
right?
often talks about these things being an incompetent helper.
Right. Yes, and at the same time, before I used ChatGPT to do that, I was using AI to bring it all together, and that wasn't incompetent, traditional AI, and I didn't have that before. I had legions of finance people who would go off when I asked a question and come back a day later, and that I already solved with traditional AI. So it is transformative, but you have to actually change. Like the biggest problem when we did that was not the technology, was that none of my leaders were using it. They still called the person to bring the slide to do it.
Julie, let me ask you, you do a huge amount of recruiting on college campuses. Have you changed any of your recruiting policies just based on the anti-Semitic backlash that we've seen on some of these elite college campuses?
We have not. We're not looking at whether people have said some things. We do background checks, but we have not made specific changes to say we're not going to go look at. That's just not where we have played in terms of kind of doing that. We're much more focused. In the first case, do we have people who share our values? Are they people who learn in how we think about technology? So, for example, the #1 question we ask all recruits is, what have you learned in the last 6 months other than in school?
Are the Ivy Leagues the best place to recruit?
We actually do much broader recruiting because remember, we're recruiting strategists and we're recruiting people who do supply chain and we're recruiting people who do coding. And so we're very different than most companies, is that the Ivy Leagues are good for some things, but not all things.
So you've got companies that, they find themselves, their CEOs like, wow, we really got to get up to speed on AI. Let's talk to Accenture. Well, who got you up to speed? I mean, are you ready to go to tell these companies how to win in the future. How did it happen? And when did you start?
So great question. So personally, right, I am constantly doing learning, but we've been working, we put out a book, Human Plus Machine, 5 years ago that talked about Gen AI. Right, so we've been working in Gen AI for years, just like we've been working in AI for a decade. It definitely came on faster than any of us anticipated, but I've taken my top 45 leaders through 10 hours of live training. They've done at least 6 hours of computer training. We'll train 250,000 people this year in Gen AI, and since 2019, I've trained every person at Accenture, about 600,000, because obviously we have people coming in, on AI, right? So in 2019, I became the CEO, and I said, every person, you work in the mailroom, HR, or a strategist, you need to know 6 things. Now it's 11, and they take assessments. So one of the things that I'm most passionate about is that AI can be great, and we have to bring our people along. My dad taught me something really simple. A job matters in life, right? Lots of problems are solved by that. And so we focus a lot on the skills that are needed. So when I'm using AI in finance, I don't have to explain to the finance people AI. And so when you think about the Davos, right, and why does AI matter, and the skills part. So every workshop we're doing, we talk about skills and talent, because we have to do something fundamentally different in companies and in schools.
Thanks.
Haunting. I may call you.
Julie, thank
to
you.
help me.
Great to see you.
No, I would do it personally.
When we come back, a lot more rolling on here from the World Economic Forum in Davos, Switzerland. Fashion icon Dion von Furstenberg. Her view on the trends in retail and keeping up with the consumer. Squawk Box. Come right back after this.
%50 off.
Welcome back to Squawk Box Live at the World Economic Forum in Davos. Our next guest founded one of the most iconic brands and dress styles in fashion history. Today, she's a leader in culture, fashion, and philanthropy. Joining us right now, DVF founder, co-chairwoman, and style icon Diane von Furstenberg. Thank you for being here.
Thank you.
It's nice to see you.
Look how beautiful it is.
Isn't it gorgeous?
It's gorgeous.
So we got a lot to talk about. When you come here, I'm curious, when you come here, you come, to be honest, with I think a different sort of approach than a lot of the other business people who are here, who are talking about all sorts of issues in a very, very specific way. But I feel like you infuse this whole agenda oftentimes when you come with a sense of purpose. This year, you have different words every year that you like to use, words of the year. Last year you said clarity and gratitude were your words of the year. This year you said the word is manifestation and intention.
No. First you have to have the intention.
And
right?
then manifestation.
Because you have to focus on the intention in depth, so then you can manifest.
So are you bringing this message here to Davos?
No, I think what I first of all, they asked me to come here, and I'm very flattered that I spoke here. But I do love the theme, restore trust. I mean, I think it's such a major, I don't know who came up with it, but we need it so badly. And because and the two words are important. Restore means that you don't have it anymore,
right.
Otherwise you wouldn't restore it. And then trust is about truth. So I think it's a very good topic.
But as somebody who I think understands the customer, which ultimately is the public, what do you think? There is a reason to restore trust because the public doesn't trust almost anything anymore. And I wonder how that manifests itself, you think, in business, but also in life.
Well, I think that people are, yes, it's very confusing out there. You know, you talk about money all day long. You talk about currency all day long, right? Maybe we should invent the currency of kindness, the currency of trust, the currency of truth.
When you, I was going to say, the social media, and you spend a lot of time on social media, both personally, but also...
Well, you spend a lot of time reading me on social media.
I do, and I admit it.
Every time I do anything,
I put a little heart on it. The question, though, is, do you see the customer? I mean, the customer's on social media right now. And do you think that the social media...
First of all, I hate the word customer.
Okay.
It's just because it feels like a ripoff already. You know? I mean, it's the women who buy your clothes.
So the women who buy your clothes...
I don't like the word customer.
But do you think that social media is undermining the trust? That's what I was going to say. The way you used to advertise in it historically,
True.
You used to advertise in a very different way. Now you do it in this other platform.
I don't know. I think that you can only control yourself, right? I do think that over the years, I have gained trust from women. I've never lied. I've never lied in my life, so I can't be blackmailed. So I went through ups and downs and this and that, but I always share it.
I think you're right in that you can only control yourself and see what happens. When you get to a place like this and they start talking about restoring trust, I have a hard time figuring out what some of the solutions are. What do you think the solutions are?
Oh my God, the solution is look at the mountain. Look at the mountain, look how beautiful it is, and look what we're doing with it, you know? I mean, it's a little humility for, you know, the aggressiveness and the weapon and the medication and all of those things that, you know, that inspire fear.
We got to run, but I have one last question. You've been trying to empower women for a very, very long time. There seems to be a backlash happening against what are called DEI programs across the country. Some of this is related to race and gender and all sorts of things, quotas and the like. I'm so curious what you think of that. DEI being a diversity, inclusion, and equity, right? Diversity,
it sounded like drinking.
You're asking?
It sounded like drinking, like DUI.
No, but I think there's been a lot of questions just about, and we were talking about universities and hiring policies and the like, but you know, there's been a lot of efforts to put pledges in place and quotas in place, and whether you think that's a good or bad idea.
Well, I mean, you know, everybody talks about data, right? But what about impulse? What about what happens with the heart? You can't predict that. So what about coincidences? So it's great to have the data, and it's wonderful to go for justice, but I think we just need a little oil in the spinach.
I like the message. Dion, run first to work. Thank you. Thank you for being here.
You
Appreciate it.
say you don't say that in English, oil in spinach, but in French you do.
Squawk Box coming right back after this.
Tweedly, tweedly, tweet, 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 on this living love for me. Good morning. Oh my. What's this?
Safe.
Huh.
Good morning. World leaders and business titans gathering in the hills of the Swiss Alps at the World Economic Forum, and we are here live.
And all that
In this
jet
hour,
fuel
the
going to
leader of one of the
waste.
world's largest hedge funds, Ray Dalio, will join us. Plus, the CEOs of Intel, NASDAQ, and BNY Mellon will join us right here in Davos. Also, we'll get market reaction to earnings from Goldman Sachs and Morgan Stanley. Those are coming up shortly. The second hour of Squawk Box begins right now.
Good morning, and welcome back to Squawk Box here on CNBC, live from the World Economic Forum in Davos, Switzerland. You can probably figure that out. I'm Joe Kernan, along with Becky Quick and Andrew Ross Sorkin. And here are the futures this morning, which, not really a big welcome for us over here on Swiss soil this morning, but not too bad, down 125 points. It's been a little bit of a consolidation period that we've seen after that great. It wasn't really a Santa Claus rally. It started, I think,
Yes, it was.
late November, and the averages surprised everyone by the end of the year. A little back and forth so far, but I don't know if
It
anyone
was a
can
Santa Claus
figure out
rally.
what 2024 is going to bring, given the events that we're going to witness in November, which started yesterday to some extent. There's the 10-year, which is right at 4%. Take a look at oil. Oil is important, always important, but it seems to be around a trading range now between 70 and 75. And there is Bitcoin, which kind of interesting that it ran up to 49,000 on the ETF been very, very stable right here, right around 43,000. I guess people are buying it. I know BlackRock, what they bought, how many, 15,000 Bitcoin or something?
It was a big number.
So whenever there's a dip, I guess that, but I wouldn't overstate it. It's $1 trillion market cap, and if you just add up what every ETF is going to have to begin with, it's still not anywhere near. What do you think the total is that they have to buy for initial demand? Now it is on the margin because there's a lot of people. 70% will sell, but it's not like you have to buy more than 20 billion. Buy more than 30 billion.
I think it's going to take a little bit. You got to get the RIAs involved.
Does it? But
we'll
it's
see.
so stable, it could be a currency for you. You can buy a pizza with it.
We may be able to talk to one of our guests, our next guest, about this here at the World Economic Forum in the Swiss Alps. World leaders convening to imagine a path forward in today's geopolitical and economic climate. Joining us right now with his vision for what he's seeing, Ray Dalio, founder of one of the world's largest hedge funds, Bridgewater Associates, and it's great to see you on day one here. We always talk about crises, and there are a lot of crises, and a lot of folks who are involved in crises that are here, if you will. The president of Israel is going to be getting here, I believe, on Wednesday. President Zelensky, who I think you saw this morning, is here. We have Anthony Blinken, who's here trying to sort through some of these things, and the premier of China is here. And there are all of these sort of various...
What the heck is he doing over there?
And I'm curious how you think that is going to weigh, and I've been reading you on LinkedIn now, because you've been writing lots about what happens in the midst of these geopolitical crises, but how to think about the economy and
Blinken needs to stay out of everybody's life.
I think, as you know, I think there are 5 major forces that repeated through history, and those are the debt money economic force, the internal conflict force, which is the big conflict in terms of the elections and so on, the external geopolitical force, which is the struggle for the control of the world order, the climate issue. Throughout history, climate has killed more people than...
Oh, God.
Lord knows it's bigger force now.
That's bullshit.
And then, of course, technology. And so we have all of these forces coming together in 2020.
Climate change. Let me see. We had a genocide of more than 500,000 killed in Rwanda in 1 year, one term. We had 500,000 dead in Syria. Now we got 500,000 dead in Ukraine. Or more, a lot more than that. Now we got another genocide over in Israel. And then we got the Middle East on fire. But climate change has killed more people than anybody. I've been dealing with these climate change gurus ever since 1960 in the Ice Age. And now we're so far in debt because of these idiots.
The move down to 4% bond yields. And then you have the movement to in equities, particularly those countries, those companies, that they're no longer as cheap as they were before, right? So I think, let's say we start with a bond yield, start with an inflation rate, then add in a real rate. I think that the inflation rate is in the vicinity, likely to be in the vicinity of 3.5%. We have to start with that. Then you have to add in a real yield, which is between 1 and 2%. So we're talking about something when you get to a 4% bond yield, that's no longer a really attractive rate. And then if you go beyond the bond yield and you say the bond yield, of course, affects everything. And it's also going to affect what the economy is going to be like this year, right? Because we have to roll over debts and at higher interest rates and so on. So I think if you look at that particular thing, by any measures, it's not it's not cheap. Okay, none of the markets are cheap. Okay, so the pricing here is different than the environment.
The market's way overpriced. That's when I'm a little less hesitant to listen to these guys.
It's a difficult thing to play for a market participant. How do you deal with that? And so that uncertainty isn't priced in. Neither is the geopolitical. Maybe if you go to China, the prices are priced in because of the circumstances.
Okay, let me ask you then the political ramifications on the market. If President Biden wins a second term, good for the market, bad for the market. If former President Trump wins a second term, good for the market, bad for the market.
I think they're both threatening for the markets.
Both are threatening for the markets.
Okay.
So there's no alternative?
Well,
bad outcome?
Which is the better of the bad alternatives, if that's the case?
Let me say why, okay? Our big worry, I think, our biggest worry, is whether we're going to accept, whether both sides will accept the circumstances, not just the election, whether they will go with the election, but whether they will accept the decisions. Even today, we deal with the question of, does the Supreme Court rule? Is there an acceptance of those differences? Will each live the lives that the others want them to live? And we're coming into an environment where even politics is made as a political weapon, so that we're now having fights. So even if you take the extreme left and the extreme right are at risk. If we take Biden, he will not be president likely. I mean, most people will think that he may not be the strong president throughout his term. Then we're dealing with another part of the Democratic Party, and then the same.
You mean Kamala Harris?
You're saying Kamala Harris,
and a more. There is a great conflict between the left and the right,
and you're putting her in a more progressive camp.
Then that would be more progressive, and I think that you would see a more progressive Democratic Party. Okay. So now you have a more progressive Democratic Party, and you have a more progressive. Conservative, nationalistic party in which the political fight itself is an important thing. So the question is how we get through this in a way where we have sensible governance, or do we have irreconcilable differences over many things? Living standards, it's not just money, although taxes will enter into it. So the taxes that will come out of this, protectionism that comes out of it, nationalism, support for other countries, all of that will be different, but also it has to do with even how you raise your children in terms of these types of balances.
You just boil that down to an investor's point of view. If we're at higher risks for the market, no matter what happens, if either of those two candidates win, and you don't like the payment you're getting for U.S. Treasuries, what do you do?
I think the question is, do you know what your neutral position is? Like I find that the markets right now are not either super attractive or super unattractive, generally speaking, aside from the politics. And so you're going to come into this environment where there's going to be greater risk, particularly taking that factor and the world factor, right? And so then, what is your neutral position? I have a neutral portfolio, okay? My neutral portfolio is a diversified portfolio that I won't take the time to get into, but you go closer to your neutral portfolio, right?
Let me ask you another question.
A neutral portfolio doesn't emphasize cash. Is always, people think you go closer to cash. That's not right, because cash is a trashy investment over a long period of time. But what is balance? How do
Don't
you
call me
balance
trash till you slip in my
You know what
trailer.
your neutral portfolio is, and go closer to
Let me ask you a different
and then
question.
make tactical
Given how much time you spent in China, and we were mentioning earlier, the premier of China is going to be here. I don't know if you're going to have an opportunity to meet with him. But do you anticipate something happening with Taiwan, given the election that just happened in Taiwan, given that party has talked about trying to ultimately be independent of some sort? What do you think happens?
I do not. I think that there can be a demonstration of concerns that will be more cosmetic than there will be reality. There's important changes have taken place. When I was there last March, and since then, they were not on talking terms. And there was a big risk of crossing red lines. And particularly when we have elections here, which creates also more antagonism. That's changed ever since there was the build-up to the APAC agreement and so on.
Point hit my 50%
Communication now,
pullback.
it's quality communication about how to deal with such things. So that there's a likelihood there will be a delegation that will go over there. But the red line is, are we in favor of independence of Taiwan? So I think that you're going to have very careful wording by the United States that makes very clear that they are not in favor that.
But it's strategic ambiguity. It's still pretty ambiguous.
But loud and clear. The wording is going. You note the wording changes. The wording changes.
Would you agree with this? We have the greatest system of government ever since the beginning of time, the Constitution and the Bill of Rights, and there are a lot of safeguards built in. And as Churchill said, when it comes down to it, we try everything else, but we eventually do the right thing. The strength of our people, the strength of this country will prevail. And I mean, can we say that here in Davos? And not everyone else can.
I think absolutely that you can say, but you also must say, don't take that for granted.
Right.
Okay.
Right. Agreed.
Because there are things that are going on now that are threatening to that.
Right.
Okay. And we see those things.
But we've been through
No, but I
tougher
think
times,
the question
probably.
is we. Who is we? My generation,
American people,
my parents' generation, and those who went through the war and so on.
Yeah.
That was the greatest generation.
No doubt.
Well, my generation, unfortunately, got deeply in debt, broke down the infrastructure, had problems of educating
What the heck?
pervasive the population,
Right.
have poverty and so on, and a lot of issues, and can't work well with each other.
Right.
And so the question, the system is a wonderful
Now you're
system.
making me. Now we got the millennials and Generation X.
So how
they're going to be the ones that save
The
us.
question is, the system is fine. How are we going to behave with each other?
Yeah.
How are we going to behave?
Not
with
very
each other?
well.
Can we work it out?
No.
Or are we, as we're going into this environment, in a situation where, congressional committees of each other is going to do?
I don't want to live like a Democrat.
Internal or China?
Excuse me?
Bigger risk.
Coin.
Internal, United States or China?
Internal is the bigger risk.
I don't think so.
Okay.
No, I think it's China.
Okay, that's okay. We can disagree. Okay. The most important thing is that we are strong and that we work well together.
Right.
Our greatest risk is not China. Okay, our greatest risk is ourselves.
Yes,
Because
he's
if
smart.
we can pervasively, as a group of people, where most of the people benefit from that productivity, and we educate our people well, and we are strong, that is what is going to make us great.
Is that corn?
And that is what the risk is. That's
Oh,
what we're
God,
facing.
I
We
can't get
all
this
look around
right.
And we all know that.
Great, Gallia. Thank you, sir.
Thank you.
Okay.
Good message.
I hate
When we come back, the CEO of
These
BNY
kind of
Mellon.
weekends.
Plus, we're expecting earnings from Goldman Sachs and Morgan Stanley. Those results and the market reaction are straight ahead. You can see ahead of that, Goldman Sachs shares up by about 25 cents. Morgan Stanley shares up by 42 cents. Squawk Box will be right back.
Morgan Stanley's got earnings. And Goldman Sachs. What'd she say? I thought she said it was up. God, look at that run on IBM Friday. That's a 50% pullback at least. Know what I got here? Earnings, okay. Apple could be a trade today. Baidu, golly. 104. That's cheap. Oh my gosh. I think this needs to be on watch today.
Shares at BNY Mellon jumped by 4% on Friday after the bank's earnings beat estimates thanks to a surge in net interest revenue. That was what was supposed to happen. Join us now, BNY Mellon CEO Robin Vince. Obviously, if you use GAAP numbers, though, we had to replenish things, and there were some extraordinary items. But just in terms of the results, They were solid, and I think the stock reflected that.
Well, it's great to be with you. Thanks for having me. Good to be here in Davos on a sunny day. Yeah, Friday was a good day for us. And what we were trying to do was really tell the story of our focus for 2023. We made three key commitments to the market, to our investors, and we delivered or over-delivered on all of them, and we were pleased with that. The focus for 23 was around executing a pivot in our company, our clients, our real focus on running the company better, and our culture, and we think we did that.
You did it.
Interest income can help.
Good job.
100%. Absolutely.
What a bank's supposed to do.
We said that we thought we could get 20% out of the year. We were consistent with our guidance through the year. We never changed it, and we delivered 23%, so we were pleased with that.
We talked to one of your competitors, I guess, Bank of America, obviously, and
a client too.
And a client. We're past. We looked into the abyss with the mini crisis we had a year ago. We're out of that. Those were one-offs. There's not duration risk across the board in the banking industry.
I think 2023 proved something to us, which we know from history, but it was a good reminder, which is being resilient and being prepared matters. And so that was a year for that. We saw that with all of the issues around asset liability management earlier in the year. We've seen it with geopolitical risks through the course of the year. And so for us, and helping our clients navigate through those environments, that's really what it's been about.
Are your clients more willing to put money to work at this point or less, just based on what they're seeing?
So we've got a lot of uncertainties in the world, but clients have to run their businesses. And so what clients are coming to us for at BNY Mellon is our platforms and our ability to help them operate at scale. We're the world's largest custodian. We're the world's largest collateral manager. We're the world's largest securities lender. We're a $1.9 trillion asset manager.
Well, that's an issue,
so we have
man.
these platforms that we can use that take problems away from our clients and let them focus on their businesses.
The return to work. We've heard some other companies that say, be here or you're gone. You took a different tack, did you not?
Well, we took a slightly different tack. What we prize, and we think our people prize, and this is part of our focus on culture at the firm, is being able to be flexible. So yes, we have asked our people to come back to the office, but we haven't required them to come back 5 days a week. We've required 3 days plus. And I think there's a little bit of give and take with our people, which has been very valuable. Last year, we made everyone in the company a shareholder of the company with our BK Shares program. That's around sharing and participation so we can talk about ownership. We launched a premium free healthcare offering for our lowest paid employees. We launched additional mental health benefits. We were talking before we came on the air about our December recharge, where we gave 2 weeks free of the bureaucracy of running a company. So that's the give and take, but we ask a lot of our people. We're asking them to really drive forward for our clients. We're asking them to help run the company better, and we're really focused on our culture as part of enabling that.
Very good. Thank you, Robin. Vince, BNY Mellon. Very good to have you here in Davos.
Good to be with you. Thank you.
And, coming up, NASDAQ CEO Adena Friedman. Squawk Box will be right back.
That sounds like a great place to work.
This sounds like a great place to work. Boeing. I got 208, and I got these two supports right here for Boeing. So let's see. I still think there's probably going to be a little bit more selling pressure. Now these goons tried to pump this when this news first came out, and it wasn't a very bright idea. I mean, this is a 3-month-old plane, and they subcontract all their everything, their fuselages, and just kind of like an assembly plant. They don't. I think they've outsourced too much. So we gotta wait. I'm gonna wait. Now Dow, they're pumping Dow, and it had a good pullback. Some people just have the basic instinct of knowing when something's overpriced and not. I don't think Boeing was overpriced, but I think they're overpumping it. I watched it when they first came out on Monday. Oh, well, they brought all their investors out and said, oh, we're still holding. We don't see much of a problem. They'll be out back in the air in a week. Now it's indefinitely.
Big tech IPOs have remained dormant for the last couple of years, but it looks like it could recover some as borrowing costs come down and equity markets become less volatile. Joining us right now is Adina Friedman. She is the chair and the CEO of NASDAQ. And Adina, thank you for being with us here.
Oh, God.
It's great to be here. Let's talk a little bit about the IPO market, because there are some thoughts that maybe things are loosening up and maybe we're going to see a very different year.
Yeah, I think that there's the potential for that. I think that the economy continues to need to show resilience, which it has been, and I think that that's giving a lot of people more confidence on the back of the fact that inflation's coming down, so the Fed hopefully will feel like they can ease off the rate environment over the, as we go through
We
the
opened
year.
up right at my
Unclear
first
as to when.
support.
But even the promise of that, or at least the expectation of that, I think gives investors more confidence in being able to underwrite risk. So we are seeing some really interesting companies looking to go out as early as this quarter, but a lot more in the second quarter.
Peter Orszag was here earlier this morning, and he said that he thinks the market has it wrong right now, and you're not going to see any rate cuts until at least the very end of 2024. If that's the case, do you think that would put a freeze on things?
I think I'm not really expecting it to be very early in the year, personally. I think that the Fed needs to see the inflation environments come down and stabilize, be stable at a lower level. And it's likely that the
It's just
decline
funny
will
how
diminish,
everybody has
so
a
meaning it's
different
gonna
tune
get harder
now.
and harder to continue to bring it down. But if they feel like they can show that stability, then they might take
You know what
one
I
action
said?
or two actions as we go through the year, and maybe more. But I'm
This is
not,
what I said.
I'm not thinking that it's going to happen in like the first or second quarter so much.
You've been the CEO at the NASDAQ since 2017?
Yes.
So
This is what I said. 2 words. Double top. Pulling back to the 9. Maybe pull back to the 457 area. And I'm going to load the boat. 450, 460. That's what I said. Now it's been 3 weeks of the market overpriced 6 rate cuts.
A conversation here years ago when you
We'll be
announced
back.
that any company that was going to go public on the exchange on NASDAQ was going to have to disclose, there was going to be a transparency around diversity on the board and the like. There is now a massive pushback on that very idea of DEI that's taking place all over the country. And by the way, it's relating also to other issues. And there's a backlash against climate investments and the like as well. But what do you think of that? And how much do you hear about that now?
First of all, we actually continue to work with companies on managing their ESG requirements and reporting requirements, and that there's still a lot of demand for that. It's still a very complicated world in terms of satisfying investor interests. When it comes to the board disclosure rule, that really was investor demand driven over many years, actually, of asking, can you please provide us a more standard way for us to evaluate board diversity? So we did put that rule in place. We introduced it in 2020, implemented in 2021. And our companies are complying, and it's really a very simple, straightforward disclosure rule at this point.
But what do you make of the larger sort of sea change in terms of sentiment around DEI programs in the country and pledges and quotas and all of it?
So my view is that you always have to look at how you're making decisions for the long term as a CEO. How do you create a culture that, celebrates the differences, celebrates diversity, brings, creates inclusion, so that people, and then you go out and look for a diverse set of candidates so that you kind of naturally raise the inclusiveness of your company and the diversity of your company. I think my personal view is you take a long-term view on it and you make sure that those programs last through any political cycle, and you kind of focus on it over the long term as opposed to trying to manage to a political cycle. So that's the approach we've taken at NASA.
We had Julie Sweet, Accenture on. And you have the same issue. You would like to attract all the new AI companies, I'm sure, to the NASDAQ, but you need to be an AI company yourself, running the NASDAQ.
Yeah,
it's daunting, isn't it?
Well, we now are, as you know, a pretty scaled technology provider to the industry. So
you had to do it already with security and everything else. You're in the business, and you want companies that do that to be.
That's right. Yeah. It's kind of this nice flywheel effect, right? So if we can show that we're an innovator, we can attract innovators. We also believe that innovation's absolutely critical to solving some of the biggest problems the financial industry faces. So we have been leaning very much into AI for a long time, actually, across the markets, but also in the anti-fin crime suite that we have, and making sure that we leverage the data. That if you bring data together and you carry collective action on that data, you use AI algorithms to root out specific criminal behaviors, you're going to be much more effective in solving that problem.
You let us broadcast from the NASDAQ. You give us our view. This is our view here.
It's a beautiful view, I have to say.
When we're at the NASDAQ, at your view, we have a floor-to-ceiling window of Times Square.
Yeah,
it's a
little different. It's a little different.
I think there's beauty in both.
That's the way to look at it, Joe.
I think that
it's a different. I mean,
the canyons of Times Square.
The urban beauty. It's called urban beauty. There we go.
Has its, in all beauty, if you look closely, has flaws.
I would agree with that.
Okay. Yeah. But do you have a preference? It might be nicer here.
This is actually pretty, but it's a little chilly. A little chilly.
Adina, thank you very much for joining us.
Thanks very much.
Oh, let's get to Leslie Picker now with some quarterly results from Goldman Sachs. Do that for us, would you, Leslie?
Hi, Joe. I am happy to. Goldman reporting $11.32 billion in the fourth quarter for the top line, with $5.48 on the bottom line. The firm had a number of items in the quarter, including markdowns related to the Green Sky portfolio, which is held for sale, essentially an accounting technique there, as well as the $529 million FDIC special assessment to cover the shortfall from last year's bank failures. They moved the GM card to available for sale, reflecting that process that they've started there. That's, again, an accounting impact added to pre-tax earnings, as did the sale of its personal financial management business. Taken together, though, these and other items knocked about 83 cents per share off of EPS. In terms of the individual businesses, Global Banking and Markets saw a dip in the quarter with net revenue down 3%, and that was a bit lighter than consensus. M&A advisory dipped 29% with fewer completed deals in the quarter, although Goldman says its quarterly backlog increased sequentially. Asset and Wealth Management was a beat with growth of 23% in the quarter, and the firm reported record management fees of $9.5 billion on record AUS, assets under supervision, of $2.8 trillion. Its smallest division, Platform Solutions, was up due to the average growth in credit card balances. Morgan Stanley also reporting this morning, market responding positively here. Fourth quarter net revenue of $12.9 billion and 85 cents per share in EPS. Firm also took some special charges in the quarter, $535 million. About half of that was for the FDIC, half for a legal charge. Here we saw investment banking revenue up 5% from a year ago, while equity and fixed income trading revenues were basically little changed in the quarter. Wealth management also little changed from a year ago. Becky.
Leslie, thank you very much. Again, watching that stock right now, you can see it's up by about 40 cents. When we come back, we've got Intel CEO Pat Gelsinger. And be sure to follow Squawk Pod for special episodes all week featuring the best of our Davos conversations in audio form. We're going to be publishing multiple episodes of Squawk Pod reports, Davos each day. Hit that follow or subscribe button on your favorite podcast app, and you can listen anytime. We'll be right back.
What are you waiting for?
Welcome back to Squawk Box. We are live at the World Economic Forum in Davos, Switzerland. Take a look at futures this morning ahead of the market open. Still got some time to go, but the Dow looks like it would open down about 115 points. S&P 500 off about 20 points, and the NASDAQ off about 83 points. Meantime, a headline to bring you this morning: Apple will be dropping blood oxygen features on its smartwatches that have been banned from being sold in the United States. Apple and the U.S. Customs Bureau haven't commented, but reports say that Massimo, company which claims Apple infringed on its patent, says the feature will be now going away. Apple pulled the devices before the sales ban went on into effect last month, but then won a temporary reprieve in court. Bloomberg reporting modified watches have been shipped to stores but won't be sold until the government officially approves the changes. So we're going to keep our eyes on that story.
In the meantime, Microsoft is offering its Copilot AI virtual assistant to small businesses. Consumers can also sign up for a paid version for $20 a month. Those moves will help Microsoft expose more customers to generated by AI, which has exploded since ChatGPT came onto the market last year. The paid version will let people use Copilot in Word, Excel, Outlook, and other apps.
Up 63% in the last year. And we started with Apple and Microsoft. If there's two horses, not of the apocalypse, but those are the two most important stocks by far.
63% on an incredibly large base before it started.
That's the thing. And now the most valuable company on the planet. Uber is reportedly shutting down Drizzly. That's the alcohol delivery service it bought for more than $1 billion 3 years ago. Drizzly provided technology to let local liquor stores provide deliveries of alcohol instead of hiring its own workers. The delivery service suffered a data breach in 2020, exposing information on 2.5 million customers, and that led to an order from the FTC restricting the type of data that Drizzly could collect. Shares of Uber, which we'll take a quick look, are actually off down about 0.8%. Tomorrow, right here on Squawk Box, CEO Dara Khosrowshahi will be our guest. That'll be in the 8 o'clock Eastern hour or 2 o'clock hour for us.
Did you notice the gain 1 year up 112%
for Uber?
Yeah.
Yep.
Smaller base, but still, that's an impressive showing.
It's starting to work. It's working.
No doubt. When I have I got it, and I do it. Now I use it. I do it.
Does that mean jumping the shark?
Yes. No. Hopefully.
It's way to you.
That's like being on the cover of the Business Week. It's the end. Coming up, Intel CEO Pat Gelsinger is going to be our special guest right here from the World Economic Forum in Davos, Switzerland. And then in the next hour, another great lineup of guests, including the CEO of Palo Alto Networks, Chevron CEO Mike Wirth, and the CEO of Qualcomm. We'll be right back.
Coming up next, the CEO of Intel joining us live right here at the World Economic Forum. And then later today, right here in Davos, I'm going to be bringing you an exclusive interview with the Secretary of State, Antony Blinken. Coming up later this morning. That's going to happen at 10 a.m. And we'll have highlights from that conversation tomorrow right here, of course, on Squawk Box. Back in a minute.
By Buzz today.
Let's check on Goldman Sachs and Morgan Stanley. Both reported earlier. Goldman reporting $11.32 billion in fourth quarter revenue with $5.48 on the bottom line. Both those numbers above expectations. And the firm did have a number of items in the quarter, including markdowns related to the Green Sky portfolio, I assume, unless it's Green Ski. Green Sky.
Green Sky. Green Sky.
CEO David Solomon is going to join us tomorrow. And Morgan Stanley reporting.
Blue skies here, though.
We do. Yeah, blue skies ahead, hopefully, in 2024. Reporting fourth quarter net revenue of $12.9 billion, 85 cents a share. The firm also took some charges in the quarter, $535 million, about half of which was for the FDIC. We've been talking about that after that little mini crisis we had a year ago, also for a legal charge. And Morgan Stanley CEO Ted Pick is going to join us on Thursday.
Intel stock jumping 12% in December after the company announced a new line of AI chips. And joining us right now is Pat Gelsinger. He is the CEO of Intel. And Pat, welcome.
Hey, thanks for being here. What a great honor to be on the show with you.
Well, it is wonderful to have you here. I want to talk about your stock and the things that are driving its performance. We just mentioned what happened in December. You had an impressive year. The stock was up about 60%. And it was because of two big things that were pushing it. One, I think, is this idea that chip sales are going to increase as you see an increase in PC sales, hopefully. The second is just this idea of the foundries that you're building and what that's going to mean too, with AI kind of built into the like. So let's break it all down. First of all, PC sales have been down for 8 quarters in a row. What's going to turn the tide there, and when does that happen?
Yeah, I think this year, people, I think, expect it to start a little slow, but accelerate as we go through the year, because you're hitting a natural refresh cycle. You're 4 years after COVID, so that's normal, a 4-year cycle. but there's also a Windows new operating system coming out, end of life of older one. Again, that's always a positive. But the big thing for us is AI PC, right? And I've described it like Centrino. And if you go back in time, we had created Wi-Fi. I helped to create Wi-Fi. And sort of nothing happened for a couple of years. And then we launched the Centrino platform, and all of a sudden, if you were a coffee shop, you had to have Wi-Fi. If you were a hotel, a business, and it changed the PC. You went from Excel as your key application to the browser, right, and the internet and connectivity, and changed the form factor and use cases. And we think of that like the AI PC. Right, it's going to drive new applications, new experiences, new form factors, and I believe there's a budding excitement for what that's going to do to the PC category starting this year, but continuing into the next couple of years. And obviously, we announced Core Ultra, our AI PC flagship product. As the starting gun has now sounded. We are off.
All right, let's talk about the foundries side of things too, because this has been a really exciting story. You guys are making plans. You're in the works with some of these factories that you're building, not only in the U.S., but in other places too. But this is a long story that plays out over a long period of time. You just announced that you're going to be expanding a plant in Israel to the tune of about $25 billion after that country said that the government there would give you, I think, $3.2 billion in subsidies for that. So is this just an indication that you're going to go where your capital is treated best?
Overall, I guess there's three things to tease apart there a little bit. And I think part of the optimism in the stock for Intel has been we're getting the process technology back. We said 5 nodes, 4 years, this audacious plan to get back to leadership. And as it's coming to life, people who might have been skeptics are saying, wow, they're making it happen. And I think with that, it's sort of like the products get better, but the foundry opportunity.
Where are you in the 4-year cycle?
Well, in the 4-year cycle, we're a little bit over halfway, and we've delivered 2 of those are done. We're going to production with a third of those 5 in the first half of the year, and the other 2 by the end of the year. So we're on track for something that people said, wow, they can't do this, and we're proving them wrong and building momentum. But then that says, oh, foundry customers, hey, they want to start taking advantage of that process technology for that. And we're starting to have more momentum of those customers saying, we might have only designed on some of today's foundries in Asia, TSMC, Samsung, Global Foundries, but now Intel with leadership process technology, we're interested because we want balanced, resilient supply chains, but then says, where are the factories? And that's the third part of that story is the factories are coming along. The big ones in the U.S., Arizona, New Mexico, Oregon, and Ohio, the big project. And here in Europe, we have Ireland, the Magdeburg factory, or Poland assembly test, and the recently described Israel expansion. So overall, we say we're the only company in the world that has major supply chains for all 3 areas, the Americas, for the Europeans, and for Asia. That's a unique capacity, and people say, it's an uncertain world. I need resilience in the most critical element of the supply chain, my semiconductors.
Can we talk about national security issues as they relate to chips? Premier of China is here in town. Lots of questions about what can be exported or should be exported to China. There's a whole question about throttling chips, whether the folks in China want to buy throttled chips. What is your position on all of this?
Well, we've consistently taken the view that the best way to think about this is the U.S. and the Western companies maximize exports. We want, if I'm going to build lots of factories and be able to fund R&D, I need access to the global market. So let us sell chips globally. Manage consistent with your industrial policy where you want technologies to be. Right? Not the products. Sell the products everywhere you can. Give as much market access in the global community, and the biggest market is U.S.
But the idea of limiting sales of certain speed chips to China puts us in a good position, a bad position. How far back do you think China really is? I mean, I think a lot of people saw those Huawei phones last fall, last summer, and were surprised at how fast the chips inside them actually were.
Well, part of that's how much technology access they have, particularly in equipment area, and that's where the partnership between U.S., Europe, and Japan, where do we want the technologies, the equipment to go? The idea of limiting the highest performance chips, this has been going on for almost 50 years in high performance computing. I think what's been surprising is the inconsistency or the changes in those policies over a short period of time, making it impossible for any of us, right, to adjust our businesses and products to meet an ever-changing policy environment. set the policies consistent with industrial policy, let us run our business against them. And of course, then, you know, the question, as you say, is, okay, where should the lines be drawn, right, associated with it?
President Biden is very tactful in talking about the Taiwan elections over the weekend. I would imagine you'd be very tactful as well if you were to comment on things like that. You have to be very careful on what you say. But what would you say? And there are some people that think there's only one option left at this point for President Xi, and it's only a matter of time.
Well, I think President Xi's been declarative. You know, this is part of China, right? It's a critical role in the supply chain. And, you know, I think the elections sort of say things are probably status quo, which I think is good for the world. Taiwan is a tech hub.
It's a staunch, independent, right? The new president staunchly
but a balanced legislator. Balanced legislation that probably keeps a reasonable balance to the view of the policies.
So you don't think anything happens in 1 year, 2 years, 5 years? How long?
I believe there's great risk here by any area of the world being a disproportionate portion of the supply chain for something so critical. And that's the essence of
how much time do we have? How quickly do we get to a point where we are chip independent, if you will? What does chip independence mean?
Is that the end of your 4-year cycle?
You know, what we've said when we started this journey, the U.S. CHIPS Act, the EU CHIPS Act, was get to 50-50 by the end of the decade.
Meaning 50% of the chips being manufactured in the United States?
In the U.S. and in Europe.
Is that all chips or just the important chips?
Particularly the leading edge chips, right, as we move forward. And today, that's less than 20%. So that's a huge shift in the policy. And if we get to 50-50, the world will be a pretty happy place in comparison to the fragility of where we are today.
The CHIPS Act was passed in 2022. It has seemed like that money has been doled out in dribs and drabs. What do you think of how quickly or not quickly that money is getting out?
We're anxious to get it done in that sense. And, you know, the Department of Commerce, you know, they were somewhat, you know, they caught the bus. Right, they had never managed something of this scale. You know, this is new industrial policy muscle for them to build. So on the one hand, hey, I'm empathetic of what they had to stand up, but hey, I'm building factories today. You know, get the monies dispensed rapidly. We're working closely with the Department of Commerce to move this forward because the faster we move, the sooner we get to a more balanced supply chain.
Andrew, go ahead.
The other piece of this I was going to ask is, this is maybe a geopolitical or policy question. Do you think if we get to the 50-50 piece in 2030, that makes it easier for the United States if China decides that they want to take over Taiwan? Do you think the U.S. says, okay, actually, you're no longer strategically as important as you used to be, therefore we're actually willing to let this happen? Or does it actually strengthen the hand of the United States to say, actually, we really want to protect you because of the democracy piece of it and the independence piece of it?
Well, you know, the geopolitics, hey, I'm not a politician.
But you've spent a lot of time now with these leaders talking about this.
Like one on that answer about China.
Yeah, thank you, Joe. You know, the thing is, if you have a more balanced supply chain, everybody can make better policy, right? If you have unique, harsh dependencies, then small things must become big things. And in this regard, I think everybody can sleep a lot easier if, in fact, we have more balanced supply chains. You know, we have fewer choke points. You know, fewer ports, fewer islands, fewer places in the world with choke points. And that's what we're trying to achieve. And build a much better economy and national security for the U.S.
So everybody in the U.S. can sleep better, not necessarily everybody in Taiwan.
This is the creation of major jobs, you know, construction of factories, rebuilding the heartland of America, and having more control over national security. This is the right policy for the world.
I've read about there being a shortage of construction workers in Ohio. How big of a problem is that right now, just in terms of how fast you want to move?
It's a challenge. That said, you know, we're managing through it, we're navigating through it. You know, when there's worker shortages, people sort of say, give me a few more bucks and I'll start showing up. So, you know, we're having to manage it, but the balance of cost, schedule, and available talent, you know, we're getting through it, and we've been thrilled by the warm reception that we have in Ohio.
Do we need to expand the visa program, or do we need to start teaching more math to our kids? I mean, sooner or later, it's going to be a bottleneck, and it's going to be hard to get engineers, is it not?
Well, I have 3 policy objectives before I leave this job, Joe. You know, one is CHIPS 1 and probably CHIPS 2, getting industrial policy done. You know, number 2 is long-term R&D, right? Build the seed corn for the long term. and the third is immigration policy. You know, every high ed degree should come stamped with a green card to go with it. We need this talent, you know, and you know,
do we not have it here, Pat? That's what I mean. Do we need more STEM?
We need more STEM. You know, we need more technicians. You know, we need more capacity for, you know, think about how many of our companies are led by immigrants today. You know, they come to the country well educated, the top of their class, and hungry for the opportunities, you know, that the West offers them.
Right.
And I think we should just say, if the world wants to give us their best and their brightest, we should say, yes, please.
Pat, thank you very much for joining us. Pat Gelsinger.
Thank you so much.
And up next, from the World Economic Forum in Davos, the CEOs of Palo Alto Networks, a guy named Nikesh Arora, also Chevron and Qualcomm, plus so much more. Big hour ahead, so don't go anywhere. Here are the futures. Kind of the opening bell on Wall Street. The ball's tonight, I think. We'll be right back. The CNBC ball.
Good morning. It is cold in Davos at the World Economic Forum, but we've got a hot lineup of guests in just the next 60 minutes, and you don't want to miss any of them. General Atlantic's Bill Ford, Palo Alto Networks CEO Nikesh Arora, Jim Breyer from Breyer Capital, and the CEOs of Chevron and Qualcomm. Don't go anywhere as the final hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box here on CNBC. We are live from the World Economic Forum here in Davos, Switzerland. You knew it was coming up. We've been thinking about it for, how long have we been thinking about it? I think since last Davos. I'm Joe Kernan along with Becky Quick and Andrew Ross Sorkin. Something always happens here. Either we're too negative and it's a great year, or we're too positive and we get a pandemic. Do you remember? Paul Tudor Jones was sitting right there, said, I don't know, there's a respiratory virus in China right
January of 2020.
January of 2020. And Trump came on and said not to worry. U.S. equity futures, but who could have known at that point? We've been through bird flu and so many different scares, but that one came to pass, unfortunately. U.S. equity futures are down, but down much less than when we began this morning. Now, about 60 points, NASDAQ down 57 or so. And Treasuries, not a lot to take home from this today, 4%. That's all you need to know on the 10-year, right around there. Goldman Sachs and Morgan Stanley reporting quarterly numbers last hour, both rising slightly. Goldman CEO David Solomon is going to join us tomorrow. And Morgan Stanley CEO Ted Pick is going to join us on Thursday.
Meantime, following reports last month, the private equity group General Atlantic confidentially filing for an IPO. The firm now making a big acquisition move with a new acquisition today, just announced. It's buying infrastructure fund manager Actis, which has a big presence in sustainable infrastructure. Joining us right now here on CNBC, William Ford, General Atlantic CEO. Good morning to you.
Great. Good morning, Andrew.
So this is apparently part of a trend. We were just talking to Larry Fink back in New York on Friday, getting in on the Infrastructure Act. What led to this? What's the thought process behind this deal?
Well, we've known Actis for many years. They're a terrific firm focused on sustainable infrastructure, and we've concluded for a while that the next big investment opportunity is going to be energy transition. And they've distinguished themselves by focusing on developing sustainable infrastructure like power, like solar and wind in the emerging markets. And that's what really attracted us to them.
So one of the things we've been talking a lot about in terms of sustainable infrastructure is both the need for it, and maybe it's a chicken and egg situation. But, you know, we've seen these reports even last week about EVs in the United States, just the pickup, the take-up by consumers, not nearly as fast as people think. Some people say that's a function of the fact that the infrastructure doesn't exist. Others say that there just really isn't a demand for this product and that it's being pushed on them.
Well, I think what's going on behind the scenes is much more significant. Last year, the volume of renewable capacity put online grew by 50% to 510 gigawatts globally. So it is a growth market and continues to grow significantly, both in developed markets and emerging markets. So I think while the demand for EVs might wax and wane, the demand for power is growing.
How much of that is a function of governments continuing to spend on that investment? Because most of that is government generated. And we've talked to a lot of people here who say they're watching the November 2024 U.S. elections very closely for what it's going to mean not only for markets but other countries too.
I think, Becky, that's been a tailwind. But if you look at the fundamental demand, take emerging markets, Asia, Africa, Latin America, the demand for power grows at 2x GDP. These countries are growing rapidly. They need more power. It's either going to be renewables or it's going to be traditional carbon-based energy. And the hope for the world is that it's renewables. And so I think the demand is there. And what's needed is, you know, $1 trillion of capital flowing in to put this capacity.
Money's going to flow downhill to coal. You know that. We've had 20 years of investments in what you're talking about, and you haven't moved the needle. It's like 83.4 fossil fuels. It used to be 83.5 makeup of the world. So you're looking for some type of inflection point when things change, because it hasn't changed yet.
I think, Joe, it's a fair point, but I think this is a disruption. I think this transition is going to pick up momentum over the next decade.
You don't see India and China, they're building a coal plant every day.
They are, but actually the biggest increase in solar capacity in the world was China last year. Of that 510 gigawatts.
On the margin, though, Bill,
it's still marginal. Look, we're not going to be transitioning from carbon-based energy in the next 5 years.
Is part of your investment thesis that you're going to continue to see the government? I'm not saying you know, they're investing in dollars that the private sector. Well, I am saying that they're going to invest in things that wouldn't happen in a free market system, and so you're going to take advantage of that.
In this case, Joe, it's not subsidy driven. It really is about fundamental demand.
Well, we know there's demand, but it's just not necessarily demand for expensive solar and wind. It's demand for
power.
Right. For power.
Yeah, and that's going to grow. Take data centers, for example. I mean, data centers today use about 60 gigawatts of power to fuel them. With AI, it's going to be 10 times that number in the next decade. Yeah. Where's that going to come from? Yeah, some will come from traditional carbon-based energy, but a lot of these data centers are being powered by green energy.
Right.
And that's what we want to get behind.
I want to pivot the conversation to both your firm, but also want to talk China first, if we could. You're a big investor in ByteDance, owner of TikTok, controversial. You're a board member. Shein as well, a retailer that's been taking off. Lots of questions about that firm as well. Have you got a chance to spend any time with the Premier of China who's here yet?
I know you spoke this morning. I have not seen him yet.
Okay. What is your sense, though, of the relationship between the U.S. and China, given what's just happened with the election in Taiwan? And
How does it relate to your role, and how do you feel about being a board member on ByteDance these days, given that your company is oftentimes being described as a national security threat?
Well, I think China had a difficult post-COVID environment. A lot of us sitting here a year ago thought China was going to have a very strong economic growth and have their own post-COVID rebound. That didn't happen. It was a challenging year, and problems in the property market and municipal finance came to the fore. But I think the government is getting a lot more focused on driving economic growth in China and improving things. So I think we've seen the bottom in terms of economic performance in China, and it should improve this year.
What about the whole ByteDance piece of it?
Well, ByteDance is a terrific company. It continues to perform well. It is a global internet company with 2 billion users worldwide, half in China, half outside of China. It's a company that aspires to go public at some point in time.
Right.
When the time is right, we'll execute that.
Well, so let me ask you two different questions. One is we saw the rise of anti-Semitism on TikTok this fall. You saw that. I don't know how as a board member, you feel about that. I'm also curious how you feel about the fact that in China, TikTok is really limited, or the version of TikTok in China is uniquely limited, in large part because of what they think it may do to kids and other things in terms of what that looks like, versus the version that is exported, if you will, to the rest of the world.
Well, let me just clarify a couple of things. First of all the content that exists inside of China has always been separated from the content from TikTok. It's never been merged together. The user bases have been separate. The content bases have always been separate. The data has been protected separately. So it's never been a case that they've been merged together. And what we have done in response to your first question is we've doubled down on content moderation, which is basically trying to screen out negative content related to hate, violence, in any kind. And we've always been deeply committed to that, but we doubled down over the last year.
Now, the reason I asked you, Alex Karp, who we're going to have on tomorrow from Palantir, he's literally made the argument that he believes that ByteDance and the TikTok itself is an export to literally control the minds of kids in the United States, not because of propaganda, but just basically to make us dumber, frankly, and because we're all addicted to it and spending all this time on it. And he says, look how they do it in the United States and look how they're doing it in China, and what does that say about what's really happening here?
I don't agree. I mean, the content is user-generated. It's moderated to screen out the bad stuff, and it's generally as much educational and entertainment-oriented as it is, mindless, as you might say.
So if we're making everybody dumber, it's our own fault for the garbage we're putting into it?
I think there's a lot of great content on TikTok, too. There's a lot of
wonderful things. Do you limit your kids on it?
I do.
Screen time?
I do. Well, my kids are older, so
Do you limit your own screen? I find it addictive myself. I literally have a screen time, timeout thing on it for myself, and then I, of course, blow through it.
I get stuck in 100 emails that I got to return, so I don't even know as much time as I'd like to have.
Diane Furstenberg's Twitter account. You get cut off, right? You've been on there for like
too much. Let me ask you. You filed confidentially for an IPO. What does that say about what you want to do with the firm? But what does it also say about where you think this IPO market is going to be this year?
Well, I think that's a more interesting question about where is the IPO market. It's been a tough 2 years for IPOs, as you guys have reported a number of times. But I'm pretty constructive on it now. If you look what's going on, the volatility is at a reasonable level. Equity market performance has been good, particularly starting in the fourth quarter. Interest rate increases appear to be off the table. That was a real headwind to the IPO market. I think that's all improving right now, and I wouldn't be surprised if we see the IPO market open up even in Q2 and have a much more active 2024. There's a lot of companies that are ready to go public that are high quality, high growth. There's also a lot of private equity portfolios that companies.
Does that require the Fed to lower interest rates?
Not really. I don't think so. I think what it needs is you need reasonable levels of volatility, which we have right now, and you need positive equity market performance. With those two factors and $7 trillion sitting on the sidelines, I think you can have a very active IPO market.
Bill Ford, thank you for coming in this morning.
Great.
Richard, great to see you. Thank you so much. Thank you.
Okay.
All right, when we come back, we've got some more news-making interviews, including a can't-miss conversation with Chevron's Michael Worth. Next, though, we're going to talk cybersecurity with the CEO of Palo Alto Networks. Stay tuned. You are watching Squawk Box right here on CNBC, and we are live from the World Economic Forum in Davos, Switzerland.
welcome back to a topic that's on every CEO's mind here in Davos, cybersecurity and how to protect employees and assets. Join us now is Nikesh Arora, CEO of cybersecurity, a giant Palo Alto. It is giant now, Palo Alto Networks, giant in market cap and everything else. Congrats, 4 years with stocks up since you came on 4 times.
4.5, but who's counting?
4.5, but who's counting? I mentioned earlier, you know, I love reading about molecular genetics, but I read about cybersecurity combined with AI, and I am left in a bit of a daze. But these are daunting times. The times that the opportunity is like it's never been in the past, I would imagine.
Yeah, I think part of what is, Joe, if you look around you everywhere, everybody wants to deploy more and more technology into the enterprise. And the more technology you want to deploy, the more you're going to take a look at data, the more AI you want to do, the more data you're going to take and analyze. And in that process, you're going to leave a lot of doors open for bad actors to come and access your technology. If you look last year, billions of dollars were paid in ransomware, and we saw very few convictions. So if you're in the bad business, this is a good bad business to be in because there's a lot less people getting caught. So you were seeing that, you know, the economic incentive is there for bad actors to get into these doors that are left open by companies who don't secure themselves well enough.
There are new technologies in what you do, and you've made acquisitions, bringing in companies that either augment or to somehow synergize your own offerings. Which ones have you done recently? I read about them, but I didn't understand exactly what I was reading.
I think if you look at a macro level, Joe, 5 years ago, the trend in our industry was you came up with something new, something cool, you sold it to a lot of people, you became a hot cybersecurity stock, and then somebody else showed up because the bad actors moved on to something else. So in history, we've never had a cybersecurity company that has persisted or been evergreen. So the strategy we took on 5 years ago was that we want to be there where every trend shows up. We'll be there early. If we can't build it, we'll buy it.
That sounds like a big pharma company.
I hope not. The difference is in pharma companies, you're solving very specific problems. You know, it's like you've solved
but they
cancer.
buy their pipeline.
They do, but you know, they solve
innovation.
cancer. There are people who have cancer. They don't necessarily have something wrong with their eyes. So you don't need a medicine that works in Alzheimer's and a Parkinson's and cancer.
But so how do you think about an R&D budget versus an acquisition budget, effectively?
So we've been pretty consistent, being able to spend about $500 million to $1 billion a year, in addition to about 12 to 14% of our spend being in R&D. So that seems to be the right balance. And every year there's about 2,000 companies that get funded in the cybersecurity space. So it's an amazing innovation farm. You can go out and look at them.
Do you fear, though, that over time, and the bigger you get and the better this works, that the government says, well, look, we can't have you buying all these companies. It's too much.
Well, I think
most of the things you bought are small enough that they're not
$2 to $500 million.
Right. They're not hitting Washington. But at some point, does Washington start to look at this and say,
I think the question is, are we creating a better outcome for our customers or not? Are we helping customers secure themselves? Or are we going to end up in this chaos where customers are going to get breached and lots of money will be lost? So I think from that perspective, if we can take a deployed customer and add another feature to it by acquiring a company, that's a much better outcome for customers. We're not destroying competition. We're not making it hard for anybody else. We're just making sure that the needs of the customer, needs of the moment are met.
So we started talking about AI. Is AI going to help you design security products for customers, or do you need, because of the proliferation of AI, do they need now more cybersecurity because of AI?
Yes and yes. Yes and yes. Sorry. I mean, literally, I just walked out of a meeting with 100 CEOs sitting there talking about how do we interpret generative AI and how do we make sure we can use it in our business. This is the fastest any technology trend has taken off. I can't remember any other time where last year we weren't talking about generative AI at Davos, and today everybody's talking only about generative AI. So everybody's got religion. They all want to figure out a way of leveraging AI in their business. Now, the moment you do that, you're going to be sharing your company's data, your customers' data with some LLM out there. Everybody's trying to grapple with
large language model for those uninitiated.
Yes. Sorry, we talk about this so often.
I know.
Yes,
letters.
yes,
Yeah,
yes.
I know.
And everybody's trying to have figure out how to make sure this data stays secure. It doesn't get in the wrong hands. It doesn't. You don't have bad LLMs out there that are large language models that are trained on bad data and get bad outcomes.
But there is this tension between trying to protect your customers' data and trying to make sure you are making the quickest advances possible with AI. We've watched that play out with OpenAI and Microsoft.
Yes.
How do you balance that?
You know, that's a great question. I think it's much easier for startups to go out because they have nothing to lose.
Yeah.
But if you take a large pharma company and they put all their intellectual property into a large language model and train it to figure out the next medicine, What if that model is open and somebody else starts training the same model? Suddenly your IP has been
Compromised and given away.
exactly. Yeah. So that's why large companies with lots of data have to be more careful in trying to introduce this new technology compared to startups with nothing to lose.
Cash, you and your CFO both said that market participants need to distinguish between billings and what was the other RPOs,
yes.
revenues,
Remaining performance obligations.
Okay, so initially the market looked and said billings are not what they're not up to snuff. I think that your CFO said, well, interest rates went up, so customers are not using the same purchasing.
That's right.
I guess schedule that they would with lower rates. So what you really need to look at are RPO, so our billings are fine. Can you just explain that?
We're going to get into a technical discussion?
I don't know. It was technical enough.
It's very easy. You know, if you buy this cup, you get revenue. You pay for it, that's revenue, right? Now in our business, we say, I promise to serve you for the next 3 years, right? The customer signs a contract, I promise to serve the next 3 years. That promise is called a remaining performance obligation.
I just remember GE with their power generation business. You remember that, Andrew? They had some kind of weird way of accounting for it. But it's all
legit. It's all perfectly fine. Everybody does it like that. The only distinction is you can only bill what you invoice. So if I don't invoice you for 3 years right now, it's not billing. It's a future obligation.
And now rates have come back down, so billings are going back. Everything.
So people don't want to pay you up front anymore because I can make 5%
so growth
of the bank.
is just as robust as you had forecasted.
I think growth is robust. I think cybersecurity will be a theme for a while. I think the more we get technologically dependent as a society, the more cybersecurity.
How much do the big software, the Microsofts of the world, represent a competitor to you? Because over time, one of the things that they're trying to do is increasingly integrate their own technology and their own security into these operating systems and the like.
Yes.
Should they be? Should they not be? And by the way, there's a potential case in, well, there's a case against Google, there's cases against Microsoft, there may be a case against Apple about their integration of various things. If the DOJ called you and said, should these OSs have security in them, would you say
operating systems?
Operating systems, thank you. Should these operating systems have security built into them? You would say what?
Look, there's two-part answer to that. One is yes, most things should be secured by design. Trying to throw a security blanket after the fact is always harder. If you're secured by design, your operating system doesn't allow you to mess with it, it's better. But by definition, because everything needs to work with each other, every piece of technology needs to leave doors open for me to talk to it, or me as in one piece of technology to talk to the other piece of technology. So we're sort of not associated with any one particular camp. We provide security that runs on every piece of technology that's out there. So to the extent some of these players are integrating into their stack, yes. If you're totally reliant on their stack, yes, they present a threat.
You use a VPN here, or would you even touch the Wi-Fi in Davos?
No.
You would not use
There's
Wi-Fi?
5G, it's wonderful.
You go straight to 5G because you think it's that much safer.
Turning mine off right now.
Okay. Good to no VPN.
I don't know what the CNBC.
I'm shutting it off right now.
Do you do a VPN over your 5G?
Yeah, if I use my computer, yes, I do. Palo Alto has a product called Prisma Access. We protect most companies out there. We use that as a tunnel to go access data.
Good to know. Some news you can use.
There we go.
There you
Finally.
go. Thank you.
Hey, Cash, before you go, just very quickly, you just came from the Sam Altman meeting. What was the message where 150 CEOs are listening?
I think it's been said that about 98% of the CEOs out there are aware of generative AI and would like to see it deployed in some way, shape, or form in their enterprise. 69% expect to deploy it in 2024.
Wow.
That is, as I said, the fastest adoption of a technology trend. And guess what? The moment every one of them starts to deploy it, they're going to have to make sure that their data's not getting stolen, no prompts are getting injected into their large language models, so they need more security.
Big new opportunity. Thank you.
When you came, when I said welcome, and one of the big boys, a non-founder in the Billionaire Club, that's what I was talking about, which is not, you're so good at Google, so great at Palo Alto, it's a great country. Is it not?
SoftBank in the middle, you know.
Yeah, SoftBank in the middle.
Exactly. Okay, thank you. Thanks. Appreciate it. Coming up, we're going to talk about the state of venture capital in 2024 with Briar Capital's Jim Breyer. And then later today, here at the World Economic Forum, an exclusive interview with the Secretary of State, Antony Blinken. That is today at 10 a.m. Eastern Time. Stay tuned. We are coming right back from the World Economic Forum in Davos.
news. Some deal news. Chip design software maker Synopsys announcing a deal to buy engineering software company Ansys in a cash and stock deal valued at, $35 billion. Under terms of the deal, Ansys shareholders will receive $197 in cash and about a third of a share of Synopsys common stock for each Ansys share that they own. The combined company expects to achieve roughly $400 million of run rate cost synergies by year 3. The deal expected to close in the first half of next year.
Okay, here's what they should do. Combine the two companies, and then it could be
Synopsys. Oh, yeah.
Synopsys.
Pretty similar. There is some synergy there. They both don't hit.
All right, when we come back this morning, we will go inside the U.S.-China chip war and the race to develop next-generation AI technology with the CEO of Qualcomm. But next, we're going to talk markets and the state of venture capital with Breyer Capital's Jim Breyer. Squawk Box will be right back.
Humanly possible.
Welcome back to Squawk Box right here on CNBC. Let's take a look at the futures this morning. Right now, you're still looking at the Dow futures in negative territory, off by almost 100 basis points. Actually, fair value at about 90 points below. That's an improvement over where we started the show this morning when we were down by about 200 points below fair value. That's after we got Morgan Stanley and Goldman Sachs, both those banks trading higher after reporting their earnings.
Meantime, last year at Davos, VC investor Jim Breyer was pounding the table. I don't know if you remember this. On NVIDIA, calling it an underappreciated AI story. And boy, was he right. Breyer Capital's investment reveals bets on AI adoption for everything from detecting and treating cancer, developing new materials, and writing papers. Joining us right now is Jim Breyer. for our Capital founder and CEO. Welcome back to Davos.
Pleasure.
So, okay, by the way, we should start here. Would you still pound the table on NVIDIA?
I'm pounding the table.
You're still
on
pounding the
NVIDIA. And I think the key risks are supply shortage. Obviously, there's the Chinese supply chain. It was at one of the discussions in and around some of your conferences where I spent time with NVIDIA senior teams around the resilience of the supply chain. I came away very impressed. They have built a software layer around their chip that the companies I invest in just can't get enough of. And so if you want to run really significant AI, and you want to do optimization, you want to be running different probabilities, you need NVIDIA, and I also pound the table on AMD.
On AMD. Speak to this, though, because when you talk about doing serious kind of work, you're not really, I mean, Sam Altman's here, he's talking about ChatGPT, there's just a big meeting, I don't know if you were at that meeting, we can talk about it, but you're talking about, I mean, you're investing in a number of companies that are using AI for healthcare, where they're having to do imaging and real sort of heavy-duty stuff. Where do you see the real opportunity? I mean, we talk about AI every day, but nobody sort of has a tangible form factor for it. Where do you see the biggest opportunity immediately?
Well, I'm seeing it play out in very positive ways because for the 12 or so AI spinouts out of Memorial Sloan Kettering, MD Anderson, Harvard, UCSF, we start with great medical data and a great set of doctors. It's my job to recruit these insane machine learning geniuses out of Alphabet and Amazon and Microsoft. And we're seeing phenomenal progress in a number of cases where something as simple as getting a pathology slide back used to take 10 days. We do it in 2. And I think what we shall see over the next couple of years, these worlds have been completely separate.
You're talking about the academic world and then the commercial world where you can actually get those patient to patients, right? To actually help improve things.
And so I think the other piece of it is for a lot of people who invest in biotech, they've been very slow to invest in artificial intelligence. And there are a lot of great investors out there who just don't do healthcare life sciences. And so part of the Breyer Capital thesis in 2016 and 17, study New England Journal of Medicine, spend time with the doctors, and the newest deal, which I'm really excited about with my friends Michael Dell and Steve Pagluca, Tom Cahill, we have one of the best scientists in the world as our founder, Stuart Schreiber. And he was a co-founder of the Broad, a lot of advances.
The Broad Institute.
The Broad
this
Institute.
is for Arena Biotech.
This is Arena.
Yeah.
We spoke to the Broad and the universities for about a year. And we are basically now announced as a for-profit institute that will build deep AI technology, but it's all medical and computer experts who really think we can make a big difference. Instead of 10 years for a new drug, it's 3.
Yeah, I mean, that's one of the most exciting promises of all of this artificial intelligence. One of the things that could probably benefit humanity to the highest degree.
So I had this conversation last night at a CNBC dinner with one of our great pharmaceutical executives, our being the world. He's not from the US. And he said, how important is AI? And I really do, I smile, but for someone working in these spaces, as well as more broadly, it's AI or die. I can promise you. I've never seen anything
Do you
like
think,
it.
though, I mean, we're in such early days, and I just wonder whether this is 1996 or not. 1996 was a great time insofar as there was a lot of invention. There was also a lot of money that went in that never came out. And so are we in that period, and how do you decipher between the stuff that's going to work and isn't at this point?
I think it's really hard to figure out if it's 1996 or 1999. I was fortunate to have Steve Jobs as a mentor during the personal computing revolution. 50 or so companies went under in about 12 or 18 months. We didn't need that many PC companies. Same was true in the area of the internet and the web browser, great carnage, social networks. Again, one of the reasons I loved Facebook, I looked at 4 other social networks, and Facebook had figured things out.
I'm trying to think of the different ways that you can use AI in the medical arena. So, and I think in terms of drug discovery, you don't even need to do some clinical trials for whatever the greatest binding compound is. That's one way to do it. You might be able to show someone a histology slide. You'll know exactly instantaneously whether it's cancer, whether it shows something else, or just data collection for drug-drug interactions, and all these things. Do you know Tyler Jacks? You know him? Mm-hmm. You do? Okay, so I know he came into the Center for Cancer Research after Sal Luria exited, and no one knew why you needed a computer genius at MIT to do cancer research. That had to be 15, 20 years ago, and he's now at Coke up there. But Broad as well, but all three, all of the above, are where you're going to see potential.
You bet. And so I think I'm a venture capitalist, despite what students wanted to call me.
The drug discovery,
when I spoke.
the diagnostic.
It's all of it. The drug discovery, it is happening. And my mother passed away from ovarian cancer, and there are drugs available today that would have let her live longer, healthier, and better, and not go through 6 bouts of chemotherapy. So there's a pipeline of drugs that just needs to be accelerated, and
that's what AI can do.
That's what AI and computation can do.
We got to run, and they're going to kill me for asking. Who loses in all of this? Because a lot of companies won, but then there are always going to be people who are going to be upended. Who do you look at and say it's going to be tough for them?
I think there are companies like Cisco that are now value-oriented. They are not on the growth trajectory. I like the acquisitions they've made. The Magnificent Seven, quote-unquote, I would add AMD to that list for sure. The best AI talent is in the mega cap arena. I would say $1 billion or $1 trillion of Microsoft market cap is probably due to AI. And so we'll see, but there are a lot of companies that don't move fast enough.
I can't tell what you're saying with that $1 trillion worth. It's overvalued or undervalued. And I think he's not going to answer the question. Jim Breyer, thank you.
Thank you.
Thanks very much.
Great to be with you.
Up next, global energy in focus and the threats to the markets from violence in the Red Sea. Chevron CEO Mike Wirth is going to join us. Squawk Box will be right back. So.
Welcome back, everybody. Energy, one of the key topics here in Davos this year, and seemingly every year at this point. Joining us right now to talk about this and much more is Chevron CEO Mike Wirth. Mike, welcome.
Thank you.
Good to see you. Good to see you. I want to jump right into the news of the day with you, because something we have not spent a lot of time talking about today is a situation that has gotten increasingly concerning, and that's the situation in the Red Sea with the Houthi rebel attacks. They have now said that they're going to be targeting not just Israeli-bound ships, not just Israeli ships, but American and British ships as well, because of the back and forth in the attack in Yemen last week. What does this mean for you? How closely are you watching this, and what does it mean for the global oil supply?
Yeah, well, we watch it very closely. I mean, the safety of our people is the most important thing that we work on every single day. We have ships that go through the Arabian Gulf and the Red Sea regularly. Last year, we had 2 ships attacked by the Iranian Navy. We had one ship was boarded off helicopters by commandos, and the ship was actually hijacked and taken into an Iranian port. We had another one that took fire for several hours until the U.S. Navy interceded. So we work very closely with the Fifth Fleet. We coordinate every vessel movement with U.S. and other military authorities that are in the region. But it's a very serious situation. It seems to be getting worse. So to this point, we haven't seen much in markets.
That's what I was just going to say. WTI below $73 this morning. That comes as a surprise to me. Does it surprise you?
Well, it does, because the risks are very real, and so much of the world's oil flows through that region that were it to be cut off, you could see, I think, things change very rapidly. Thus far, we've been able to maintain our movements through the region, and I think others have as well. But this is an evolving situation that we really have to watch very carefully.
Okay, let's talk about what's happening here in Davos. And we said energy has been a focus here for years, and it has. It's generally, though, people looking for renewable solutions to the climate change issues that are going on here. That's been a focus of Davos for years. You've been very vocal about the idea that we need to have lower emissions, but it shouldn't come at the expense of affordable and reliable energy supply. What is that message here? How does it resonate?
Well, I actually think the discussion has evolved here a little bit. As you well know, for a number of years, the focus was almost exclusively on climate.
Right.
And there are 3 things that really matter when it comes to energy. It's affordability, it's reliability, and it's the impact on the environment. And you have to take all 3 of those into consideration as you talk about energy as a part of our economy. And we've certainly seen in Europe when reliable supply is threatened, prices respond, and the economy feels it. And so I find a more balanced conversation is underway, certainly not less concern about the climate, but I think more recognition that reliable supply and affordable energy matter, and that we have an energy system today that has the mix that it has, and you can't change this overnight. And so it's going to take time, it's going to take technology, capital markets, and investment in order to scale some of these new technologies. And we're on that path, but this is not something that can change as rapidly as I think most people would like to believe that it can.
Do you think some of for example, the climate agreement, it was much more punitive for the United States vis-a-vis India and China, and we're already in much better shape in terms of controlling emissions. It's almost like we were taken. I worry about less developed countries having to live by rules established here by the global elite in Davos that you let them eat cake. You can't have hydrocarbons. You need.
Basically, you're saying to other people that you have to lower your standard of living unless you can afford for carbon.
You can't come into the first world like the rest of us. We've already had this, but you've got to. Your economies can't grow. You're not going to have the hydrocarbons necessary for you to grow.
Well, this is the tension.
It's been a backlash. This is coming home to roost. When people don't have energy, when things cost too much and your economy goes into a recession, when Europe looks like they dodged a bullet with Russia and natural gas, could have been much worse.
Well, this is the tension that's been inherent in the Paris Agreement from the beginning, is who pays, and particularly for developing countries, how do they allow their economy to develop in a way that's competitive and raises the standard of living? And that's maybe a very different solution than what you see in the developed world, where you've got already great wealth, you've got an economy that is well developed, whether you're talking Europe or in the U.S., and the ability to afford things, be it in the energy sector or others, is very different.
Mike, is the coal plants that we know are
being developed every day in India and China. Are they all clean coal?
I'm not an expert on Chinese coal, but you're right. There's still a lot of coal-fired power being developed.
They need power for the grid that doesn't come from wind and solar.
And we need nuclear as part of that
we need
mix
nuclear
as well.
modules
We need
too.
an upgraded
Do you think
grid.
Davos is? It's different. It's almost Davos 2.0, isn't it? There's a realization that the
I
pie
think
in
the
sky.
discussion is evolving. Yeah.
Think anyone realized that coming here on a Gulf Stream probably wasn't a good look when they're piled up at the airports?
I was going to back a U.S. political question, which is, you saw gas prices go up, and then you saw gas prices go down. President Biden blamed for it going up. It's a question about whether he gets credit for it going down.
50% above where he started.
Well, no, and so the question though that I have is actually as a CEO of a company in this space, how do you think about the politics and how it relates to price? For those out there who are watching, trying to figure out how they think about what's happening in the country.
The price of gasoline in the U.S. is set by supply and demand and competition. It's not set by the President of the United States. It's not set by CEOs of oil companies. It's set in markets. It's a globally traded commodity. And prices went up because oil prices went up when the war in Ukraine broke out. Prices came down as people realized that oil supplies weren't threatened. So there were sanctions that were imposed on Russia, but the Russian oil kept coming into the market. The sanctions that were imposed on Iran have not been
But do you
enforced.
credit or blame a particular president at any point for either pipelines that are built or not built, or supply chains, or ports that
Well,
are
that's a
open
different-
or not open? Because all of those things also interact with the price.
That's a different issue than the price of gasoline today. That's about investment in long-term infrastructure, long-term energy supply, and energy security.
Regulations
Those are
matter,
important issues, but they're not really relevant to the price of gasoline in the short term.
There's a more draconian regulatory environment now than there was before President Biden, is there not?
We've certainly seen mixed signals, and we've seen a more aggressive regulatory agenda out of this administration.
Let's talk about what it means even on a state level. California, your home base. You just said, I think it was last week, that you'll be taking an impairment charge of up to $4 billion because of significant regulatory ongoing challenges that you've been dealing with them. And there's a long litany of the back and forth with California, what they've been doing. But you've also spent hundreds of millions of dollars less in investment in the state since 2022, and it's because of the policies that are happening there. What's the problem? What's the outlook for California?
Well, California was one of the biggest energy-producing states in the country for many, many years. Our company was founded there. We made the first commercial discovery in Pico Canyon in 1879. We've been there for 145 years. We've been part of the economic growth and the success of the state. The regulatory and policy agenda has become increasingly aggressive and hostile to our industry, raised the cost, made it more difficult to do business there, and we are investing less. And as we've looked at our future plans and will invest even less going forward, we are taking an impairment on the value of some of our assets in the state because we simply won't be able to produce the value out of those assets that we had planned to. It's gotten too difficult, and the opportunities for investment elsewhere in our portfolio have become more attractive.
What specifically? I mean, a lot of this is Gavin Newsom as governor. What specifically regulations have made you look at it and say, forget it, it's not worth investing?
Yeah, I wouldn't put this all on the current administration. This has been underway for a couple of decades, and there's a whole series of things that have made it more difficult to develop energy resources in the state of California. It's permitting issues, it's setback issues. There are a whole series of constraints that I think many in the California policy world would say are intended to constrain and ultimately shut off production in the state as the state tries to pursue a less carbon-intensive economy. The reality is California drivers are still using gasoline, and will be for a long, long time to come. That supply will come from other places than the state of California.
And if they're using EVs, you need the Chevron natural gas to power the grid that charges the EVs anyway. You're going to get it either way, Mike, aren't you?
Well, look, we're an energy company. We're investing in renewable fuels, biofuels, hydrogen.
But even EVs need power, don't they?
The power comes from the grid. The grid comes from power plants. The power
and
plants
natural
have
gas
their
is a good way to do things, is it not? Yeah.
Mike, thank you very much for being with us today. Michael Worth.
You're welcome.
You have to talk me down. Head of Chevron has to talk me down on hydrogen.
Thank you, sir. Coming up on the other side of this, AI and the geopolitical fight over semiconductors. The CEO of Qualcomm is going to join us right after the break. And a reminder, be sure to follow Squawk Pod for special episodes all week long featuring the best of our Davos conversations that you can listen in audio form. We'll be publishing multiple episodes of Squawk Pod Reports Davos each day. You can hit follow or subscribe on your favorite podcast app and listen anytime. We're coming back live from Davos, Switzerland in just a moment.
And as the world is shifting towards AI, our next guest says his company is well positioned to capitalize. Joining us now is Qualcomm CEO Cristiano Amon, and it's good, Amon, good to have you on.
Happy to be here.
And I'm having deja vu from an interview we just did with Palo Alto. You need to work with me. You need to work so we at least have an idea of what you're doing. It's very arcane. Qualcomm has been a leading edge chip company for a while, and that right there makes it hard for most of us to grasp exactly what is happening. And then you throw in the AI component, and it's a mix that's hard to explain. Will it help Qualcomm with its competitors and go into the future and be even more successful?
Yeah, absolutely, Joe. Look, the company, and I think probably most know Qualcomm from what we have done in the wireless industry through every generation of wireless, but the company is really changing from a wireless communication company into a connected processing company in the semiconductor space. And what we're really excited is AI is just the new computing, and what's happening on the data center, and you see with ChatGPT and everything, we can bring this to every device. We can bring this to phones, we can bring this to PCs, we can bring this to cars, and it comes as a tailwind for the company effort to diversify and grow. If you look at what we're doing in automotive, we're entering the PC space now, building the next Windows platform for Microsoft, and the ability to run AI on those devices is a great opportunity.
Okay, so AI is helping you design the chips to do that, or you're selling into the AI market itself, or both?
So our chips are going to run those large language models, those large visualization models. They're going to run, and they're going to run in your phone. It's going to run in your PC. It's going to run in your car. Just as an example, CES, we're back in Vegas. We, in a partnership with BMW, one of our customers, we had our Qualcomm concept car, and we had a large language model running on that chip with all the knowledge base from the car. So you have something in your dashboard, you just ask the car, what is this like? And the car explain what it is, tell you what the problem is, and ask you when to schedule an appointment, tell you the availability, look at your calendar and schedule that for you.
That would be nice. Will,
yes.
will it then drive the car there and take care of it
It's
while
going to be a change in
I'm
how
at
we
work?
interact with computing, and we can do this in everywhere. You have a computer even in the palm of your hand.
There was a time we talked about Qualcomm so much that we actually would play Qualcomm because we mentioned it so much. And now I think we'd do NVIDIA if we did it. So you have had to transition the business, or at least the stock has been, it hasn't been the growth vehicle it was for years and years in the last 2 or 3 years. How does it get back to today?
Look, this is, I think, the essence of why we're being so focused on diversifying the company. If you look where the stock trades, it's trade on the mobile market. The mobile market is great. It's a very big market, but everybody has a phone, so it doesn't grow as much. But what we realize is some of the technologies that was the essence of with the company, which is wireless communication, high-performance computing, and now the ability to do AI processing, could have different end markets like automotive or industrial. And I think that's where we are. We're happy to see that some of those markets, in a short period of time, we're now working with every company in the automotive industry. So it's a kind of testimony to our technology. Over time, that's become a larger component of our revenue. Non-handset, we expect the stock to have a different performance, but AI is a great opportunity, and as I said before, it's a tailwind of what we're trying to do.
The leading tech company is all about reinvention. It always is, and you either reinvent or you turn into Novell or something, or I don't know, Prime Computer.
Well, that's our story. I think we have been reinventing ourselves every generation.
So the growth rate, in your view, will get back to some of the days gone by.
If you look at some of the new business for us, whether it's automotive, industrial, I think our entry into the PC space, the things we're doing with Meta, for example, with virtual reality, augmented reality, all of those markets, they have double-digit growth rates, and I think that's really the opportunity for us as they get scale. And it's highly leveraged. We leverage the same exactly technology that the company's been developing.
So who's your ideal? You go to colleges. Who's your ideal candidate for a Qualcomm position?
Well, we're a chip company. Yeah, we Qualcomm is in a unique place because we build CPUs, we build graphic processor units, we build neural processor units, we build more wireless communication.
All right, I can't do any of that.
Yeah. So anybody that is interested in working in chip company and change the technology landscape, I think we want to hire those.
And can you?
Absolutely.
Is the talent you're finding enough STEM educated individuals in this country, or
I think that's an issue that the entire tech sector has. I think skilled immigration it's important, and I think we have been hiring people globally. I think not only in the United States, but in all different geographies as well.
And it's not just me. Andrew, you're not going to work with Qualcomm, are you?
No, none of us are smart.
He hasn't offered me a job yet.
Yes. Okay. Cristiano, thank you.
Thank you.
Okay, very good. Let's get a final check. Almost going to put this one to bed. This first show, we got 2 more to go here in Dallas. The futures right now, back down 148. We were down 50. We had recovered. Now we're back down 75 or so on the NASDAQ, S&P. Off 21. Interest rates haven't been the issue today. About 4% now on the 10-year. And Bitcoin's right at about 43,000. Make sure that you join us. Tomorrow might be a little precipitation, or is that?
I think it's Thursday. Yeah.
It's Thursday. But we'll be here. Please join us. Squawk on the Streets next.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl King today with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. Got some caution to kick off this holiday shortened week. Stocks are lower in Europe and Asia as well. on some China weakness, risk in the Red Sea. Yields do fall on a very weak Empire survey. Roadmap this morning begins with the rest of the big banks. Goldman Sachs, Morgan Stanley out with results. We're going to dig through those numbers.
Plus, we're keeping an eye on shares of Apple. They seem to be under pressure again. The company is offering what are somewhat rare iPhone discounts in China there, as, of course, demand perhaps is waning a bit. And Elon Musk, well, he wants more control over Tesla, at least if you follow his tweets. He wants perhaps 25% voting control. This amidst the company's AI initiatives. We'll talk that through.
Let's begin with the bank earnings from Goldman and Morgan Stanley, Jim. Equities at Goldman getting some attention this morning.
Yeah, look, I gotta tell you, I thought Goldman is really much further along with the transition, be going back the way it used to be. I was worried about the Apple Card. They've got that kind of cordoned off. It's gonna be fine. I think that investment banking is going to be very good. A merger is going to be great, and they were very low key about it. Morgan Stanley, a lot of what was wrong last time got better, wealth management. But I want to make a larger point. The banks are rolling over no matter what. I mean, Goldman was terrific. It opened up a couple percent in early morning trade. Doesn't matter. When JP Morgan finished down on Friday, you just said, I don't want to touch this group. Because JP Morgan's quarter was maybe one of the best I've ever seen in history. And the stock reversed from being up 6 to being down $1. Doesn't matter what you say. People want this group out.
Because?
Because I think the group moved a lot. And because I also think that somehow there's a belief that it can't get better than this. I disagree with that entirely. I think investment banks is going to be really good. I think it would defer to David. But I think you could have a huge year of M&A. But people just said this group came in too hot. Morgan Stanley was at 70. It went all the way up to 92. It's just sell, sell, sell. Wells, I thought, had a good quarter. Doesn't matter, David. This group was set to sell, and they're selling it.
I feel like it seems so rare that the group actually really does perform well after earnings. And I know we say that,
I couldn't find a time. It's a very good call.
Like a great consistency to basically not expect, certainly don't own these going into earnings.
If they ran, you're so right. There is, I mean, that's your feel, but empirically it's absolutely true. It's a really bad group to own.
I don't know why. Because they don't seem to underperform. Again, to your point, Goldman had numbers that were well above most of what many of the analysts have been expecting. There are these FDIC charges that some have been including in their estimates, haven't. So that's making things a little difficult for some of the banks. But overall, we can tell you, Goldman better than expected.
Oh, I mean, I was going over with Goldman with some Goldman people I know, and I just said, wow, great quarter. Sorry about what's going to happen. I said, well, what's going to happen? I said, well, your stock goes down. That's what banks do when they go up into the quarter. So David's right. These guys are not semiconductor companies, they're banks.
Record AUM, though, over 2.8 trillion, up 10%.
That's fantastic.
Big piece in the Journal on how the post-consumer era is in swing at Goldman and doubling down on wealthy clients.
I think that they're back to the way it used to be, where they're hunting elephants, which is where the margins are. I think that they're probably staring at the stock right now and saying, how is this possible? This was as good as it gets. And the answer is, it's possible, but it was as good as it gets. What's the matter?
I don't understand our charts.
Well, that's okay.
0.64% is which decline?
But they
both said 0.6%.
Let's take that off.
Goldman and Morgan Stanley.
Maybe we take that during the commercial.
Now I know. Well, now our viewers are also going to share my frustration. All right. They still have a return on tangible equity that's nothing. I mean, what happened to double digits, man?
Well, look, remember when you said it would never be greater than 8? I remember you said never be greater than 8.
I did.
And I remember when you told me to sell, to stay on Boeing, too. I mean, you went Boeing, sold.
Which did I tell you?
I don't care. I remember you telling me to take the Eagles. I said, you're out of your mind. No, but
Carl, I'm to blame for anything bad that's
anything
happened.
Boeing, up or down.
But I told him, I asked him why he wasn't selling Boeing.
He told me to take Vivek. He said, go in big Vivek.
Can we come back to this return on tangible equity?
I'm sorry, I was way out of line with that.
You were way out of line. In 2023, they get to what? ROE was 7.5%.
No, you're right. You're right.
And ROE was 7.1% for the fourth quarter. That's pedestrian.
They're in a transition mode.
Transition on what?
Well, they ought to get out of a lot of stuff that they do. Dude, you want them to own that company that was like you want to do your porch over?
So,
you hire Goldman?
No, they have moved on from the lower end consumer stuff.
Yeah, it's good.
Mid consumer stuff without a doubt. Their focus is.
Didn't you think that took guts to do?
And wealth management is one of the outperformers, as of course it is for Morgan Stanley, where much of the bank is constructed on wealth.
But people want to sell them, and then you start seeing this kind of group thing. I mean, we saw this, Carl, when you're down 3. Like, you don't even know. You moron sellers. You're betting on the stock being down 4. Hey, let me get in there and make $1.03. But that's what you do. A lot of morons playing the game, a lot of non-teamwork, to a lot of pulling guys before they should be pulled, a lot of firings. Morgan Stanley is not bad. But go ahead, sell it because you think you know more than me. You don't. You'll take the stock down 5 ultimately, then it'll go to 100, and you're a bunch of clowns. I said to Tammy Reed on Saturday, I said, I don't know anything because I'm a fan. She goes, correct.
That was great stuff Saturday night. We'll talk more about the weekend in media in a minute. Jim, to your point about IPOs, Adina Friedman on Squawk, the NYSE Vice Chair, John Tuttle, talking about a robust pipeline. We got a deal today in 3D design.
I mean, if you look at what's going on in biotech, you're either going to come public or you're going to get bought. And there's a lot of companies like Roche bought a company, and it's just like, I thought it was going to go public for like 5, they got it for 2.5. Then what Carmot was called, it was a GLP-1, and I think this is a halcyon moment for IPOs. David has not mentioned it, but the FTC has gone, Linicon obviously is on a consistent intellectual vacation now.
Why do all roads somehow lead back to her? Where did you get from IPOs to the FTC? Take me through that.
These are important lineups, the M&A lineup.
M&A.
I'm getting together with an M&A lawyer later this week. He's almost too busy to see me.
Yes, there is. We talked about it. By the way, we have a very large deal today that we will get to. Synoptics buying Ansys. It's
Yeah.
a $35 billion deal. Let's call it roughly half cash, half stock. Sure, a lot more on behind what was behind that. But you're right. M&A is most likely going to be far stronger this year, it would seem. At this point, it's hard to say than last year.
Well, then why do you want to sell these stocks? Who's selling?
Because you know what? I mean, listen, it's important. It's a high margin business. It does move the needle for the Goldmans and the Morgans. But really, Jim, if you are focused on a resurgence of it, you might want the purer plays that are out there. I mean, Evercore, for example. Evercore, for example, advised Synoptics on the Ansys deal. You've got Evercore, PJT, Moelis, even Lazard, maybe. I'm just thinking, right, that's for there. I mean, there are pure plays that you can play M&A with, as opposed to obviously where it can kind of get lost in the shuffle, even though I don't want to say that it doesn't move the needle. It does for the Goldmans and the Morgans.
But look,
and the JP Morgan.
NVIDIA could say that it's getting out of the banking business. It's not even in it, but it would take the stock up 15. I don't know if you heard Jim Breyer this morning. I mean, Jim Breyer he went like this, pounding the table NVIDIA. When we had dinner with him at that great May CNBC conference, he was telling me, he says, look, NVIDIA is unbelievable. And here he is just reiterating, but the stock hasn't moved yet. And he's a really smart guy. They've had some good guests today.
Yeah, and a lot more to come, of course, including Solomon, I think, tomorrow.
That's going to be fantastic. His stock's going to be down 3 after he speaks. Sorry.
As for the broader setup, Jim, got 10 and 11 weeks positive. I was sort of trying to isolate that initial week of the year when we were down almost 2%. This Empire print got a lot of people's attention because it's the weakest since the depths of COVID, and it's the biggest miss since, I think, spring of 2020.
Yeah, that was out of sync with the thesis, and of course interest rates are going higher today. I think that, Dave, we're in this weird moment where I read a lot of articles about how the year started poorly, and I'm like, where's the year started poorly? With what? Where? Where's
economically or
no? Stocks reacting to economic news. That the stocks have divorced themselves from weaker news.
Right.
They've divorced themselves from the fact that the Fed is not going to cut and that the March cut is chimerical. And I think stocks act quite well, but I do think that they should spend a little time in the tank. JP Morgan's down 3. Like right now, Jamie Dimon, who does not pay attention to stock one bit, is saying to one of his guys, "What's with the stock? What's with the stock?"
Yeah,
it does.
Is that what he does?
Does cavalier? He's always got that kind of cavalier coolness about him. He's got a coolness about him.
2.85% for the week and 1.92% in the pre-market. Okay. That's what's happening with that stock.
Okay,
You
so
like
let's
that?
move on then. You want to go to what? Do you want to go to Tesla?
No, I want to go to Apple. Let's go to Apple. You can.
You have to go to Apple.
Yeah, I want to go to Apple because you talk about it. Well, this is a stock that is down so far this year. It's got a smaller market cap now than Microsoft,
Wow,
which is
tiny.
Oh yeah, tiny at $2.87 trillion.
Because Apple's getting.
But you can
giving,
see in the last week it's
who
down
isn't
1.7%.
everyone's giving discounts in China. Other than that weird thing, you guys ever looked at Temu? I saw a pair of boots for Temu. They'll pay me like $80 for it. I mean, some of these Chinese sites are just incredible. Of course, it accrues to Amazon, the chassis. But yes, you have the stock. You have the stock under pressure. I mean, okay, all right, take it down. I don't care.
There are reports that, in Bloomberg Journal that they are discounting.
Well, has it occurred to anyone that the individuals are out of money and it's deflationary?
Well,
so
they have a consumer demand issue in China for sure. So you talk about economies. I mean, China's economy has got to be a continued focus, both because there are U.S. companies that are relying on Chinese consumer demand there, and not to mention Boeing, which is a separate issue,
Yes.
but certainly demand from China is important, and their safety issues now seem to be causing some issues for them. Back to the consumer demand, yeah, there's deflation in China right now. Then you get to the export side, and there's a belief that China's going to ramp up exports even more, which conceivably is going to represent a significant competitive factor for U.S. manufacturers. Should they once again start trying to dump various things here despite our tariffs. So it does matter, that Chinese economy.
Right. All right, I'm going to ask you something. I'm not a political guy. But do you think that the Chinese awoke this morning to a straw poll in Iowa and said, holy cow, we're in a real jam here?
You know, the one thing that has been relatively consistent from the Trump administration, the Biden administration, Jim, has been China.
They don't like China.
Has been the tariffs on China.
I know.
None of them that I'm aware of have been removed.
No.
And of course, we have new ones on high-end ships
And then we
that
have
you're well aware of.
the
That
new,
Junior Raimondo is very involved in.
I know,
Secretary of
the new
Commerce.
Taiwan election that went Chinese, not the Chinese way.
That's right.
And yet the Chinese, they want to issue some $1 trillion bond, and yet we know, well, it's actually not that much, but we know that from Eunice Yu that the amount of empty cities, ghost towns.
There are ghost towns. They have a real property issue.
Do they have,
And
like, tumbleweeds?
Deflation is going to be very significant. They've got some demographic issues as well. We don't even get a youth unemployment number any longer because we know how high that number may be.
Hilton
All
Road
that
pulling back.
said, they still can export a lot of stuff. I mean, talk to the Europeans right now about EVs, which are becoming higher quality and are being dominated
That's
by
a very
the Chinese.
good point, and they now have the
Are we
largest
going to
share
keep
in
them out of
Mexico.
this market? If they
either president-
$28,000 EVs, you're not going to be able to buy them here.
Either
But you know what?
president
Some
gonna
people
keep
might
them out.
say, "Well, come on, it solves the inflation problems."
Good point. Good point. The inflation problem is being solved by the plummeting stock of Apple.
Yeah, I think the headline of the Journal is Wary World Watches as Prices Fall. We talked about CPI on Friday, 3 straight months, worst since the Asian financial crisis.
Gotta
Jim,
change the narrative.
Chinese stocks relative to the S&P are the cheapest in almost a decade and a half.
I know, but you come in and Baidu's down big. I don't know about Baba versus Japan, where
Baba hasn't been this low.
Japan's back
Baba's
to
below its IPO
1990.
price. Yeah,
Japan's back to when it was bigger than us.
Japan is. Had a real renaissance.
And we don't talk about it at all.
No,
it
we
just
don't
happens.
talk about it too often.
Nope. What is that about? That we don't talk about the renaissance of Japan? I mean, it's been the best market of all, and no one's even talking about like Toyota. They talk about Tesla, but not Toyota.
That's a good point. That's a good point. There are still a lot of formidable Japanese companies.
There are.
Yes.
And yet we act as if they got left behind.
Well, I mean, their market cap combined still doesn't equal Microsoft.
Who bought Letter X? And I don't mean Twitter. Who bought U.S. Steel?
Yes, a Japanese company
It's
is
wrote a
in a
check.
deal to
But we
acquire.
don't even think anything of that.
Why should we?
Well, because they had the money.
They did have the
They
money.
had the money.
They had the most money.
They had the
Yes. It's not just the money. Cleveland Cliffs had the money too. They had the
That's
most
true. Morgan Stanley down 3. How about taking it down 6? Why don't you just do that? You bunch of clowns. Just take it down. You
are
fatuous individuals.
Are you directing your hostility at the wrong audience here?
I'm a chief fan.
There's a guy who runs the
I like that
You wanna
most
talk
people
about it?
scream at the TV. You scream at the TV from the other side.
Oh, absolutely.
Back at the viewers.
Absolutely. Because these people are I mean, I got to tell you,
Not our viewers. You're talking when you saw. I want to make it clear here. He loves his viewers. He's talking about the people who are selling Morgan Stanley.
Mo's selling
being
it down
clowns
4,
and morons.
and Curly's got it down 5, and that's just Shim's chance to buy it down 6. Go ahead, Shim. Take over. And then, by the way, Goldman, I'll pay down 4. Soupy.
Got it right. Bang.
Take a look at the pre-market here. We're going to get to a lot more, including a discussion about the Fed's Waller today. Big speech at 11, which might set the tone for the week. Got some calls on Target, Starbucks, Boeing, Depot, BlackRock, and a bunch more when we return. Some breaking news out of Washington this morning. For that, we'll turn to our Emily Wilkins. Morning, Emily.
Hey, Carl, how are you doing today? Well, lawmakers have just released. Hey, Carl. Well, lawmakers have just released a $78 billion tax deal that includes major tax breaks that businesses have been lobbying for years. This proposal is going to allow full expensing for research and development, bonus depreciation on qualified property, and full expensing for business property. Now, if these sound familiar, all these provisions were part of that 2017 tax law, but expired in past years, and businesses have been pushing to bring them back since. This bipartisan package would also expand the current child tax credit, although not to the level that it was at during the pandemic. And the bipartisan deal is a result of negotiations between the House Ways and Means Committee Chair Jason Smith and the Democratic Senate Finance Chair Ron Wyden. In a statement today, both of them really urged this as a bipartisan measure that's able to pass. Both said that it would be good for families as well as good for businesses, Main Street businesses. And they both emphasized the importance of having these tax breaks in place for American businesses so they could remain competitive with China. Now, not everyone is necessarily on board with this.
I'm not on board with it.
Key Democrats have slammed this proposal in the last week for not going far enough with the child tax credit, and we'll see what they can do. Wyden says he wants this done before tax season starts.
I'm not on board with it.
This month, it will be a bit.
I don't like laws that are made to. I mean, yeah, if I had 5 kids, but I have no kids. It's your responsibility. If you have a kid, it's your responsibility to step up. They're going to give them tax credits. Give me tax credits for paying for their kids. I never have approved of that.
So you don't agree with these tax breaks?
No, of course not.
You don't?
No.
Even for R&D?
Why don't
You don't want to, I mean,
no, they have so much money for R&D. It's just tone deaf with how rich American business is. Why don't you help small business? Why don't you help people who got in a jam during COVID? But they don't know. I mean, look, not to be too laughing at everybody, but business is getting tax breaks. Business is doing so well. We all should be.
If we had a great economy, we shouldn't be given any tax credits, but we don't.
But they are so out of touch with the real world, it's really frightening.
Very good.
It really is.
Kramer's got it right.
Doing the best I can recall in a long time.
All the way through a tightening cycle, which has been the surprise.
Starbucks, what happened here?
Name me a business that's doing poorly. Like charge.
Morgan Stanley upgrades Starbucks to overweight from equal weight.
Office, commercial, real estate.
Oh, we ought to give those clowns a break. Give them a break because they spit
Real
their
estate
broke.
got a lot of breaks in them.
Yeah, exactly.
See, here's another company that it seems like every time they hit a bottom, they want to give them an upgrade. 91.77, then they come out with an upgrade. For what? There's amid interesting risk reward. So it's risky, but they still give it a. And Morgan Stanley, of all companies, the worst one out there, of all banks. They do it all the time. I mean, if you think you're out of support, sometimes it's, I mean, that's a descending pattern. It'll probably be tradable today. Same thing with Goldman Sachs. The banks didn't do too well this round. Almost to my support level. Morgan Stanley's taking a knife. They say things are getting better for Morgan Stanley, but this is the worst of the worst, next to Wells Fargo wagon. I think they're improving once they got rid of that CEO that's screwed the housing market up. And Boeing's close to my 210.23. We're right on it. So we might have us a trade at open. Now I'm not definitely calling out Boeing because I think there's a lot more trouble coming to the plate. And Tesla, I think what Elon's saying is going to sharpen up the board on Tesla. The market's going to take it negative because they lowered prices again to gain market share. I used to do it all the time. I had both of my businesses. The janitorial one and then the picture frame industry. I was very competitive because I lowered what was a 600% increase in cost. I lowered it to $300 in my picture frame shop, which was like half price, and people were going, God, I can get that same molding for $250 instead of $5. So definitely be watching that Tesla today, but it's still going to have some hardcore bears on it. Coin hit my support. Got a 50% pullback on the run. Not going to say that's going to be good, but I need to blow my nose. One below here in Missouri. And I heard 5. Okay. I paper traded oil and gold this morning. Did very well in them. /CL. It's been very stubborn. Called it off this here 200 right here on the 1 minute. I tried to look at it on the 5 and I just couldn't find a good entry on the 5. Unless I would have took it off the 50, but it was so undecisive in here. And if I'd have waited for that 200, I don't think I'd have hit it till now on the 5 minute. But maybe I would have took it down here though. Maybe. And then we failed and I would have probably got shook out. I'm watching Lily. Sophie, I got 6 something for it to jump in this trade. Nvidia, the 200, see if that holds on the 1 minute, or that's the 5. Yeah. $5.46, I like it. Lily has a new high. Microsoft is the big pump right now. We got earnings list. Intel was on today. We've had a good pullback on Intel. Everybody's in Davos right now. Netflix, they were pumping Netflix last week. I got 485.55 as a support. IBM had that good run. They upgraded it. Morgan Stanley coming out with all these price lifts. They don't want this market to tank. Not at all. Sees better than expected earnings. Kept equal weight. IBM. Let's see if that's all time. Yeah, see, double top. They come out with a price upgrade. I'd like for these people to get investigated. AMD is popping. Now TSM probably will take a beating. They had earnings last week. did hit my support. NVIDIA leads AI chip rivalry with new GPU, while AMD and Intel beat big on AI PCs. Oh, we're open. Shit. Okay, we got a double bottom on SPX. And I'm watching oil / CL. What's on my charts? Got a head and shoulders, a couple of hammers on / CL. The 72.50 strike is the one that I did this morning. Another platform. $47.85 strike. They're pumping Starbucks. Okay, we didn't hold. $47.85 at $3. Learn to take your profit first thing in the morning. This next candle spike, I'll probably, if we can break here. Nope.
Post-close. Now that close itself is going to be a year. They do need China approval, and that may be one reason why you are seeing a fairly significant spread between ANSYS's current stock price and what the deal is worth. You did have these two cover bids there, though, so we can expect that this was the highest price they could get. The two companies have a 7-year partnership already, and Jim, what you want to try and explain is what is this all about? I mean, you've got a new CEO, brand new CEO, just took over January 1 at Synopsys. Not typical for a company with a brand new CEO to do a $35 billion deal, but they felt like they had to participate because this was the only time perhaps this asset was going to be available, given the timeline I just gave you. We'll know more when the proxy comes out, but the Cadence put it in place. So they get the deal done. They simulate a lot of things.
Got that wrong.
Company. Most importantly, and where the overlap is for 30% of their revenues, is they simulate the performance of, let's call it, chips, which get more and more complex every day. And, ANSYS has what they call world-class simulation and analysis capabilities, and they say that will enable the combination to provide a powerful and seamlessly integrated silicon to systems approach to innovation to help maximize the capabilities technologies, R&D.
3 black crows on the IWM.
So you want to understand how something's going to work. You want to understand the power consumption. You want to, so many different things. Simulation becomes very important, but not at the end. You need it throughout the process. You need it integrated essentially into the entire work environment that is producing.
Okay, we're at a double bottom here.
Chips. By the way, they don't just simulate chips. They simulate all sorts of other things, including, for example, for a Formula One car. They simulate the wind tunnels to see how it would perform. They simulate what the noise would be from a fan for heated seats in a high-end automobile. So that's 50% of their business is stuff that doesn't overlap at all with what Synopsys does, but will be doing now. And then there's an energy business as well, simulation, and some others that make up the rest of the revenue pie over at the company. But again, a company that we've rarely ever spoken about gets sold for $35 billion in cash and stock this morning.
Incredible is this. You mentioned another bidder. Synopsys and Cadence are considered to be maybe the most important ways to play AI, and they never get talked about.
No,
the Cadence is the wrapping of it, and that's something we're worried about with China.
NVIDIA's popped.
Fantastic company, so I don't know why they need to do this, but they're smarter than I am.
They felt like, again, it was an asset they couldn't let pass. Again, I
Then
pointed
there's
out
SPX.
have had what they call a successful 7-year partnership, and obviously that may have been one reason why the ANSYS management team did feel comfortable. Don't know the cover bid prices here from both Cadence and I believe Siemens also bid, but we have to assume they were less. We'll find out in the proxy. China, again, approval needed, so perhaps, there's always worries about that. But on the antitrust front, which you bring up a lot, Jim, doesn't appear that this is going to be a big issue.
I think it's really
and they're going to have what I think as much as $2 billion a year to spend in R&D, which in this area will be the largest single budget, is my understanding as well.
Well, look, I think this is the deal we have to follow because I think Secretary Raimondo does not want these companies to do as much business in China as they're doing. So this is a good opportunity for the Chinese to show whether that a Broadcom deal can they extend that kind of positive nature.
It always is concerning just because of the relationship between our two countries, but there's nothing on the antitrust front that would seem to
absolutely right.
I mean, I think it's 5% of their business in China. By the way, the CEO on the call, Sassine Ghazi, the new CEO of Synopsys, saying the combined companies enhance the ability to invest in AI and cloud solutions.
It's true.
Jim,
I mean, it's
which
not
underpins everything we do is another huge benefit to the transaction.
Not a press release. Actual. When I had Cadence on, again, I had Cadence on during that seminal CNBC conference, and Cadence spoke directly. Really, they're competitors. There's no other competitor.
Speaking of AI, we haven't yet touched on Elon Musk's comments about how he would like more voting control before he starts investing AI into Tesla.
I thought that I'm trying to remember a CEO who tried to get more stock because he wanted to have more. I don't know. I mean,
Well, I mean, the Google guy. I mean, Zuckerberg. You know, they.
About Warren Buffett.
Control.
Yeah,
He got 27% of Oxycontin.
Which he addressed, he talked about.
And he wants control over the AI that's being developed in-house there in various forms. He you know, now again, 25% is not control, but it kind of gives you what you almost call negative control. It's hard to get anything done without it, essentially. So he's at 13% right now. Remember, he sold down. He had as much as 22% ownership.
100 million shares.
And to fund the Twitter acquisition. Unclear what this means or whether he would conceivably, and I think this is the threat, as he says he's growing uncomfortable about it, move the AI efforts out into a separate company in some way because he would have more control. You know, there you see it. Tesla's not one startup, it's a dozen. Look at the Delta, what we do here. And he goes on to say something about showing up for work.
Right. Trigger.
Meanwhile, Optimus. I like to keep an eye on Optimus. That's the robot. It can now fold shirts.
It can?
Yeah, fold shirts.
And you got Deere and SpaceX.
Shirts. I think we may have some. Video of Optimus folding
Do we?
shirts. Yeah.
I'd like to see.
There it is. Takes it out.
This is
That's
about
not
as
moving-
high tech as it can
It's not
get.
moving that fast.
Because I
It does
can't
show
fold a
you
shirt to save my life.
Continued advancement in terms of its ability to manipulate its hands.
So it can do what my wife can do? Holy cow.
Wow, that was
out.
one of the more sexist things I've heard said on our.
I just said it. Just,
When's
she's in
the last
Mexico.
time
She
you
doesn't
folded
know
a shirt,
where I am.
Jim?
Yeah.
I actually, I did packing. I folded a shirt, and then they lost my bag, so it really didn't matter to them.
And there you go. And thank you, Optimus. Move on now. Please clean the bathroom.
Yeah, little scrub. Well, that's really impressive.
And to Carl's point, you saw Deere and Starlink,
Right.
obviously a separate company that is involved, it's part of SpaceX, which is controlled by Musk, and not a public company. But they're using Starlink for, I didn't know their digital efforts were so significant when it came to agriculture.
Yes, they are, and AGCO has something very similar, and this is because there's a shortage of farmers, and you really just want
Gold
to
took a
joystick
hitting.
what you do. I know you've never farmed, David. I have. You just go up and down and up and down. It's really kind of like you're trying to keep your mind on the work. You got music playing.
Now I
It's all
got just
very
under 200 on Tesla.
Yeah, it's a huge tool for yield management,
Oh,
as they say.
why? You can't get people to do that stuff.
But on top of the discussion between Musk and the board on ownership structure, a lot of notes here this morning, Jim. It's Wells. Will pricing pain start in Q4, referring to the OEMs in the auto business. They do expect Tesla to miss Q4. They're in line, Rivian, but below consensus on the other legacy OEMs.
Jeez, I know. Look, that group is trouble, and I don't see. I thought that when you saw a pivot away from the expensive EV losses to, say, Ford, my trust owns Ford, I thought that would be, remember, they're like 47 years straight, David, the F-150. But I also felt that they got a great hybrid offering, and they're making a lot of money on it, but it doesn't matter. People decide the cycle's over there.
That's it.
Yeah. Yeah, that's it. The cycle's over. I mean, that's how the street works. Like 6 cuts. We're not going to have 6 cuts, but we're going to have 6 cuts.
You think your general tone today would be different had the Eagles won?
No, I'm a Chiefs fan.
Long-time Chiefs fan? You're a Reed fan.
Hey, did our coach, wherever the heck he is, because he certainly wasn't as, well, never mind. Andy Reid mentioned me in his post-game press conference. I've not really gotten that kind of high sign from him. Coach, whatever.
Well, the game, Jim, was the most streamed event in U.S. history, 23 million viewers, largest usage of the internet ever at 30% of web traffic. And we don't know how many Peacock signups we got, but it was flawless.
It was flawless, and we're hoping it was a lot.
I thought it was, look, I was out there.
You can get it at a very discounted price right now.
I thought it was amazing. I sat behind Paul Rudd next to Clark Hunt. It was like the best promote I ever did. Comcast is down? All right, okay. I'm not going to say it. I know I'm not going to say that the sellers are fatuous morons. I'm just out of that game. I'm going positive.
Of course, there is that question of internet usage. Now, the fact is that Comcast actually is behind.
Now, they pumped Netflix last week also.
Signal, but let
Yeah.
John Malone, for example, say, hey, why isn't Amazon paying us a lot more money to deliver when we're the capacity required to deliver these kinds of broadcasts is enormous and strains the ability of the broadband providers themselves. In this case,
don't have an answer.
There's the content, but a lot of it's being distributed over Comcast
I think
wires, at least for your content.
if you're not
Meta
by
knifing?
7, your stock's kind of. I mean, like the Microsoft notes today were such suck-up notes, right? It's like this is the greatest raising price already, because they have something to talk about. They've got AI. You can have the co-pilot yourself.
The best performer this year, though, is by far is NVIDIA.
Well,
Jim Breyer once
I left
again
out
on our
NVIDIA
air
for 30
earlier,
seconds.
talking about NVIDIA very positively.
I check in with NVIDIA pretty much every day.
Yeah.
Because I lose in DraftKings, check in with NVIDIA, win there.
Breyer was talking about
Just right at 389 for Microsoft, maybe.
Well, look, I think that people are just beginning to realize
389.
25 to 27 times extra earnings. I mean, I'd rather be in that than any other stock at this moment.
AMD is actually leading the S&P right now. We got
doing
upgrades
great.
today of NXP and Western Dig, Jim. We had the upgrade of Qualcomm on Friday. There's some excitement around
Two
semis.
upgrades of Western Dig, which tells me something's clearly going on because that thing has been a complete bow wow. And I think that that's very positive. I think that something's going on with Western Dig. You just don't have two upgrades.
How am I doing these days when, of course, I questioned why you own Boeing, so you sold Boeing, you blame me for selling Boeing. Now Boeing has been down a lot. It's down another 4% today because of fears perhaps that the Chinese are not going to follow through as quickly as thought on what had been.
It's not has no.
It's a revenge trade going down.
It is,
because
God, come on.
I'm going to win the trade. I am going to win that.
It's not a revenge
I'm going
trade.
to go back to where I sold it.
Well, yeah, it's a revenge trade, that's for sure. That means you're making a false, you're only buying on hope. It has everything to do with them not allowing them planes in the air. And I think it goes way deeper than what we're hearing about. Because they're the way they're doing things, there's no way, if I was a picture framer, there's no way I'd hire somebody outside of my shop to cut the glass. There's no way I'd hire somebody outside of my shop to cut the mats. There's no way I'd hire somebody outside of my shop to cut the corners on the frames. I just wouldn't do it. I'd get it all done in-house. And that's Boeing's biggest problem. They don't have enough verification on what's getting put out. They just put it together. And that could be a bigger problem than what we're hearing about. And they were saying buy Boeing back when that news first came out, and I said, no way, I'd short it. So I've got an average of 220 on the SPX. I have to get out of this one and recruit, but every time I say it, boom. And the banks, I said earnings is going to be my catalyst, and the banks have done horrible. Well. Jimmy's going to have to go in big now. Market not doing too hot. $10.30, we got the 3-month bill action and a 6-month. All the other stuff's come out. GDP, and I thought we had the CPI in here. And what's going on? Yeah, house price index.
The NBC.
Take a look at some of the cannabis ETFs. Highest level here since, say, September of last year. On Friday night, we got that report from HHS arguing for a rescheduling of cannabis to Schedule 3. We'll see if that puts any pressure on the DEA, but finally some movement in MSOS. Dow down 255.
MSOS.
Tuesday. We're back in a moment.
Oh boy, shoot, finally. What are you talking about? Finally. Bunch of bull flags. Sudden alert at 3:05. What is this? Come on now, give me some big bucks on my SPX. I got two different trades going on here. $47.59. Oh, coin.
Offensively, I'd start with the offensive line. Defensively, I'd start with the defensive line. And then there were good individual efforts in there, whether it was George with a couple sacks that he had, Chris Jones, and those guys brought all their mad money with them.
Nice reference from the coach.
Coach is a great for Tammy Reed, his wife, who's really the CEO of the coach. These are phenomenal people. Clark Hunt, incredibly gracious. It was an amazing time. But it was really great to get a shout out from Coach Reed, whom I love and always have. And I am now an official Chiefs fan. How could I not? I have my Chiefs hat. And the Eagles have never even said hello to me. I mean, what the heck? I mean, that's just.
Oh, that's not true. Jason Kelsey said hello.
No, that's true. No, I just think that Andy Reid is really a fine man, and that's a great organization. I had a fantastic time.
There you are.
Look, I love the Eagles. It was tough. But you have your AFC team that you can root for.
He's retiring.
Yeah, he's just a great
Boom,
man.
baby.
Andy Reid is just, he's as good as it gets.
Okay, I'm going to go ahead and sell my
Fine people.
first ones here.
It's just going to get more exciting in the coming weekend.
Oh, it sure is. The Bills is going to be, that's a great game. But that organization, I mean, I can't rave enough about the Chiefs and how they treat people. It's just an amazing.
It looks like he had a great time. That was great stuff.
Mr. Hunt is just amazing. Fantastic.
Jim, we'll see you tonight.
Absolutely.
On Mad Money, of course, 6 p.m. Eastern time.
I'm surprised Jim Cramer didn't get jousted. Them Chiefs, they're racist. Tesla popping. See, I like Tesla when they cut the prices. They don't like it because they're fundamental traders. Well, it's going to cut the margin down. Let's say my picture frame shop was higher priced than the guy down the street. So they go down the street. They said, God dang, Jim's prices are $450 for that ready-made. You got this for what? $125? And you're throwing in free labor? Yeah, it just takes me a couple minutes to snap this picture in for you, sir. We're going to come back. Next time I'm going to bring 3 of them to fit in your ready-mades. While the guy up the street, he's got his for $500 a piece and he ain't making any sales. And then I get that repeat business. $185, time to escape the trade. And I'm done. I'm off to the beach. Hey, Porge, I wanted to let you know that I'm not, they kicked me off StockTwits. That's why I haven't answered to you.
Tuesday
They didn't like my Iger joke.
Walk on the street. I'm Carl Quintanilla with David Faber and Michael Santoli at Post 9 of the New York Stock Exchange. Sarah Eisen is on assignment. Got some weakness to start this holiday shortened week as we wade a little bit deeper into earnings season with the banks. We're watching Davos, the Red Sea, deflation in China, and some important Fed speak coming up.
They were asking this morning in Davos, or wherever you call it, Davos, or wherever they are, about this hiring people on the color of their skin and their gender. They said there's a lot of feedback. And I agree, I don't believe in that. And they asked this old lady, and she says, well, you need a little bit of oil to mix in with your spinach. And I'm trying to figure out, what do you mean by that? And then I had to go do something. I couldn't listen to the answer of what that other lady that works for the government said. Boeing's down to 204. I got 200. So that's the month. This is the yearly candlestick pattern. And you got a couple supports right here. You got 3 of them. And we just hit one. Each one of these represent a year. Each one of these candles. So your lowest support's going to be right there. $190.23. Next one's at 201. And the first one's at 208. So we're going to use the bottom of them yearly candlesticks for a support level. And we definitely got one right here at 196. Gosh. That was a nice trade. I mean, I had the cost average down, but it was well worth it. Oh, what's this here? I really like that 196.27. I really do. I think that's the one. It's got a 2-headed snake with a gap. I mean, if we get 196.27, I think I'd go long on Boeing. That's a triple top breakout. I really like that number. This has had a huge sell-off in 2 weeks. This is when I really like to shine. My best trading comes on knives. I really like that 196.27 big time.
Learned that much in the last 30 years, but I think one of the things I learned is don't fight that. And then the third.
Now I nailed these here bottoms. I mean these tops, the resistance level on the S&P and the SPX before year end, and I said earnings is going to be my catalyst. Well, so far they suck, the banks, and that was my leading catalyst to say, okay, so these idiots on CNBC had it wrong. They priced in 6 rate cuts. That's what they said in a way. That's what the market's telling them is what they said. And I'm just trying to emphasize how important irrational exuberance is. When you can see it on these guys' face when they're pumping, we're at like a double top, and then they come out with an upgrade. Oh, we're going to upgrade the stock to 350, and it was at $2.75, and we're at a double top. I think to become a good trader on that, you'd have to know how to play 52-week highs and listen to the mumble jumble. I just think I kind of think it's illegal sometimes. How they come in here and they upgrade something like they did NVIDIA for 7 months. We're going to 650 and we're going to 1250. Kathy Woods, Tesla, we're going to $5,000. When we were at $1,200, it went to $2,200. I've never have been
more attractive as you go forward. So
if there's no resistance to find, and I'm not buying their bull. If we had like a previous resistance of, let's say NVIDIA was at 550 and we had a previous high of 650 or 7, I would go for it and I'd believe it. But anything beyond that, I don't see how they can come up with numbers. But I've never have been a fundamental trader either, because I just think it's anything could happen. So I'm definitely going to set an alert down here for my 201.59, a little bit above it, on Boeing. This one, Kramer came out when it was at all-time high, upgraded the price, and then 3 days later, the bad news comes in. And I don't think these guys on CNBC understand how serious this is. Same thing with Disney. Nile's getting cheap. Nile's getting real cheap. 3-week sell-off on Nile. And what about AMC? Another pumper. This guy, he's really making himself look bad. So I had on YouTube, there's this guy that has an AMC sign in his background on the wall. He was pumping this at $6, saying he's loading the boat. They come out with videos one after another. And I blame wokeism on this one. What are these at now? The SPX. Dang. 215. Oh, there it is, 220. You wouldn't believe how much money I left on the table here. 500 plus 560. Just on one trade at a time, and this is how you play it. Right now, I know the earnings are bad, and we're going to have a lot of volatility. So we get these knives. These fat cats are going to buy the dip and scalp it. It's just a great opportunity when you're in a bull market, and these guys are very bullish. And I'm not. But I am if we get into it, like these huge dips. And I talked about it in my last videos. That's when we break out at open, expect to buy a put. And then when we break out down below opening, expect for it to run up once it finds the bottom. So we got the snake. I got in it a little too soon. Right here. Draw your snake out. Once your snake's drawn and we break out, look for the pullback or the chart pattern. Break out, pull back. Got a hammer, shooting star, a hammer, hammer,
ultimate goal in terms of coming to Davos? And what are you trying to do?
Well, first, when you went through that litany of things, it shows you why, for better or worse, we're in a growth industry these days.
Here's the guy that's starting all the wars around. Gave Iran $5 billion plus about $200 billion in oil subsidies.
So much of what we're trying to do around the world. Have everyone in the same place at the same time.
Right.
Not only convenient, it also creates some really interesting, synergies. Just bringing people together in interesting ways. Davos is a great place to do that.
Let's go down the list of maybe crises or big, at least hot topics that are being discussed here, starting with U.S.-China relations as it relates to the Taiwan election. New president in place. You came out with some comments congratulating him on his victory. What do you believe it means for U.S. and China right now? Does it up the risk that something's going to happen?
Well, look, it means a few things. First and foremost, we congratulated the president-elect, but also the people of Taiwan on their robust democracy and the great example that sets not just for the region, but for the entire world. When it comes to Taiwan itself and when it comes to cross-strait relations, we've been focused on one thing, and one thing intensely, with many other countries around the world. Peace, stability, no change to the status quo, the peaceful resolution of any differences. And there's a reason that matters. And it matters to virtually everyone here in Davos. You know this. 50% of the world's commerce every single day goes through that strait. The semiconductors.
I just can't listen to this guy. He's talking about peace, and he's got three different war fronts going on. The Red Sea, Israel, and Ukraine. I just can't listen to it. Bull crap. AMD popping. Now we got Apple. Came back and almost hit that 180. Tesla looking strong. Nice rebound in the market. Oh my God. Oh no. Oh, I love this stock. 290. So 10 times, I'd be up 8. Oh gosh. $3. My whole strategy was based on this. There we are, double top. So time for the put. Look at, let me see. We got to look for an indicator that's going to bring this put down. Dadgummit. Oh, shoot. Oh my, what? Magnificent. I want a good grade, but also want a point deducted. I gotta learn to stay in these trades longer. I bet you I'd be worth every bit of $20 million right now. Shit. The guy's still on there.
Around the world about how the Israelis are going about this and about the U.S.'s support for it, including inside the White House itself, with members of government literally walking off the job. I want to read you something that Speaker Johnson tweeted out in the past 24 hours. He says, any government worker who walks off the job to protest U.S. support for our ally Israel is ignoring their responsibility and abusing the trust of taxpayers. They deserve to be fired. What do you think of that?
Look, we've had, I can just speak for the State Department.
Oh my gosh.
People in the department since October raise questions, raise concerns, raise criticisms of policies that Israel is pursuing, policies that we're pursuing. And the kind of place that I want to have, the institution I want to have, is a place where people feel comfortable doing that. We have something called the dissent channel that allows anyone in the department to raise a concern. We've had a number of those. I read every single one.
Walking off the job.
Look,
fireable?
From my perspective, I want to make sure that people feel that they can say what they believe, express themselves.
But then, do they ultimately have to get behind the position of the State Department?
They ultimately have to be on the job and do their jobs. But the main thing is this: people feel the need to speak up and speak out. That's a cherished part of our democracy. It's a cherished.
Then why are you prosecuting Trump?
My view of patriotism, but people also need to be on the job, do their job. Look, we see this across many administrations. If their policies
This
and
guy's
administrations
so, I mean, he's so
that,
stupid.
Individuals object to in a way that they can't continue to work, well, that's their decision. That's their choice. They have to.
You're muted. You'll be kicked out of my room. That's a beautiful trade there. I could have added on. I don't know why I didn't think about it. That would have been a good spot. I got out right in time. And it pulled back to my support. I should have jumped on it right there. Sorkin's good. He's asking good questions this morning. I find it hard to believe, but he is. He's asking actually questions I want to know, especially about that hiring people on the color of their skin and their genders. That was good to hear coming out of him. That was real good. I've done it. I'm guilty of it. I mean, I had frame shop, and I had one black lady come in out of hundreds of people just for a job, and I hired her. But I didn't hire her because of her skin. I hired her because of her attitude. Every job I've had, that's what been my responsibility, is hiring people. I always had to find the ones that were the mostly qualified, and my second criteria was attitude. All the way from 1984. She's probably one of the best employees I ever had, too. I think Tesla's found some resistance. That's a beautiful run on Tesla this morning. Golly, man, look at that. $400. I'd been $4,000 right there on the SPX. And I took off 550. I took 550 and I could have got 4,000. Trying to figure out what kind of pattern this is. It's really not a pattern, just a little pullback bull flag. Or fallen wedge. That's what it is. Dang. Tweetly, tweet, tweet, tweet. I bet you Boeing's even bouncing off this. Nope. We're about there. They want 204. They want 203. Right now the tape is telling me it wants to get in at 203 at the bid on Boeing. Well, it did. Yeah, it is. We're getting closer. Let's see what happens here. January the 19th. The 205 strike. And the spread's not that bad. See what the NASDAQ stock looks like. 202. They want 201. They want to get out at 206. Okay, my alert was just triggered. Don't look now, Randy. God. You only get to deduct one. $5,000 in less than a half hour. That really sucks. And that's the way it's been all my life. I sold them other couple weeks ago, made 1,000 and could have made 50. I gotta quit thinking small. The way I used to think of it. I'm happy to get 100. I'm happy to get 2. Well, be happy and get 4. Thou. So we got to draw the snake out and prepare ye in the name of the Lord. Oh, there's the put. Oh, look there. Ah, what's it watching? 1, 2, 3. Dadgum, Jim. I think I'm going to go in the bathroom and urinate. Okay, I got an idea. So we've got a triple bottom. And we're going to draw a trend line on the triple bottom. This is on Boeing. And that's going to become our resistance. So we could be creating a head and shoulders if we break out of that. Once it breaks out, we want it to pull back to this here support line. Then that'll be our retest to run this back up to the 200 maybe. But this is Boeing. I shouldn't even be looking at it. But it's so inexpensive right now, and it has hit one of my supports. I love you, SPX. SPX, do you remember when I bought you a chocolate shake? See, this Davos, this is where all the CEOs get together and plan the year out. They make deals and they try to build enthusiasm in the market. And last year, a couple years they had it wrong, and they had it wrong last year. They were very bearish last year, and then we had that big run. And we already knew we were going to have the big run from the year before. Here's 3 white soldiers. So this year, they were wrong about the price cut, the interest rate cuts. As we know of now, we don't know that, but if we get 6, then they're 100% right. But analysts are never right. Anybody making money today? This is when your watch list comes in very handy, especially your favorites. Like if you're stuck in anything that dipped, like a Microsoft or an Apple. I can't be doing that on here. Jimmy called the double bottom here on the Apple. Snake breakout, pull back, double bottom, boom. Microsoft is being very pumped bigly, so you knew this was going to be a bounce this morning. You draw your snake out. There's just a lot of good opportunities on these top tickers. Leads out with 3 white soldiers, then consolidates into a symmetrical flag. Got an inverse head and shoulders, left shoulder, right shoulder, another head with a 1, 2, 3. That's a bear flag. BABA had 5% growth, their lowest ever. GDP. China. God, I can't believe I let that go. I'm still China. I can't get I can't get this off my mind. Okay, maybe we have a put here. I have a 1, 2, 3 on the top side. How dare you? How dare you? I dare you. If this keeps up, I'm going to become an environmentalist. Let's see how their Starbucks pump's doing. Yep, it's doing. Inverse head and shoulders. Snake, breakout, pull back, created the head, broke out. This is what I was talking about earlier on that other pattern. It established a head. This is kind of what I think people, when they're learning how to trade, is to try to predict the next move. This is a prime example right here. So you know you came out of the snake, you broke out of it, then you came back and created what I said earlier, a head. Then we pulled back and hit the head. the shoulder, the right shoulder. Inverse head and shoulders. Now, one would know that this would be in play because it got an upgrade. Goldman Sachs, dadgummit. Double bottom. That would have been a good trade. Earnings came out on it this morning. Then Morgan Stanley. They say they're doing better. Oh, I forgot about Dow. Okay. See, I always believed Dow was the worst to invest in, and then I listened to Lynn Zoid, and she mentioned that some of her friends love Delta. So I did some research this morning. I'm going to book a flight, and it was so easy and cheaper than other places that I've tried to book flights to. Mexico and Jamaica. If anybody's ever been to Jamaica, it's one of the best vacations you could ever have. If you like music and Dow. So we've got a head and shoulders right here. This is 3 black crows. If I remember right, it's on the weekly. Yeah, 3 white soldiers. 3 white soldiers. So we pulled back to the 200. We go back to that 180 day, 4 hour. I want to thank Randy for talking about the 4 hour a lot, because that's got me looking at it more often now. There's a channel. Kind of a pivot point at 36.39. Okay. This time, SPX. I don't know. Oh my. How much did they go to? I went to 650. That's all right. So let's look at the 5-minute.
In this country and did top last year's Saturday night wildcard ratings by 6%. NFL agent Drew Rosenhaus joins us this morning with his reaction to the weekend. Drew, great to see you. What a weekend. I hope you won't mind me starting up.
I think that was a good idea. That Peacock, you could watch the game for $5. I mean, I don't watch football anymore, but back in my prime, I would have went ahead and done that. But we also have it on the local station, but I think that would have been kind of fun to watch. I might do that if they got a boxing match. Peacock. That's a good way to get more revenue, especially on a day like this weekend when the temperatures are so freezing cold. I couldn't handle it sitting in the stands. I just couldn't do it. Not with my epilepsy, man. I'd go into convulsions. I'm tempting to go put here the 40. It's just a little bit far out. We got 5 minutes before the fat cats go to lunch. So I'm looking at the 47.65. Or I get 2 contracts of the 47.70. We got 1, 2, 3. Okay, here we go. Got 1 contract at $4. $47.70 put, Lotto, at $4. Hey Jude. believe that. Jimmy said these spreads would start to really look good once we hit that double top. Not today, not today, but back at the end of the year. See, I feel like getting out right here and watch this have a big knife. You say McDonald's, I can get a Big Mac meal for what, 18 bucks? So I'd be able to get 5. Maybe 4. Yeah. 4 Big Mac meals. There we go, 510. Ha ha. Oh, 580. Let's get it. This is a channel of support. This is the right shoulder. Oh. Oh. Okay, Jimmy's going to get out right here. Come on. No. Do it. There it is, about. Do I get a good grade? 100%. Oh, no. 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 God. Son of a... Oh, fuck. No. It went to 1340. Bitch. Dadgum. I heard cockroaches don't survive a nuclear war. Can survive a nuclear war. Good alert, Mike. Look what Mike wrote in the room here. I want to give kudos to Mike and give him an A+. We don't grade Mike much because he really doesn't need it. Now, don't get too froggy in this today. As far as I care, earnings sucked. Good alert, Mike. As someone in the room, you people on YouTube, you want to keep track of the calendar. We got a lot of Fed speakers coming out today. And you always want to look at that calendar when you come in first thing in the morning, get some kind of clue what kind of day you're going to have. When we have Fed speakers, they all have different opinion, or whatever you want to call these people. So you just got to be very careful when they start coming out. And you want to know what kind of market going on, like a CPI, or we got bonds going for sale today, and keep that time frame. You know, I always say 10 o'clock, right? What happened at 10? I know at 10 o'clock's the key day. Well, that's here in Missouri, 11 Eastern. So I've been here every day for 20 years, and I know what the 10 o'clock means to me, 11 o'clock, and I know what 12:30 means, and I know what 2 o'clock means. 12:30 is 1:30 Eastern time. So I got it broke down in different, how I want to trade in each period. Like right now, I'm going to go and make me lunch. I'm happy with this trade that I just took. I got out way too soon again, but I held on. I got more than what I could have. I was going to sell for $70, right? Instead, I got out with 100, 300 and 420, 100% gain. See this big hammer here? That's a buy indicator. You see the higher lows? That's another buy indicator. So we had snake breakout with a hammer into a symmetrical flag, which is an upside down pennant flag with two engulfing candles. It's going to come back here and retest. This is a SPX. So go to the calls. The 47.85 have dropped hugely. We do have a support right here. I see three of them suckers. So, like, let's say I'm looking at Dow. We got the snake. We draw out the snake. This is another thing to think about. The Red Sea, it could cause gas prices to go up, fuel prices to go up. Okay, here's the moving carefully with rate cuts. Did them people on CNBC have it so wrong? The 47.85 calls are bouncing up a little bit. I think some of the best advice I could give anyone is to always be the devil's advocate and do your own research and go with your own gut. If you don't have a gut feeling, that's part of trading. It melts down to karma. It's like this car I got right now. I'm not liking it because I think it could be like a head gasket in there that's going bad. So I'm raising heck with these people. I don't know if it's bad or not, but I just feel like it is. Or when I go fishing, what kind of bait am I going to use? Am I going to use my spot minnow, or do I need to use live bait? My gut feeling says it's time to catch the white bass, and I might want to use a float, some kind of float, and I forgot what they call them, jig, and then tie a little lure right behind it. We're using the right pickup lines. Like, say, baby, would you like to have a cup of tea and a donut? Oh, I was going to look at Lily. Man, look at NVIDIA. My God. NVIDIA. I nailed this one. I wish I'd have really nailed it with some good money. I told Kramer the end of last year on the last day that he's going to get his 650. And Kramer this morning got on CNBC, said, I look at it every day. I look at it every day. Nailed it. And what I really want to short is Eli Lilly, but I'm afraid to. I really want to short it bad. Just had too big of a run, too fast. And Intel CEO was on this morning, and it's had a nice little pullback. These are yearly candles. I forgot where my supports were. You can see if I got it again. I need to go up and urinate, and I'll be right back. Get back into this. Could have been a good day.
No, we're seeing, look, luxury is about scarcity. Luxury is about differentiated product and exciting product, and it's still there. What the online business has been able to do is it's created access and it's created the ability for people to be inspired and see things in a different way.
So what is the state of the luxury consumer? We got another warning from Burberry. Some of the European players and brands haven't seen things as robust as we have over the
Get
last
ready to
several
take
years.
profit.
What's your viewpoint?
Yeah, one, I always start with the luxury consumer is probably the most resilient. They are generally last in and first out of moments like this, and I think that's what we're seeing. We're seeing sort of, going back to the mean a little bit, and some of that spending that was happening is modulating. But I'm not concerned. I really believe that this consumer, as long as the product is there and the experience is there, they'll be there.
And there's a strong correlation with
They'll
what
be
you see for
there.
SAC sales and the market. So where is that right now?
Yeah, it takes a little bit of time. The positivity in the market has to move through. Luxury is a sentiment-based spend, so I think the consumer needs a little bit of time, but it's going to be there. The better the market, that means there's more deal flow. That means there's better operating margins on Wall Street. That means bonuses are higher, and it works its way through the whole luxury continuum.
What can you tell us about the holiday season? We've gotten some dribs and drabs from some retailers giving us at least a little bit of look at what they saw.
We have an expansion pattern.
Yeah, I would tell you it was on balance. I think, we came in, what I liked was traffic was there versus last year. We saw increases in our average order value, increases in our average unit retails. So the consumer was interested, the consumer was buying. Conversion a little bit down. We were far less promotional this year than last year. Felt great about our inventory levels coming in, and probably less promotional than even others in the space. So the margins were there. So sort of, I saw a little bit better than I was expecting, but it was more margin with a little bit more of a softening on the top line.
This is going to be an election year, and I know sometimes that can have an impact on your business. What are the expectations?
Well, we just need somebody to win, that's for starters, because in 2000, when nobody won, that was very difficult for us. Expectations are people are going to shop. They're going to shop because they're going to want to luxury is a good escape. We saw that during the pandemic, and I think we're going to see it again. We have to watch carefully. I think media costs and other costs during election cycles rise, and it makes it a little bit more competitive.
What did you just say?
We're thinking positive about the second half of the year.
A big theme here on the expo floor and really throughout this entire conference is AI in retail. What can you tell us about what Saks is doing or how you're using AI as a tool?
Yeah, we're pretty...
So you people on YouTube, I talk about chart patterns, moving averages, and being in the now. So just for example, I like to use the 1 minute quite a bit. I'm going back and forth now between the 5 and the 1 because I want to learn the 5 a little bit better. But I know the 1's always been very successful. So all I need is one line, and that's the 200 SMA when it comes to scalping, and the 9, and maybe the 21. So I know when the 9 crosses the 21 SMA, I know the trade's good. Then I can follow the trade up with a 9 and eventually get out of the trade. The 200 will also get me into the trade and get me out of a trade. So we got the 200 as a resistance and a support line on the 1 minute. I know it works because I've done it over and over again. So that's why I took that call, because we hit that 100 right here. Or the 200 SMA on the 1 minute. Now if I use the 5 minute, I'm going back, once I put these in here, I go to the 5 minute. I want to see what trade would have got me in sooner. And it would have been probably these 3 black crows with that hammer, which we already noticed this morning. And then maybe it didn't touch the 200, the body of the candle. Didn't touch nothing. So I don't know if I'd have took that trade or not. I probably wouldn't have, because that's a bear flag right there to me. Unless this was a tweezer bottom, and I could almost get away with that and took it right there. So definitely felt more comfortable taking it off the 1 minute this time.
Were business stops. Now 75% of our stops are residential stops. And so that's a fundamental change in how e-commerce is changing. So yes, it's a fast-growing thing. Of course, we have a huge part of our business is the industrial economy as well.
We talked a little bit about post-COVID, back to normal in terms of e-commerce usage. What are you seeing right now from the consumer and from retailers as far as ability to spend, behaviors? Feels like we're going through a lumpy kind of economic time.
Well, I'll just mention a couple of aspects of it. One is that during the COVID, of course, everyone stocked up on goods, and the services was completely down. Well, there was a period of reset in the last couple of years where consumers were spending more on services versus goods. I do believe that reset period is kind of over. The levels are normalized to where it was prior to pandemic. So the overall consumer spending is, I think now more balanced between goods and services. I would say that if we look at supply chains overall, the industrial economy remains challenged, and the demand environment is quite uncertain.
Very fascinating commentary there, Carl. I mean, residential historically has always been not as profitable as business. It really speaks to this incredible tidal wave shift we've seen in terms of business models for companies like FedEx and, oh, by the way, also UPS. Also thought coming out of this interview, something that was interesting was the fact that he's not seeing very much in terms of Red Sea disruption impact, because you would be expecting potentially to hear a company like FedEx saying that more goods are getting shifted over to air freight because of that situation. But he basically suggested that that's not really happening, at least not happening in a meaningful way.
Yeah, definitely a bigger story for Europe. That's why the commentary from IKEA and Tesco have outweighed the commentary here from, I guess, the likes of Chevron or Shell, for example, today, halting their transit through the Red Sea as for an indefinite period of time.
Yeah, huge story continues, one we're going to talk about a little bit more this hour. Also later this hour, though, value investor Bill Nygren adding a name in the financial sector to his portfolio. His fund is beating the S&P by more than 4% in 2023, so last year.
Plus, our coverage of Davos continues tomorrow with a number of big bank CEOs still on deck, including Jamie Dimon. That's coming up tomorrow morning in the 7 a.m. Eastern hour. We're back in a couple of minutes.
Did I just do what I thought I did? No. I thought I did so. Oh, God, there we go again. 235 to 510. So, do you know what I'm feeling right now?
Couple hours into trading, let's get post to post with Bob Bassani, see what's moving. Hey, Bob.
S&P still down, although some of the big tech firms still on the upside. NVIDIA, Micron, A&D having a great day. We're trying to make sense of a lot of these bank earnings, and it's been very difficult. For example, Morgan Stanley, we have these special assessment to the FDIC that's changing the earnings picture on some of these, so it's a little confusing here. But if you look here, Morgan Stanley was sort of one of the decliners on the S&P 500. Ted Pick's first earnings report as CEO. Revenues beat, wealth management's the key. These companies are about wealth management and then a little bit about capital markets and trading. But wealth management was the key. But the trading operations underperformed. Both missed estimates that we tracked there. Investment banking was a very, very small beat overall. So that's the story here with them. And if you look at the opposite story with Goldman Sachs, and they're essentially in the same business. Again, the big money center banks are about wealth management and capital markets and trading. Goldman reported a big beat here. Global banking and markets were
got a double top on the SPX.
David Solomon was on the conference
watch
call
puts
this morning.
here.
He said he was hopeful that capital markets activity, they make a lot of money on this, like debt, for example.
The 47.65
in 2024. We'll see about that. A little bit of a
double top
there on the IPO markets. We've been waiting for this for a long time. Still
oh damn it! I'm looking at the weekly.
Intelligible when you get into regional banks. I like regional banks more. PNC
yeah.
reported with regional banks.
Yeah.
It's a lot simpler overall here. You're dealing with loan growth and credit quality. And again here, the average loans for PNC were up 1.6%. That's fair, not great. Credit losses, though, well contained. They're not dramatically increasing the provisions for credit losses. So the two things that matter are fine. They're just not terribly exciting. Loan growth isn't particularly astonishing in that business here. They beat on the revenues. That's a good sign. We want to keep an eye on these revenues because some of these companies are reporting lower revenues. Net interest income was lower year over year, but it was better than some people expected. So it's a little hard parsing this in a simple way on the bank so far, Morgan, but I would say that loan growth has been fair, not great. There's not a big increase for loan losses, and overall that's good. But trading activity has been flat to down overall for those big money center banks that we talk about, the big six overall. Sort of a mixed picture for bank earnings so far. Morgan, back to you.
Well,
Mixed?
you did a great
They
job bringing all
sucked.
the nuance to us, Bob Pisani. Thank you. And of course, our sights now turn to the regionals. 41% of the KRE is set to report this week. It's time now for a news update. Bertha Coombs has that for us. Bertha.
Hey, Morgan. Former President Donald Trump back in court today as jury selection begins to determine damages in the defamation case brought by writer E. Jean Carroll. Trump's already been found civilly responsible for sexually abusing Carroll in the 1990s, and a judge found him liable for defaming her when she came forward with the allegations. Carroll is seeking $10 million from Trump, who said he plans to testify in his own defense. The trial is expected to last 4 days.
Oh, boy.
Prosecutors charged the man accused in the murders of 3 sex workers on Long Island with a 4th murder today. The new charges against him for the death of Maureen Brainerd Barnes were unsealed today. Detectives arrested accused serial killer Rex Howerman in July. He has pleaded not guilty to the earlier charges. And former Arkansas Governor Asa Hutchinson dropping his Republican bid for president following his 6th place finish in the Iowa caucuses. Former President Donald Trump won by a record 30-point margin. Entrepreneur Vivek Ramaswamy also suspending his campaign after finishing a distant 4th. Now on to New Hampshire. Carl, back to you.
Bertha, thanks very much. Foreign leaders reacting to the recent elections in Taiwan, including the president not supporting independence. What does that mean for the U.S. relationship with China? Former Commerce Secretary Carlos Gutierrez will join us next to weigh in.
We can come back down to the 200, I think, on SPY.
come.
European markets trading down this morning as investors digest some mixed commentary from ECB officials speaking at Davos. Germany and Finland's policymakers offering a more cautious outlook on cutting rates this year, while France's central bank chief expects a cut to be their next move. Bolstering the case for doves is a fresh ECB survey out today showing that European consumers have slashed their inflation expectations, expecting prices to grow 3.2% in the next 12 months versus 4% last month. But it has sort of been that pushback on cut expectations that has European shares lower today.
It certainly does. Well, not that different than the commentary we got with Waller today here in the U.S. Well, staying overseas, Taiwan's presidential election, the ruling Democratic Progressive Party winning re-election, escalating tensions with Beijing over potential independence. Our own Andrew Ross Sorkin spoke with U.S. Secretary of State Antony Blinken last hour about those results.
When it comes to Taiwan itself, and when it comes to
Darn, man, I even called that.
We've been focused on one thing, and one thing intensely, with
Look at that.
many other countries around the world: peace, stability, no change to the status quo.
Oh, God.
The peaceful resolution of any differences.
I've had enough of you today.
Flow of these elections. And then the other thing, I just listened to Secretary Blinken's comments. Those were very moderate comments. They weren't about bash China, but it was, let's keep peace, the status quo. If anything is going to change, let's do it peacefully. That is the right attitude, and that's what China wants to hear. I think the statement that President Biden made, which, by the way, every president has made, is that our policy is not an independent Taiwan. And that goes a long way in just keeping things at bay and keeping peace.
So how do companies think about this? How do boardrooms think about this? Because we have seen the shift, to your point, in narrative from not decoupling between the U.S. and China, but de-risking. And we do know, and you're a former Commerce Secretary, that the Commerce Department here in the U.S. has really been tasked with standing up, for example, a domestic semiconductor supply chain. That's going to take years to realize, though. So what does de-risking look like, not only from a U.S. standpoint, but also from a corporate America standpoint at a time where you do see this tension, and it is hard to decipher between rhetoric and potential action?
Well, I think, though, that is the challenge for executives running China, and that is the challenge to communicate to the is, you know, the rhetoric will be so high that there will be boards who say we have to get out, when the reality is that you don't, because what is being said is rhetoric. So observing, staying close to the embassy in Beijing, you know, those things have to become a priority for CEOs. CEOs have to be somewhat of, you know, diplomats and policy leaders as part of a big part of their job. Moving out of China, you know, as you know, with the chips, Taiwan Semiconductor tried this building a plant in Arizona. That's not going well. There have been a lot of union problems. The cost eventually will be 50% higher. They've done business with Japan. Japan will also be a higher cost. So that is a big issue, that it may just turn up that the best place for them to invest is in Taiwan. But that is an ongoing issue. But what you said about the boardrooms and explaining to the boardrooms that the flights and the balloons and the rhetoric and the military exercises are just that, and they are not an advance for a war. And that's going to be the tricky part. By the way, the U.S. also needs to play a role in making sure that President Lai kind of keeps his rhetoric low, because of all the presidents, the DPP presidents, he is probably the most out there in terms of calling for independence, in terms of having a verbal confrontation with China.
Carlos Gutierrez, former Commerce Secretary, thank you for joining us.
Thank you. Nice to see you.
The EU's antitrust chief warns that more regulation is coming. What does that mean for the Mag 7? We'll talk about that next.
Plus, a $35 billion deal to get chip designer Synopsys acquiring engineering and product design software firm Ansys in a cash and stock transaction, I should say. Synopsys is up. Ansys is down right now, but the CEO of Synopsys will join us on Overtime at 4 p.m. Eastern this afternoon. We'll be right back.
I'd definitely give Elon his 25%. He's the one that invented the company and started this AI and everything else. It could be a good catalyst, because they've been talking about, well, he's already got a good team at Tesla and he's getting ready to retire. And I watched him, listen to him speak about his space program, and he's really tickled about that.
Europe's competition chief meeting with some tech CEOs, including Apple's Tim Cook and Alphabet's Sundar Pichai in Silicon Valley and San Francisco last week, ahead of some new antitrust regulations going into effect. Our Deirdre Bosa sat down for a one-on-one with her for today's Tech Check. Morning, Dee.
Hey, good morning, Carl. So before Lena Khan at the FTC, before Jonathan Cantor at the DOJ, there was the EU's Marguerite Vestager, the original antitrust bulldog, who has taken on big tech and actually got results. She has been Europe's chief antitrust regulator for nearly a decade, and really she's the one that wrote the mega cap regulation playbook that laid the groundwork here in America, which is going to be increasingly relevant this year. Now, Vestager was in the Bay Area last week meeting with Tim Cook and Sundar Pichai, among others, making sure that they're getting ready to comply with the next battle, the Digital Markets Act, which she describes as a new era of regulation and a way to actually change, not just fine, big tech practices going forward.
The case-by-case approach cannot change the business model. You get the fine to punish past behavior, you're ordered to stop what you're doing, and you're told not to put something in place that will have the same effect. So of course it changes behavior. But what we have seen is that part of the behavior that we have punished, one, is reoccurring. So what the legislation will do is to enable us to have speed and much more efficiently to see if there is compliance. And we got more effective tools, fines for repeat offenses, doubling of fines if for repeat offenses that companies can be ordered to split up. So we have, more efficient tools, we have a clearer legislation. And since everything is digitalizing, I think the timing for this is also perfectly good because, well, now other companies have a fair chance of getting the better of digitization.
Right. Sounds more proactive.
Exactly.
A new age.
Yes, I hope so.
And with regards to that timing, of course, there's a number of antitrust battles set to take place here in America this year. Meanwhile, guys, the efficiency drive, that continues with Google planning to lay off hundreds of employees in ad sales after layoffs recently this year, too. Bernstein calls all of this the years of efficiency with an S, lasted longer than maybe folks had predicted. And as we've talked about before, there could be an AI element here. A survey unveiled in Davos this week revealed that a quarter of global CEOs expect generative AI to lead to headcount reductions. Our weekly Tech Check piece, by the way, looks at Apple's under-the-radar AI strategy. Check that out. More efficiency, though, this flight back to quality that we've seen this year, that's really underpinning mega cap market leadership. EVP Vestager's trip to the Bay Area. It's a reminder that antitrust is set to play a bigger role this year. And could we start to see that affect stock prices and the market? I don't think that's out of the question, guys.
I was just looking at a piece, Dee, in the Washington Post. This is from last week, but it's about Duolingo. And they call it one of the most high-profile instances yet of the company getting rid of human workers in favor of AI.
It's a perfect example of that, right? We say that it's the year of efficiency because that's what we've known over the last few years. But there's this other force at work, and that is the generative AI push that's making workforces more efficient. So that may not lead necessarily to layoffs. It could, but what's likely to happen and what I think we're already starting to see the beginnings of is sort of a slowdown in hiring. Generative AI is able to take on some of those back office tasks, especially in IT, that firms may have hired for. And that was exactly the Duolingo story, which I also thought was fascinating. Could be a precursor to some others. All right, one we'll continue to watch and certainly contributes to the soft landing narrative. Whether we talk about it regularly or not, it certainly contributes. Deirdre Bosa, thank you. Great stuff. TD Cowen upgrading BlackRock to outperform this morning. Oakmark's Bill Nygren also buying the stock. We're going to get to that and the other names he's picking up after the break. Don't go anywhere.
Well, Boeing went below my support. We got one more to go. Boeing stock enters bear market as FAA probe opens a whole new can of worms. Downgraded by Fargo Wagon. There it is. You're a little late, Fargo. Lowers the price from $280 to $225. You're a little late. You're a little late. Almost started singing there. When the fat cats stop pumping, that might be the time to start looking at it.
Back to equities to finish the hour. Our next guest runs a value fund which outperformed in both Q4 and the full year 23 despite the resurgence of those growth names in the most recent quarter, initiating some new positions in some names in financials, payments, and energy. Oakmark portfolio manager Bill Nygren joins us this morning. Bill, always good to check in with you. I know you got some thoughts on names that you think the market is ignoring, and one of them just had earnings on Friday. You want to talk a bit about Citi?
Sure. Citi is one of the banks in an industry that's out of favor. It's one of the names that's left for completely dead.
I thought Citi had earnings.
Stock's down over the past 2 years about 20%, and I think down over the past decade as well. Jane Fraser took over about 3 years ago, and at Oakmark we think it's interesting that lots of times when there's excitement about a new CEO, by the time that CEO has figured out what they're inheriting, what has to change, they've changed out the next layer of management, that management starts making their changes, and a turnaround is about to take place, Wall Street's given up on it. And we think Citi could be in that position. The stock sells at a bigger discount to book value than the other banks. It sells at about 4 to 5 times the earnings level that the company thinks they'll achieve in a couple of years. And Jane has just gotten rid of about 10% of the labor force, created 5 divisions where there's more accountability than there's ever been at Citi. We think that's a pretty good setup and a very cheap stock price.
Let's talk a little bit about GM as well, Bill, because that's been a name that's not been so loved as of late, but you're bullish.
Yes, and it's
why?
been in our portfolio for a long time, and it hasn't done us any good. It's about the same price it was 10 years ago.
Exactly.
It trades at about 6 times earnings. And I think management there was embarrassed when Berkshire Hathaway sold their stock because they didn't have confidence in them. And it's completely changed the way they think about their free cash flow. The company's recently announced a share repurchase, about 20% of the shares to be purchased over the next 18 months. And importantly, that should come mostly from free cash flow. So it's not like the company's levering up to make that repurchase. The big knock on GM has been the way they've invested capital has not increased shareholder returns. And if that money is coming back to...
It makes no sense to have a repurchase program when you're going to supposedly turn your factory into EV cars only. It makes no sense. She only said that so she could get somebody interested in buying that stock when it was down at $24. This, like he said, it's been more than 10 years since this company's done any good at all. It was in everybody's portfolio long term, and one day we're going to bounce.
Ryan Lance took over the CEO position there about a decade ago, back when ConocoPhillips had a reputation of not being a very good capital allocator. Ryan has shifted their capital allocation philosophy toward investing in projects that have good rates of return, even at lower oil prices. And with them having been doing that for about a decade and then returning excess capital to
27 cents a share.
We think they were a trendsetter because that's starting to become popular across the industry. But with a decade of that in the rearview mirror at Conoco, we think it's one of the...
The only time it ever bounced was when I alerted this before it happened. And I said, Biden and his EV deal, he's going to be pumping EVs. And we had the bounce. That's the only time it's bounced in 20 years. Then we had the Obama crash, where it was at 27 cents. I did well on that trade. They got bailed out. And the same thing going to happen here. They're going to get bailed out again.
We've never been, we've never endorsed the idea to give up on the ICE business. We thought the transition would take a long time, and I think the market is seeing that. The convenience of EVs in the flyover states is not nearly what it is on the coasts. And I think General Motors is in a good position to be able to reap profits from the existing ICE business and yet still be ready for a conversion to EVs when customers are ready for that.
Quick question for you. We've seen the stop, start, stop nature of value versus growth. I mean, is this the year where we're actually going to realize gains within value? And if so, how are you defining value? And I ask that knowing that in 2022, for example, you actually invested in some of the big cap tech names that were really beaten down at the time.
Well, let's hope this is a good year for value. I think when people are looking at money managers, they kind of have to look at the last 2 years together. The value outperformed growth by more than 2,000 basis points in 22. It underperformed by a little more than that in 23. And at Oakmark, we're really proud when you look at our 2-year record, where you kind of cancel out the headwinds and tailwinds of value versus growth, that we significantly beat the S&P 500, and importantly did it with less risk, because we weren't down as much as the S&P was in 2022. To us at Oakmark, value investing isn't just buying the cheapest PE and cheapest price to book stocks. We think buying great businesses at average prices is just as much value investing as buying average businesses at great prices. And that allowed us in 22, when the growth stocks were getting hit so hard, to buy companies like Uber at a double-digit cash flow yield, Adobe, when just 1 year of growth would bring its multiple down to the PE multiple of the market. Some of the software companies that were selling at large discounts on revenue to the top names in that industry. And also a company like Amazon, where on a price to sales basis, it was selling cheaper than the companies it's putting out of business. So, I don't think we're doing anything crazy in the definition of value. It's just broadening it beyond the simple PE and price to book metrics that so many traditional value investors use.
Bill Nygren, always great to get your thoughts. Thanks for joining us. And Carl, I'll be on overtime. We have a packed show, including, by the way, Deere's CTO Jamie Hindman on that SpaceX Starlink news that was announced today.
Big implications for ag all around the world. The judge is back. Let's get to post
What?
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Walker. Front and center this hour, the bull case for stocks, whether it is still intact. As earnings season heats up, we'll ask the investment committee. Joining me for the hour today, Josh Brown, Joe Terranova, Stephanie Link and Jim Leventhal. Show you what the markets are doing. We are red across the board. Right now, there are your losses. Dow's down about 0.5%. NASDAQ was in the green, not so much anymore. Joe, I feel like this is Waller giveth, Waller taketh away. Remember what he did to initiate the rally at the end of October? Maybe he's pouring a little bit of cold water on the idea of all these cuts coming. He said a little bit ago, yeah, we can cut this year. No reason to move as quickly or cut as rapidly as in the past. The timing and number of cuts will be driven by incoming data. Yields went up a little bit, and they're, I don't know, 404. There you go, 10-year.
I just wish we weren't in this place because there's been so much fundamental improvement from the fourth quarter in 2023 to where we are now. There should be more excitement. There should be more of a risk-on mentality. But we're in this place where we're debating whether or not we are going to have a March rate cut. And I think that's going to hang over the market in a way, in a mannerism that it's going to be very choppy price action. And I think that's been evident over the last week. Unfortunately,
we have a mole in the room. They're always late to the party.
Strong earnings
Always.
until you hear from technology and mega caps. Because certainly last week, while there was some good earnings, okay, to get excited about as it related to the banks, there wasn't enough there.
They were not good.
Okay, we're finally getting that broadening out, that dispersion trade that we got the glimpse of, we were tempted by in the fourth quarter.
Problem is, Steph, we pulled a lot forward, didn't we? We rallied so hard, so fast that, okay, we've been taking this pause. We've been chopping around, trying to figure out, where we are. Adam Parker, for example, makes the case. Look, I'm still bullish. The bull story's intact. Doesn't matter how many times the Fed cuts or exactly when they start. The fact of the matter is they're going to be cutting, and that's bullish. And margins are going to hold up for a lot of companies, and that's bullish. So there's no reason not to be bullish.
Right, and maybe we just pause until we get more of earnings. We've had less than 10% of the S&P 500 report, so you can't make a conclusive decision at this point in time. Yeah, we rallied 9% from the October lows, and we did see a broad...
They're excuses. It just drives me nuts. So Jimmy called the triple top at the end of the year. That's a hard resistance. Any trader knows that. The weekly, we double topped. Any trader knows that. All-time high. And to listen to these people on here making up excuses now. We had such a big run. Well, Jimmy said that when we were halfway up the mountain here. That I've never seen a run like this in the 20 years that I've sat behind this desk. I just get annoyed. I wish I was their chartist or a reasonable person at that desk. They were boasting about how they priced in 6 rate cuts. And I'm going, people, 1 is good enough. And Jimmy said earnings is going to be my justification if I think we're going to break out. These people are very bullish. They don't know how to let it go. But I've never seen a candlestick pattern like that in my whole entire life. One would say they're consolidating for a squeeze out. They just won't let it go. It's going to break out probably. I'm sure to say in another couple of weeks, about halfway through earnings, they'll start saying, well, we just one little... the bank earnings were horrible.
Talking about rate cuts. We're no longer talking about rate hikes. We're even talking about tapering quantitative tightening as the reserve repo market balance comes down. So that's a tone change. And in that tone change, in order to get a rally, good news has to come. Good news will be good news, which means, Joe, to your point, earnings have to come through. For me, that's the thing I'm looking at.
You know what the good news will be? a ceasefire, no war. That's the only catalyst. They won't say it though.
2.5% GDP, that gets you a decent top line number.
Plus
and the margin side
the
that we've been talking about for a while.
Exactly,
given the lower
Steffi. So
inflation.
to answer your question, I think UBS is a little, puffing their chest a little bit, but I can kind of get there. It has to come through in earnings. Has to come through in earnings. That's what this year is about.
All right, Josh.
That's what I said.
Your take is we eked out a gain last week.
We got a mole.
So we've been up 10 of the last 11, which is remarkable in and of itself. But now what?
Look, at an index level today, you can clearly see that while you've got some profit taking in some places, there are still plenty of stocks that are higher. But again, at the index level, it's just not necessarily being represented that way. I think people just have to get used to that. You can't expect every single day when you wake up for Microsoft and Apple to be racing to $4 trillion in market cap and pulling the rest of the market along with you. So you've got individual stories that just look incredible right now. NVIDIA and AMD stand out. These stocks just refuse to back off or give up any of their gains. NVIDIA now 563, AMD 158. That's its own world. That's its own story. And those stocks are not necessarily dependent on the Microsoft Apple index horse race. I find that to be really interesting. Another really interesting area to look at right now is healthcare. It's probably the most fascinating contrarian play for 2024. It's somewhat defensive, but then there's a lot of growth. The biotech names in the last couple of weeks have gone vertical. These stocks have sat out the rally for a long time. So I think that we just have to reframe the conversation about what is the S&P doing today and start thinking more in terms of, are there opportunities away from Apple, Microsoft? And if you can do that, you'll take the red days as they come because they represent opportunity.
Well, you make a good point. The problem, Joe, is one that I know you've been thinking about, is the idea of the broadening head fake, and that the expected broadening is slowing, and it may not produce what people thought it would, and thus we're going to be back to talking about the Magnificent Seven and the 493 others.
Well, I mean, that's exactly where Josh began his remarks. Josh is talking about Apple and Microsoft. I understand, Stephanie's point on the broadening out in the fourth quarter, but what I'm beginning to question is, was the broadening out in the fourth quarter just a cyclical recovery in the context of a larger trend, which is a downtrend? Or was it an inflection point where you could really say to yourself, the broadening out is real. Small caps are going to perform. Financials are going to perform. And I have to tell you, in the days that have followed, the money center banks.
You should consider choice three in that it was nothing more than a positioning run for the money at the end of the year. And that's it. And people tried to make it into.
Now, if it wasn't
one of those,
that's a great point. But if it wasn't just an exhibit in people chasing towards the ends of the year, what you should have had in the early days of January, and as long as I've been in this business, the early days of January are very critical in providing insight where sentiment is, where's optimism. So where was the optimism? Where was the money flow, all that fresh capital flowing into small caps, flowing into materials, flowing into financials? We just didn't see that. And I think the banks, I'm sorry, I just think the banks were disappointing.
Very good. Finally, someone.
Morgan Stanley, JP Morgan. I think the price reaction to the banks.
Finally, this guy's so honest. The banks sucked.
Now, the price action in the banks has been disappointing.
Yes.
To which Kramer this morning suggested, well, the banks fall no matter what, Steph. They ran a lot. He knew it, he said, when JP Morgan reported what he said to
That's
be
right. They have
one of
run
the greatest quarters ever, and then that stock rolled over.
They have run a lot because we called the bottoms on them. I mean, they've had a good run. There's no doubt in my mind. None at all. I mean, look at this. It took all year to come And then within 2 months, we're at a double top. So they've had the good run. There's no doubt. It's 100% right. And it was a short period of time. On a 3-year, you could probably go up more, but they're screwing so many customers right now. The banks are, with these high interest rates. So it's more than just about profit. It's about screwing people over. Oppenheimer maintains outperform, raises price target to $93. That's almost 100% I mean, Oppenheimer, 93, and then you get someone like Piper Sandler maintains neutral on Citigroup, raises target to 56. That's a huge difference. Evercore, all these Evercore 58 to 53. RBC raises price target to 60 from 52. And the earnings sucked. They were horrible. $163 to 84. They literally sucked. And you got just Oppenheimer raises a price target to 93.
But his point is the bread and butter business of Morgan Stanley still growing?
Hey, Judge?
I do not think that it's the bread and butter business. It's
Wealth
like
management?
50-50. The capital markets is a big piece of their
but
business.
I mean, they really put their hitch on
Hey,
the
Judge?
wagon of wealth management. Yeah, I'll get you in a second, Josh. Hang on.
The capital markets
All right.
is still a very big, important business for them, and they are actually outpunching their weight in that business. They gained market share. Credit management is structurally last year, it had a lot of problems, and I think that is poised to actually improve as you go throughout.
Hey, psst. Stephanie, they still have a lot of problems. They're the worst bank out there. Stop pumping it. If they ain't got their shit together by now, they'll never have their shit together.
Stanley was challenged by the same thing, to Stephanie's point, that challenged everyone, which is 5% risk-free rates.
Right.
And everybody saw redemptions. Just look at BlackRock. The money couldn't come out fast enough. So that was a cyclical challenge for the whole industry. The bigger problem with Morgan Stanley is it's now half the business, and it's really where I think shareholders felt a lot of the more stable growth would come from. We all understand that underwriting is going to have ups and downs. It's the nature of that business. Capital markets ups and downs. If they're not able to continue the growth at wealth management, the multiple should be lower. Let's throw up a chart of Goldman Sachs, because they didn't say the same thing Morgan Stanley said.
Well, I don't even have a
Goldman
wealth
Sachs,
management
all
business.
of the asset and wealth management division at Goldman Sachs, which the company is basically betting the farm on, revenue was up 23% year over year. Yes or no?
Goldman Sachs wealth management business is much smaller than Morgan
was up
Stanley's
23.
business.
Asset and wealth management division up 23% year over year.
much
That's all
smaller
I'm
base.
saying. And Morgan Stanley's was flat.
It's a much smaller base, Josh. It is. I mean, talk about
Sure.
capital markets. Like
Sure.
80% of their profits come from investment banking and capital
Exactly.
Isn't it going to be a smaller base
Goldman will benefit.
if you're looking to grow it? I mean,
To me,
Stephanie's got it nailed. Goldman Sachs is the crookedest bank. For many years, I don't know if they've changed, but you ought to see some of the people that come out of that bank. I remember them being like the biggest crooks of all as I was, watching the market.
right now you have other alternatives, and consumers have other alternatives because rates are so high. But as rates come down, with a savings rate of 4.1% and $6 trillion in money markets, that money's going to go somewhere.
Joe, why is Goldman up today, and the others are down?
I own them both. Recent purchases. Morgan Stanley, is down, in my view, because the wealth management pre-tax margin was not 30%. The pre-tax margin was in the low 20s. I think it was 24%. And on the call, Ted Pick didn't give anyone any degree of confidence that it was quickly going to return to 30%. Josh and Stephanie have identified the reasons why. Goldman Sachs, David Solomon very clearly said, capital market activity is improving. We feel good about it. That's why I own Goldman Sachs, and I think that justifies why Goldman Sachs is higher.
All right, your bank of choice is six.
Goldman Sachs investment banker sentenced. Ex-Goldman Sachs banker gets 3 years in prison. I can probably go year after year after year of how much fraud has come out of Goldman Sachs. And the people that traded, because they're an investment bank. She said 75% of them, they trade stocks. That's it. Insider trading, all the whole works. But I traded a lot.
Commodities, bonds, and stocks are going to be strong this year. That means assets under management at BlackRock are going to go up and the fees with it. We can argue about, hey, are people going to take money out of money market funds, put money into it? That, I think, misses the overall point, is that this should be a strong year for the markets. I won't go into it more than that.
All right, so Steph, you alluded to the fact that by trimming Morgan Stanley and Bank of America that you took that cash and you put it elsewhere.
Yeah.
The elsewhere is Home Depot, which you bought as a new buy.
Yes.
Why?
Last week. Well, I've been talking about it since December. I think I picked it as my final trade 2 times, even last week. I do think that the company this year is set up to do better. It was only up 10% last year, which is not terrible, but well below the market. And that's because they saw negative same-store sales for the last 4 quarters. And I think you're getting towards the end of that. And I think it's very easy comparisons.
I can't listen. 274 to 361. That's not 10%. It's broke out. If you ask me, it's already priced in.
You got a take on this, on HD?
Well, HD has developed really strong momentum. It's interesting because also Lowe's was included on that. Lowe's, from a valuation perspective, is much cheaper than Home Depot, but I agree with Stephanie. I would go in the direction of Home Depot. I really wouldn't go in the direction of homes on the potential home improvement.
I'm glad you brought that up. The fact that they say, after more than 4 years of preferring Lowe's to Home Depot, they think Home Depot's margin setup is better positioned.
Yeah, I think
4 years is a long time to be in on one stock over the other.
It is, but the premium valuation that Home Depot is being afforded, I think is warranted. I like their business model better, and I think their capture is going to be much stronger if, in fact, that home improvement trend begins to evolve as we move into the spring, and there's excitement that it's going to.
I think both are going to work.
You think both will work?
I do, but I think I like Home Depot better, obviously, but I think both are going to work.
All right, so that's a good segue for us, Steph, in terms of both going to work. Let's look at Apple and Microsoft, because we've been tracking the market cap battle, which has been Apple's, right? They've had the top spot for a long time now until Friday's close, where Microsoft was slightly ahead of that, and I believe it still is, as those stocks are vying for that top spot. As of 11:30, Microsoft was 2.91 trillion, Apple was 2.84. Now you have this report that the iPhone is being cut, the price cuts in China amid demand fears there. We've heard about market share losses, et cetera, around the iPhone in China, which is interesting. Josh, what's your take on this? Yeah, I don't care about the 3 trillion so much as they battle back and forth. But look, Apple has been a real good battleground stock since the very beginning of the year. It has not traded well. Technically, it's looked bad. You've had a couple of downgrades, more than you normally would see, maybe 2 or 3. But what now as it gets reiterated to buy at Deutsche and $200
maybe
is the price target for them?
Look, I think you can own both stocks. I don't think you have to pick one over the other. In fact, most investors have exposure
we got a
to
hammer?
both just by virtue of index funds or active managers who are chasing index funds. We all own these stocks. What's interesting about Apple versus Microsoft is that the trend has reversed in the last 3 years relative to the last 20. We took a look at this. Going back 10 years, Apple's market cap has been larger than Microsoft's for 2,225 trading days out of 2,500. So 88% of the time, Apple has been the bigger stock. Over the last 20 years, Apple has done 37% a year versus Microsoft 17. But in the last 3 years, Microsoft has been the better performer. And there are some reasons why, but I think when you are now looking at the opportunity, which one of these do I want to own more of, or which one of these do I want to be overweight or underweight relative to the index, Microsoft is probably in the driver's seat for this year. This is going to be a huge year for AI. It's not that Apple won't play there, it's that they're just not associated with it. And Microsoft has already been pulling a lot of important levers to make sure
Oh my
that
God.
they are,
You
at
kidding
the
me?
forefront of a lot of what investors are going to be looking for. So I think that that's really how that question will be answered this year.
I want you to answer another one, Josh, because
On the SPX puts?
veterans, you know, they're like, okay, we're going super provocative this week. They say they're going to build a better Magnificent Seven. So they take out Apple, and they take out Tesla, and they take out Meta, and they say, okay, now it's Berkshire, Visa, and UNH replacing those three. I know you own Berkshire, so you got a dog in that fight, but what do you make of that? That just because the Mag 7 was what it was last year, doesn't
It
mean
is
that it
what
needs to
it
be the
is, and I
exact same
thank
this year.
you.
Sure, some stocks in it may do well, but not all.
Oh, I agree. And these are individual companies with their own individual cash flows and their own individual valuations, and there is no rule on the books that they all have to go up or down, or that they all have to move for the same reasons. So I totally agree with that. Barron's is writing for an older, more value-oriented audience, so it totally makes sense for them to pull out Tesla and put in United Health. I don't hate the idea. I think as an investors, we should get less excited about acronyms or groupings and just really focus on what we're doing and why. And a lot of times when you do that, you start to realize a lot of these contrived, groupings of stocks really are coming from a place of like journalistic interest more so than they're coming from the perspective of what makes sense for my portfolio. Okay. Yes, we need a term to write about these unbelievable performers in a catch-all kind of way that's shorthand and everyone knows what we're talking about. I don't have a problem with that, but that's not how you invest.
I got you, but it's work, right? FANG, Mag 7, but you get the point.
I just want to point out one
Last
thing.
and quick.
On Apple, really interesting. And look, don't start sending me stuff on social media. These are just the technical facts. Number one, it's approaching the 200-day moving average. Take that however you want. But more importantly, last July, the NASDAQ came out of its earnings recession. You finally had earnings growth. Take the Mag 7. Every stock, Mag 7, is above where it was when the NASDAQ broke out in July, except Apple. Apple is the one name that is below where it was in July. Everything else has broken out.
All right, it is down today by just shy of 2%. We'll take a quick break. When we come back, more stocks on the move today. A pop for Synopsys. Got a deal, some deal talk there. We'll trade it because we have ownership. We got a drop for PayPal. Those trades and more just ahead. And later on, legendary energy trader Mark Fisher. He's going to join us live. We'll get his commodities playbook for 2024. And nat gas is an interesting play today. Oil's moving as well. We're back in 2.
Yep. Last week's session was about creating a watch list. So if you listen to CNBC, they talk about the same stock day after day after day after day after day after day. They talk about the same ones. Right now, I can't believe them puts. Again. Another sucker punch. Bad gum. Time to add. Oh, well. Netflix has pulled back. This is one of their pumps. Netflix. God darn it. Well, I got sucker punched here. I'm down 75 bucks. I saw that right there too. See if it holds that number right there, 59.38. Well, what to do? You know my other support either. I could buy 4 here and I'll have a total of 5 of them at 165. Oh, drugs. Missed the article.
Out of the fight over bathroom access for transgender students, rejecting an appeal from an Indiana school district. The rejection leaves in place a ruling that allowed a transgender boy to use the bathroom in accordance to his gender identity in a middle school. The decision keeps litigation in lower courts for now. And Philadelphia Eagles center Jason Kelce reportedly told his team he is retiring. League sources tell ESPN that Kelce, who is considered one of the best centers in the NFL history, made the announcement in the locker room after the Eagles' wild card playoff loss to Tampa Bay last night. Scott, I guess maybe he'll be joining Taylor Swift to watch his brother in Buffalo. That's going to be a big matchup, the Bills versus the Chiefs.
No doubt about that. First ballot Hall of Famer. We congratulate him on a great career, of course, if in fact it is true that he's retiring. Bertha, thanks. Coming up, trade school is in session. Josh Brown says there is a, quote, guaranteed bull market in one sector. He'll tell us where that is and the stocks he is betting on to play it. We're back in just 2 minutes.
Well, at least we had one honest person in there about the banks. I thought they were horrible, the earnings. And that's my catalyst for being bearish. But still, when it's all said and done, if it's 51% better than 49, they're going to run with it. And I'm even to the point where I think if they're worse, the earnings are worse than that, they'll still run with it. Because these guys, I mean, they're arguing, fighting, mad that we've pulled back. And it was so easy to see, market-wise. And I listened to someone else talking about, what's it, Ives. I'm trying to think of his first name, Ives. Burr. Ives, what's his name?
So you're from Long Island?
516, man.
Where?
You couldn't tell based on the, or you could? The accent.
Not really. I don't know. I guess it sounds.
Dan Ives. I forgot what I was saying now. Dan Ives. Tech, yeah. He follows tech and tech only, and I've been a tech trader forever. Ever since Tesla. And ever since the .com era. Now we got AI. It's always something new with tech. Looks to me like I'm going to win here. doot. Doot, 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 doot. Bull case for cyber stocks. FTNT.
It is a laggard by a lot,
Oh, by
right?
a lot.
When you look
Yeah.
at, these stocks have all done really well in tandem. But this one remains 23.5% from its 52-week high. Everything is basically there. Yeah, Josh.
Can we do a couple of tickers, because there are some names in this group that we never talk about.
Yeah, let's do it.
These charts are bananas. Let's put up CHKP. This is Checkpoint Software Technologies. This is one of the oldest granddaddies of cybersecurity. Back when we used to actually use the term cyber. This stock did nothing for a decade, and now look at it. It's going absolutely crazy. This is like the value play in the space. It's 17 times forward earnings. People thought of Checkpoint as a perennial share donor, meaning the new companies would just keep taking business from them. Something's changing there. Let's do Palo Alto. Joe should probably talk more about the stock than I should, because I know he's made money there. Look at this. Look at this chart. Where are the sellers? And then just one more. CyberArk, which I don't know that well. This is moving with the AI stocks. Very important to point that out. The stock made a
bring
high
it back.
in 2021, spent like the next 2 years consolidating, and at the end of Thanksgiving week, it broke out, and it just has not looked back. I don't know if I want to buy all of these at all-time highs, but these tickers need to be on people's screens.
Yeah.
CH,
We're looking at 1 year of cyber.
KP, and CYBR, and
Checkpoint
S.
we have in the JOT ETF. We've owned that for some time, in addition to Palo Alto, Fortinet, and then obviously I own CrowdStrike personally. Hack, which is the cyber ETF, is another way that you could play what Josh is talking about, and obviously I agree with him. Just keep in mind the expense fee is a little bit rich. I think it's about 60 basis points.
All right, coming up, we're going to get the trade on commodities too. Nat gas down.
There's a new watch list to watch.
Crude oil is hovering in the low 70s. We hear from legendary commodities trader Mark Fisher on where the energy market might head from here. Halftime's back just after this break.
Okay. Let's see if we get a nice little rebound here, and I'm going to be doing my thing, and I got somewhere in here, it's the exit idea. Maybe past the two, if we break the 200, we could have a 1, 2, 3 somewhere in here.
I need insurance.
He needs insurance.
We're back. Nat gas, well, it's sinking today, down more than 11%.
Woo!
It's been a rough start to the year, too, for commodities, with crude oil stuck in the 70s. Joining us now to discuss how to play it is MBF Clearing Corporation founder.
Yeah, that oil don't make no sense.
Happy New Year. Good to see you.
Hey, what's up, Scott? Is Josh there with you today?
Josh is there. Josh is here. He's just on remote, like you.
Hey, Mark.
Hey, Josh.
Hey, let's start with nat gas. So when I heard it was down a lot, I'm like, I don't know, why is that if it's so cold here and so many other places? Wouldn't you think it would be up a lot? What's the story?
Well, first of all, you know this theory that whatever makes sense never makes money, right? So that's first of all.
All right, so make sense of it for us.
Right. Second of all, last week, over this past weekend, the price of natural gas in January was probably trading around $8-9, while the futures for the next month were trading, $3.30. So again, you have this disconnect that now that the weather's actually here and the weather looks a little warmer in the next 10 to 15 days, people are pricing in the expectation of what's going to happen 10 days from now, not what's going to happen over the next 4 or 5 days, because that's the spot market, not the futures market.
Is there, what's the top end here? I mean, I just remember it wasn't that long ago where some of the predictions for where nat gas was going to go, I should preface that by saying not that long ago, like a year and a half ago, we're talking about double digits, and here we are under $3.
Right. Well, the whole world's getting spoiled by cheap natural gas, which eventually, once we ramp up LNG about a year from now, a year and a half from now, these days will all be over. But more importantly than that, Scott, there's an interesting opportunity coming up because, first of all, you had this rebalancing going on at the beginning of the year, which added all these, what I call perma-longs to nat gas and to corn and some other grains, where basically because of the rebalancing that took place, you have all these money, this passive money that's now, for lack of a better word, in natural gas and in grains for the remainder of the year unless people get out of the GSCI and the Bloomberg Index. Which means that unlike other times when people would go ahead and liquidate their longs on weakness, this passive money never gets out for the whole year. That's the first thing. Second of all, once this 3 to 4 day period of passive UNG money is over rolling, right? The risk reward to being short February natural gas is just not there, because why would you go ahead and be short Feb nat gas in the last week of when it becomes really prompt and becomes there, when you can go ahead and risk another polar vortex, which is happening now, come in February, which would be even worse, and you could probably risk losing $4, $5 to make 30 cents. It doesn't make any sense.
So what about oil? What's the best way for our viewers to think about crude, if not invest around it?
I think the best way to trade crude oil is to trade the products and not to trade crude. I think heating oil and gasoline, along with gas oil, offer the most bang for your buck, the most volatility, again, because there's no new refineries, because if you look at the cracks, they've held up pretty well. If you look at the refinery stocks, they've done pretty well, and so I would more focus on the refined products as opposed to crude oil, which kind of acts counterintuitively that when there's, political turmoil in the Middle East and everything, those markets don't usually respond positively, but yet the cracks tend to work better.
Okay.
But to me, the layup for the next week in terms of Josh, to me, is by the end of this week, I would think that the risk reward of being long nat gas and being long grains is probably a 3-to-1 trade to the long side. So that's what I'm giving. Well,
okay. All right. So then, Joe, take what Fish says from the product, if you will, standpoint, and then make it actionable for equity standpoint.
Simple. Marathon Petroleum Corp. Top performing energy stock in 2023, top performing energy stock so far. In 2024, you could look towards Valero, which I own. That's another way to play what Mark's talking about.
Josh, real quick, because we got to bounce. If you got a way to play it.
I think I just want to be long the producers. I own the IEO ETF. It's the simplest way for me because I'm an equity guy, not a commodity guy.
I got you. Hey, Fish, thank you. We got to run. We'll see you soon. I appreciate you coming on today very much.
Take care. Happy New Year.
All right, you as well. That's Mark Fisher. Up next, Mike Santoli has his midday word.
Technology.
We're back. There's your intraday of the 10-year note yield, and you can see it's at the highs of the session, 407.5. Mike Santoli, our senior markets commentator, is here for his midday word. So you can't say that Waller matters when he helps you out, and then say he doesn't matter when he hurts you a little bit.
Yeah.
And I think that what we just showed is a Waller bounce in the yield.
Largely, yes. And the bond market is also a little jumpier than you'd want to see. Volatility is a little bit squirrely at the moment. So I think people are kind of aware that we have a delicate spot. We're undergoing a little bit of a rethink. And yes, Waller matters on both sides of it, but the initial position of the market matters a lot too. And I think right now what you have is pretty much everybody gathered together and saying soft landing, huge confidence on the disinflation story. March rate cut is looking more likely than not. So we have a lot of things along that line you can be tested on. So I think that's what's going on right now. And I also think it's very nuanced. I don't happen to think that March cut is make or break for the stock market, but there are enough people who think it is, that in the short term it is. So I think that's where you come down. And there's this internal equity correction going on too, that the market's trying to keep at an internal level. Today, 85% of New York Stock Exchange volumes to the downside. Okay, this is a pullback day, but it's just not as closely reflected in the S&P because you got Microsoft and NVIDIA up.
Do you think it's a building effort among central bankers to talk the market off the idea that March is realistic? 'Cause
Or at least
it almost feels that way.
Or at least say we have 2 months of numbers that is going to determine whether March happens or not. And so, yes, I do think that there's a sense out there of we want to preserve optionality. We don't want the market to become a runaway train in one direction. But I don't think this is a heavy pushback. I mean, he's basically saying the conditions are there, and we'll wait and see.
Look, which he basically said before, it's just the market took the leap.
That's what it is. That's the initial condition.
Yeah, all right. I'll see you at closing bell. That's Mike Santoli. We'll do finals next.
Com.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
confidence.
All right, 3 o'clock Eastern closing bell. Hope you'll join me then. John Mowry, Cameron Dawson, and the Dean of Valuation, Aswath Damodaran of NYU joins us. Tell us whether he thinks the market's fairly valued, given everything going on, where rates are. Rates moving up, as we just showed you. All right, finals. Josh Brown, you first.
Another new record high for Uber. They're closing down the Drizzly app and instead bringing alcohol delivery into the main app. This is smart. Market likes it.
All right, as long as you can get it, right? I mean, does it matter what the color of the bag looks
That's
when they
right.
bring it?
Give me that hooch.
Jimmy. Visa, just one of those quiet, strong performers, should continue as the economy hangs in there.
All right, the Linkster.
GE Healthcare, mid-single-digit organic growth, margin expansion, 13% CAGR on earnings.
All right, Joe T.
I still think the SMH and semiconductors themselves are the place to be as long as the yields are going to press higher.
All right, well, NVIDIA's hanging in there, that's for sure. It's in the green today. All right, I'll see you on the closing bell. A couple hours, the exchange is now.
Scott, thank you very much. I'm Tyler Matheson in today for Kelly Evans. Here's what's ahead. A new Bank of America survey shows overwhelming optimism for a soft landing and record optimism on the prospect for rate cuts. But the Fed's Christopher Waller warning about cutting too quickly and too much. So how do you position against this backdrop? Our market guest sees 4 areas of opportunity. Plus a punch in the gut. That's how our trader describes what some of the bank earnings have felt like so far. But he's buying 3 of the banks, tells us which ones, and the one name he's avoiding right now. And some encouraging signs on housing. We'll check in at an open house and hear from buyers, and then we'll check in with a builder. The CEO of Taylor Morrison joins us live, but we begin with today's markets, and Dom Chu has all the numbers. Hey, Dom.
All right, so Tyler, it's been a bit of a whipsaw movement in the markets overall. It started off as generally a down day. We saw some moves back towards the session highs, and we saw some peaks of green for the NASDAQ composite, only to kind of head back down again. So generally speaking, we're off about 0.5% from the day so far. The Dow Industrial's down about 283 points, 0.75% decline there, so fairly significant. 0.5% declines for the broader S&P 500, 47.57 is the last trade there. And 0.5% declines as well for the NASDAQ Composite Index, 14,892, the level there. One place, though, that we are seeing some signs of life are in that technology trade overall. Now, it's a little bit mixed right now, but generally speaking, mostly in the green. Microsoft, NVIDIA, Advanced Micro Devices, Palo Alto Networks, and Arista Networks, all among some of the stocks seeing some real relative strength so far today. And by the way, for Microsoft, also we'll put a star there. NVIDIA gets a star, Palo Alto Networks gets a star, and Arista does as well, because each of these stocks made a record high at one point intraday so far today. So keep an eye on that big technology trade, still outperforming in certain parts of the market. And then, speaking of that technology side of things, if you shift towards cryptocurrencies, we are seeing Bitcoin prices back above that 43,000 mark. Remember, we did make a run at 48, 49,000 at the highs on some of the optimism around Bitcoin ETFs coming to market, but still a little pullback since then, up about 1/3 today. But Bitcoin prices, Ty, still a very big focus for some investors out there, given the recent headlines we've seen on ETFs. It's 43,000 and change. I'll send things back over to you, Ty.
All right, Dominic, thank you very much. A new Bank of America survey says 79% of investors are expecting a soft or no landing of the economy. However, cash levels are up, driven by a dip in optimism in bond yields. Our next guest says he's still a buyer of short-term corporate and treasury bonds. We'll find out why from Michael Cugino. He's president and portfolio manager of the Permanent Portfolio family of funds. Michael, good to have you back. Among other things, you say you like so-called dollar-based assets in this market environment. What are they and why?
Yeah, good afternoon, Tyler. Well, today, notwithstanding, as the dollar's gone up, I guess. But we tend to invest, most of our investors are U.S. based. So that's one reason. It takes away currency issues. It takes away the tax differential in foreign currency based assets versus U.S. assets. And also, we feel our portfolio is hedged. Whether the dollar goes up and down, we're not really making any bets on the dollar. We have assets that would do well in a declining or advancing dollar environment.
You also like strategic metals like gold and silver. Why?
Well, we think in the long term, the Fed is probably close to being done, if not done. And that's bullish for the precious metals, gold and to some degree silver. And also we think that declining dollar, increasing global demand over the next few years, the 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 economic activity relating to green assets, green energy, green general is really good for things like copper and other industrial metals. So we think there's a lot of tailwinds there, but you're going to have to be patient. So we like that. And so, yeah, I mean, so broad base. So we like the metals, whether they're precious or industrials.
Michael, we're going to ask you to sit still for a moment as we have some breaking news that we're going to go to Phil LeBeau for. We'll be back to Michael in just a moment. Phil.
Tyler, we are looking at a decision in the JetBlue Spirit merger case, and it is against JetBlue and Spirit merging. The DOJ victorious judge has decided this merger will not go through. Take a look at shares of JetBlue and Spirit, and that's why you see the reaction that you're seeing, especially with Spirit down, what, 47%? A judge, again, deciding that the DOJ has prevailed in proving that it would hurt competition if JetBlue and Spirit were to merge. So as a result, you will not see this merger between JetBlue and Spirit. Again, DOJ victorious in this case. Tyler, I'll send it back to you.
Is there any route of appeal for Spirit and or JetBlue here?
I would assume that there is, but I don't know for sure, Tyler. And then the question also becomes, if you are JetBlue and Spirit, do you want to try to pursue an appeal? This has been a long process, and even though people said from the beginning, look, with this, DOJ, that they were going to go against it, but they, remember, they had to outbid Frontier, JetBlue did, in order to get this Spirit deal announced, and Spirit agreed to it. So now the question becomes, do you want to go through that process if an appeal is possible?
I wonder if there is any partner for Spirit that would not arouse the ire of the DOJ.
Great question. In this environment, I have to wonder that too, Tyler. Look, the people at Frontier long believed that a combination between Frontier and Spirit would make sense because there was not as much overlap as there would be with JetBlue and Spirit. But at the end of the day, even with JetBlue saying, look, we will divest gates, we will pull back some of the exposure that would have been there, especially in Florida and parts of the tri-state area, that wasn't enough. The judge said, at the end of the day, this is going to hurt competition. I'm paraphrasing here. And as a result, the merger is not going through.
Well, if you're a holder of Spirit Airlines and you're long, this is not a good day. You're down 60% on the session. All right, Phil, thank you very much. Phil LeBeau.
But you knew it was a possibility, Tyler.
Oh, yeah, you knew it was in there. So, I mean,
what both airlines have to say.
Yeah, you got your eyes open if you're a holder there. All right, Phil, thank you very much. Let's go back now to Michael Cugino. Michael, thank you for your indulgence there. Let's talk about equities and what we've talked about bonds, we talked about dollar-based assets, we talked about gold and silver. Let's talk about your view in the equity market. You like energy and natural resources, semiconductors, and defense.
Yeah, it starts to go back to my previous point on the commodity metals, but I would also throw energy into that mix. We think fossil fuels are going to be around for a while. That transition to green is going to be slow. Global demand is going to pick up. The world needs oil and fossil fuels. And so, again, patient investor, these companies pay dividends. The total return, I think, in these stocks over the long term is really good. And that would include the industrial metals. We also like semiconductors, with AI going on. Specifically, we own, NVIDIA. And that trade we're generally involved in Palantir Technology as well on the software side. But we like that area. That's the computing power that needs to happen to keep technology advancing. So we want to be in that space. We like defense because Lockheed Martin, for example, because the world is a dangerous place right now and getting more dangerous, and that company tends to benefit from that. Positive dividend, big dividend, again, a total return play and a reasonable price. On the bond side, we didn't really touch on it, but the strong dollar situation helps lower duration bonds generally, and we like lower duration, high quality corporates and treasuries as well. We believe there's going to be a little bit more interest rate volatility out there before we settle in on lengthening duration too long.
All right, Michael, thank you very much. I appreciate your thoroughness and your holding on there while we had to break away. Michael Cugino with the permanent portfolio. Thank you again. Well, there's been pain and some gut punches. That's how our next guest sums up bank earnings so far. Goldman Sachs and Morgan Stanley, the latest names to report this morning. For more on his takes and trades, Let's bring in our friend Jeff Kilborg, KKM Financial founder and CEO and a CNBC contributor. He joins us for a special Free Buys and a Bail Bank edition. Let's start off with Goldman Sachs. Higher today after posting a revenue beat boosted by strength in asset and wealth management. Shares up more than 20% since November. You think it can keep going?
I think it can, Ty. And Goldman Sachs, we talk about them being one of the big banks. You have to remember that they do such a great job, and most of their revenue, nearly 45% of their revenue, is derived from trading. So they had a great year trading. Yes, they did lag, only being up 16% in 2023, but this is a name I think you can own. And I think the banks, by broad swath in general, you're seeing the gut punch being assessed by the FDIC, this one-time assessment. They're still bailing out SVB, Silicon Valley Bank. $16.1 billion. So the overarching theme today of all these banks being in the red is due to the fact that they have to pony up. And you're seeing Goldman push up about $529 million going into that insurance fund that got depleted from Signature Bank as well as SVB.
All right, let's go to Morgan Stanley, moving the other way after earnings revenues beat expectations. But that FDIC payout and other regulatory settlement cutting into earnings in the first report under the new CEO, Ted Pick.
Yeah, and I like Morgan Stanley here. I think if you look technically, Ty, it's right up against its 50-day moving average, potentially offering some support. But you have to remember, they paid $286 million into that insurance depletion. So you're seeing all these big banks, about $5 billion, really get a haircut today, or a 2x4 to the back of the legs, it feels like. And I think there's an opportunity, though, as you continue to see the wealth management side of Morgan Stanley grow and provide revenue. I think Morgan Stanley is another aim I want to own.
And the third buy on your list is J.P. Morgan, the sort of granddaddy of American banks.
It is, Ty. I mean, a market cap of nearly $500 billion. This is an essential 40 portfolio name. This is an essential bank to the U.S. economy. It's an American way of life. And you see revenue. They had one of the best quarters. And we go just back to last Friday, that trading action. That's what we look at when we're trying to trade this, have a better understanding. So in the wake of that trading report, which was phenomenal, that was one of the best earnings reports they've had, you saw it go up about 3%. And sure enough, as shareholders realized that they were getting a punch to the gut of about 74 cents per share, because they had to kick in nearly $3 billion to the coffers for the SVB and Signature Bank debacle we saw back in 2023. So I think you think about JP Morgan, above its 50-day, above its 2-day moving average, this is a bank we want to own. But if you look in the bigger picture, 2023, this was the best bank. This is the best bank of anything we talked about.
It's funny, I think
30%.
I think of being a shareholder in some of these banks kind of like being a member of a condo association where you get hit with an assessment at the end of the year to repair the curbs or something. All right, now for the bail, and that would be Bank of America reported last week missing on revenues as loan growth slows down alongside economic activity more broadly. Why the bail here on this one?
I'm bailing on Bank of America for a couple of reasons, but primarily, Ty, you saw last year when we saw interest rates move higher and the net interest margin, all these banks were doing the backstroke and swimming in cash in, you saw profits actually move lower in 2023. So that was a really hard pill to swallow as a shareholder of Bank of America. When you see that revenue drop the way it did, it was 50%. It was $7.1 billion. It went down to $3.1 billion in 2023. So I think Bank of America is a bail as they have a lot of hard months ahead to kind of react. But at the end of the day, they're coughing up $2.1 billion as well to put in this insurance fund at SVB and Signature Bank. And yes, I keep on saying SVB because I can't believe we're in 2024. We're still talking about that regional bank chaos.
Let's talk a little bit about the markets more broadly and how you assess the year so far and whether you think where we are in this working through of what I'll say is a bit of a step back from an overbought situation that with which we closed the year.
Yeah, you could argue that some of the earnings or some of the performance in 2024 was taken in December of 2023, but I actually think this is quite healthy. I'm actually cautiously optimistic. Yes, you're seeing the 10-year oscillate above and below 4% as we try and measure and gauge. Are we going to see a rate cut in March? Is it not going to be in March? But I think there's a lot of momentum, the trajectory. There's a lot of cash on the sidelines. So we still want to own the market here. I think it's an opportunity as we see some churning or some back and filling. This is actually healthy consolidation as we're about to make a move above 4,800 in the S&P 500, in my opinion. Lastly, look at the VIX. The VIX is kind of telling us those expectations are aligning with my view.
We talked about the banks there quickly. Do you think the banks, relative to the market as a whole, are going to be something they definitely were not last year, and that is outperformers this year?
I think they will outperform, but it's a really high hurdle to get over. You know, coughing up $16.1 billion for all these banks collectively, that really hurts. You're taking a bite out of profits, but I think this is going to be a one-time punch to the gut. So yes, I do think banks are what you want to own moving forward, but be selective. I don't think you can own XLF, the broad swath 71 holding ETF. I think you have to be very considerate, in particular in the names you own, like a JP Morgan, like a Morgan Stanley, as well as a Goldman Sachs.
All right, Jeff, thank you very much. Good as always to see you. Happy New Year. Jeff Kilburg,
Happy New Year,
KKM
pal.
Financial. And coming up, this weekend's snowstorm couldn't keep people away from open houses. Our cameras were there, and we'll bring you the latest on how home buyers are feeling about prices, rates, supply. And speaking of supply, we'll get the view from a builder as well. Taylor Morrison CEO Cheryl Palmer joins us next live. Plus, Houthi rebels ramping up attacks in the Red Sea following the American-led strikes in Yemen. We've got the fallout for oil and shipping prices ahead. The Exchange is back after this.
This is The Exchange on CNBC.
Welcome back to The Exchange. I'm Phil LeBeau with some breaking news regarding Boeing. Take a look at shares of Boeing as the company has named an independent advisor to assess the quality of its commercial airplane manufacturing business. The independent advisor is Admiral Kirkland Donald. He is currently the chair of Huntington Ingalls Industries. He will report directly to Boeing CEO Dave Calhoun. And again, this is a comprehensive quality review. Boeing announced last week that it was going to be doing this review of all of its commercial airplane manufacturing facilities, the process from start to finish. Now we know who will be leading that. He is an independent advisor. Again, Admiral Kirkland Donald, who is the current chair of Huntington Ingalls Industries, will report directly to Boeing CEO Dave Calhoun. Tyler, back to you.
I read an interesting article over the weekend, Phil, that had the opinion that because it appears that the problem with the door plug was a manufacturing-related problem, as presumably opposed to a design-related problem, that may make it, in fact, harder to fix, because a design-related problem, if you fix the design and then correct it on the individual aircraft, you're done. But here, you're kind of, if it's manufacturing, there's so many steps, so many parts, so many chain of deliveries that it's tougher.
It's hard to know for sure, Tyler. I'll take the counter argument to this. If it's a manufacturing and production issue, and they can identify exactly where what's gone wrong in the step from start to finish, then perhaps you can address it quicker. Bottom line is this: they still don't know exactly what caused the problems that led to that door plug being ripped off of the Alaska Airlines flight. That fortunately nobody was seriously injured when that happened. Once they find the root cause, Tyler, that goes a long ways towards saying, okay, here was the problem. Why did we not catch it in the process?
Well, it's a very interesting thing, because the more and more you read, the kind of systemic quality review that is seemingly being put in place here with this new independent advisor is what is needed at Boeing right now. Phil LeBeau will be following this into the future. Phil, thank you. Appreciate it.
You bet.
All right, mortgage rates well off their October highs, but are they low enough to get buyers back into the market? Diana Olick has the details. Hi, Di.
Hi, Ty, and the answer is yes. We're hearing from agents that there is a surge in interest from both home buyers and sellers, likely because of that recent drop in mortgage rates. The 30-year fixed hit a high of around 8% in October, then came down in November slowly and more sharply in December, now sitting around 6.69%. So, despite 4 inches of fresh snow and freezing temperatures, buyers showed up to this open house in Detroit on Saturday. The renovated 4-bedroom, 3-bath home is listed at $254,500, well below the national median price, but more than twice the Detroit median. Nikita Bell, who's currently renting, said the drop in rates got her out looking.
I have a home in Georgia. That finance rate I got way back when the market crashed, and it's at 4%. So I know I'm never going to get 4%. But what I don't want is 9, 10, 11, and 12. It is not a credit card. It's a house.
Now, a recent Fannie Mae survey found a record share of consumers think mortgage rates will drop further this year, and that may be why they're out now trying to get a jump on the competition. There is still not a lot for sale, but agents say they are expecting to see sellers get in the game also because of lower rates.
Because rates have changed somewhat, so sellers are feeling more comfortable now with putting more homes on the market. It's not going to be as reflective right this moment, but as we inch and get closer to the spring, you'll definitely see more homes coming on the market, as we've already seen over the last few weeks here, especially in the beginning of the year.
Now, the wild card, of course, is prices. They're still rising and the gains are accelerating. Detroit is now seeing the fastest home price appreciation of any major city in the country, beating out Miami for the first time, Tyler, because it's an affordable market.
Yeah, who would ever have thought that 5 years ago, 10 years ago, or whatever? Detroit now the fastest growing market in the country, price-wise. Diana, stick around as we bring in our next guest, who has her finger on the pulse of home buying trends as her company builds homes in 11 states from coast to coast to starter to luxury. She expects to see strong demand in 24, with foot traffic already up 25% in just the first 2 weeks of January compared with a year ago. Let's bring in Cheryl Palmer, CEO of Taylor Morrison. Cheryl, nice to have you back with us. We appreciate your time.
Well, thank you. Good to see you.
Yeah, it's great to have you. Have you ever thought of changing the name to Taylor Swift? Might help. Big branding move.
You know, I heard about that when we took the company public 10 years ago, and that was Kramer's recommendation, but we've held on to Taylor Morrison.
All right, well, good for you, and just putting it out there as a possibility. So are you seeing what we just described there? Increased foot traffic, increased interest among buyers, and maybe even sellers as rates come off the boil a bit?
Yeah, I think Diana said it very well, Tyler. I mean, we haven't reported our Q4 yet, but I think consistent with what you've heard in some market reports, you know, we saw rates really peak early in fourth quarter. And as Diana said, 8%, maybe even a little higher if you think about, you know, what par rates really look like. So today, seeing rates down under 7% is significant. And, you know, the builders have a number of tools in their toolbox. And I think our ability to assist consumers in today's market is critical. It's probably one of the differences between the new home market and the resale market. Yeah, I am I'm very optimistic. I think we have a nice, healthy backdrop for a very strong 2024.
I want to squeeze in one more question before I let the expert Diana talk to the expert you, Cheryl. But so you mentioned the tools that are in the toolbox. This is something that I've heard several times in talking to other builders. What are those tools? In other words, what should a buyer who is coming to look at one of your properties, what should they be asking for by way of financial assistance to help ease the buying process?
No, it's such a wonderful question, Tyler. And I would tell you there's a reason that we have to work with each individual buyer, because there's not one answer to that question. I mean, I think there's a reason we just got named America's Most Trusted Builder for the 9th year. It's because we don't paint all consumers with the same brush. We have so many programs in the toolbox. Some buyers might need help with closing costs. Some might need that certainty of a 30-year rate today, and so we can help them with a forward commitment and buying down that rate. Some want to build the home of their dreams and might not close for 6 or 8 months. So we have a program called Buy, Build, Secure that allows us to lock in below market rates for them. So it's really about us sitting down with each of our customers, understanding their needs, and putting them together with the right program.
All right, Diana, your question.
Yeah, and I want to talk about those rate buy downs, Cheryl, because we've heard a lot about them from all the builders across the board. That was a big incentive this fall to get buyers in the door, buying down rates as low as 5%. But how is that hitting your bottom line? We just saw KB Home report, and they had good sales, but their margins were not so great. A lot of that because of those rate buy downs.
Yeah, certainly, Diana, as you mentioned, with rates in the 8% range in the fourth quarter, those buy downs were a little bit more expensive. We've seen the cost of those buy downs come down quite a bit. So I think that when you look at all the ins and outs of what goes into that margin, to your point, and we look at some of the savings on construction costs, I actually think we're in a really good place. Each builder has a different set of programs, so it's hard to speak about another builder's report, but I feel actually really good about the trajectory as I report.
And just to follow on that, would you expect to see more price cuts? Because we're seeing that from other builders as well. And again, that hits your bottom line.
Yeah, I think it's very different by market. I think it's very hard, once again, Diana, to paint the country with one brush. In some markets, we're actually seeing prices go up. In some markets, we're pulling back on incentives because just by the cost of those rate buy downs, coming down, we're able to pull back a little bit. And we haven't really seen market price adjustments, I would tell you, for the most part, since middle of last year. There will always be certain circumstances, but all in all, I have a very constructive view on where we're going when I think about a positive momentum. And Diana, you know better than I do, when we think about rates dropping, I think it's, for every 100 basis points that we see rates drop, we see about 12% more consumers be able to afford a medium-priced home. So as I look forward, none of us know exactly what the Fed's going to do. We certainly saw, I think, some of that uncertainty today with the 10-year going up over 4. But all in all, I do think that we'll see, a steady rate environment in the 6s in 2024.
Diana mentioned, Cheryl, that Detroit has now become an extremely, prices are going up faster in Detroit than elsewhere. In your sales area, are there markets that are particularly hot right now and ones that maybe surprisingly are less so?
I can only speak to kind of what we saw last year since we haven't reported. And I would say generally same, but markets like Florida, Texas, Arizona, we've seen just very healthy demand. We saw, in the third quarter, a little bit of a slowdown, and I would tell you parts of the Pacific Northwest. We've seen our active adult business across the country do very well. And one of the things I'm excited about with rates dropping is I think, you really see that kind of first, second move-up buyer back into the market, a little bit more sophisticated buyer that just didn't want to kind of hold on to the highest rate available back in the fourth quarter. But I would tell you it comes down to communities more than markets right now. If you have good product to meet consumer needs in the right locations at the right price, I'd say we're seeing strength across the business.
Taylor Morrison, Taylor Swift, whatever. Cheryl, thank you very much. We appreciate it. Thank you so much.
Thank you.
All right,
Take care.
Diana, thank you as well. Appreciate it. All right, coming up, a rare sit-down interview with a regulator who has arguably taken the toughest stance against big tech. She's seeing results in new rules and multi-billion-dollar fines, so should Silicon Valley be worried that there's more to come? The exchange is back after this. All right, welcome back to the exchange. The market's right now in the red as we begin this shortened week. The Dow's low today was a negative 299. Right now, off that, down 227 points, or about 0.3%. S&P 500 down about half as much in percentage terms. Ditto the Nasdaq. 10-year yield back above 4%, climbing there after Fed Governor Christopher Waller suggested the central bank may be slower to cut rates than the market expects. And that having the predictable effect of sending rates back a little higher, above 4% in the case of the 10-year note. We go to Pippa Stevens now for a CNBC News update. Pippa.
Hey, Tyler. The GOP candidate debate on Thursday in New Hampshire is looking pretty empty, as Nikki Haley announced today that she won't be there unless Donald Trump takes part. Only Florida Governor Ron DeSantis is confirmed for the event. In a post on X, DeSantis wrote that Haley was afraid to answer the tough questions and that she was really running to be Trump's VP. Thousands of flights across the U.S. were canceled or delayed today as the winter weather continued to punish travel. According to FlightAware, storms in the Northeast delayed about 4,000 flights this morning. But that is an improvement on Monday, when more than 10,000 flights were delayed. And Sean Diddy Combs will part ways with spirits giant Diageo. In a joint statement released today, Combs dismissed his lawsuit against Diageo, and Diageo retained full ownership of Ciroc and De Leon Tequila. Combs filed the lawsuit against the distiller in May, accusing the company of treating his two brands as inferior product. Tyler, back to you.
All right, thank you very much, Pippa. And still ahead, 32 attacks in the Red Sea by Houthi rebels. The latest coming just hours ago, targeting a Greek cargo vessel. Up next, we will bring you the administration's response and the fallout for oil and shipping prices. The exchange is back after this.
NBC.
Welcome back to The Exchange, everybody. Crossing the wires just moments ago, the U.S. has launched a new attack against Yemen-based Houthi rebels. It is the third round of retaliatory strikes in recent days, but those strikes have apparently done little to dissuade the Iran-backed group so far. They've now attacked 32 cargo ships, and the hostilities have companies that operate in the Middle East on high alert. Here's what Chevron's CEO Mike Wirth told Squawk Box about how they're handling their interests in the region.
The risks are very real, and so much of the world's oil flows through that region that were it to be cut off, you could see, I think, things change very rapidly. Thus far, we've been able to maintain our movements through the region, and I think others have as well. But this is an evolving situation that we really have to watch very carefully.
Secretary of State Anthony Blinken also telling Squawk Box there will be further repercussions if the attacks continue, particularly because they're impacting the global supply chain. So what will it stop to take the Houthi missiles? Joining us now to discuss is Greg Brew, Iran and energy analyst at the Eurasia Group. Greg, welcome. Good to have you with us.
Thanks so much for having me on.
You know, I'm going to start with sort of the economic effects of these attacks, which are down near a pinch point in the Red Sea. Generally, you've got container and shipping prices. What's happening with them? What's happening with oil prices? And then what's happening to the supply chain? We read of companies like Tesla in Europe having to suspend production because they can't get parts as quickly as they need to. So start with container shipping prices, if you wouldn't mind.
Absolutely. So this is still largely a container shipping story. Well, we've seen a considerable increase in the costs that container shipping companies have to incur if they want to go through the Red Sea. This includes rising insurance costs, rising risk premiums, and that's a big reason why so many of them have opted for the last several weeks to send their ships around Africa. It's longer, it's slower, but it's safer. And this has led to increased costs to consumers. You mentioned the impact that this has had on companies like Tesla. This is also largely a Europe story, a North Atlantic story. Those are the markets that are being affected here. So the impact on container shipping has been significant. Thus far, we're still looking to see what kind of impact this could have on oil and gas. Obviously, this is the Middle East. Oil and gas is a huge factor as far as regional traffic is concerned. And the CEO of Chevron summed it up pretty well, I think. We're seeing an increase in risk, but so far, a lot of oil and gas is still moving through the region.
So if, I don't mean to catch you on the wrong foot here, but if you can put numbers on the difference in cost of sending a container from the Middle East into Europe using one route as opposed to the other, if it cost X 4 months ago, what multiple of X is it costing today?
Well, as far as the insurance, what I've seen recently suggests that companies have to pay as much as 1% insurance costs on what they're putting through in order to take on the additional risk. And 1% on a $100 million cargo is $1 million. So is a company willing to pay $1 million to cut a few weeks off of its transit route to incur that cost? You'd have to talk to the companies. As far as what they were paying a couple months ago, it was surely considerably less. I would say at least an increase of a factor of 3 or 4 as far as where the situation was a few months ago. So this is an increasing cost to container ships. Yeah. And also container shipping companies, as opposed to oil and gas, are generally risk averse. They don't want to see their ships getting targeted. They don't want to see their ships getting hit. So they decided quite early on to divert around Africa, as opposed to the oil and gas shippers who are generally more risk tolerant. They see the risks, they know what they're going up against, and they're still sending their ships through the Red Sea.
How do you analyze or handicap the possibility that the strikes on the Houthis, their military installations, ammunition depots, radar, etc., launch sites, is going to dramatically affect, cripple their ability to mount these strikes, which often are mounted via drones or via speedboats that are very hard to target?
Absolutely. I mean, you summed it up so well. When these strikes came last week, I don't think anyone was surprised. The U.S. telegraphed the strikes hours, if not days, in advance. Everybody knew that they were coming, including the Houthis. They had a chance to prepare. These strikes have continued, right? We've seen at least 3 rounds of U.S. strikes over the last several days. They're trying to hit the Houthis. The strikes that happened today were preempted. The U.S. caught several Houthi launch sites off guards and were able to hit them before they were able to fire off missiles. But the Houthis are well dug in. They have elaborate and sophisticated infrastructure in place to launch these kinds of attacks. When it comes to missiles, the U.S. can do a certain amount as far as hitting the launch sites, hitting the storage sites, but most of the Houthi attacks have used drones, which are very easy to store, very easy to launch in large numbers. Sure, they're easier to intercept, so the Houthis might have a harder time hitting passing ships, but I don't think these strikes will significantly reduce their capacity to launch these attacks. If anything, they may provoke even more attacks by the Houthis on passing shipping.
And they're clearly well equipped by Iran. They are veteran fighters, having been hardened through what has basically been a civil war and the intervention of Saudis on the other side to try and counterweight Iran's influence there. Talk to me about what you know, if anything, about the missing Navy SEALs who were involved in an attempt to board a dhow last week and disable it, which I think they were able to do, but at the cost, apparently, of a couple of missing U.S. service people.
Indeed. I think at this point, final reports on what happened to the SEALs, we're still waiting for that. We're still not sure what has happened to the 2 missing Navy SEALs, but it does speak to the lengths that the U.S. is now going to. Not only has the U.S. hit Houthi targets in Yemen, the U.S. is clearly trying to disrupt the Houthis' supply link to Iran. As you mentioned, the Houthis count on Iranian support. Iran has been backing them for years, supplying them with weapons, know-how, technical support. It's very likely that some Iranian vessels in the area, in the Red Sea, the Gulf of Aden, are supporting the Houthis by supplying targeting information so that they can, decide which ships they want to target. So Iran is deeply involved here. And the United States is trying to disrupt Iran's link with the Houthis without escalating, right? The United States is very concerned about escalating the regional conflict. It doesn't want to get into a shooting war with Iran, but it does want to degrade the Houthis any way that it can.
Greg, thank you very much. Love the work of the Eurasia Group and you and your colleagues. We appreciate your time today. Thank you.
Thank you so much.
Good. All right, meantime, analysts at Redburn Atlantic are highlighting one freight name they expect to benefit from the shipping turmoil in the Red Sea. That is the railroad Canadian Pacific Kansas City. Redburn expecting shippers to reroute from Asia to Mexico's west coast and use the railroad's new land bridge to move freight from there to the U.S. East Coast, saving up to 2 weeks on transit time. Shares are coming off their best month in more than a year. For the full story, including how much upside analysts see in that stock, go to cnbc.com/pro. And coming up, tech, one of the best performing sectors so far in this young year, but one of its toughest regulators has a warning for the industry. That is next. The Exchange will be right back.
NBC.
Welcome back to the exchange. Some of the so-called Mag 7 being accused of skirting EU digital competition rules in an open letter from a group of other tech and media companies today. The letter comes ahead of a key March compliance deadline for the tech industry. And our Deirdre Boza sat down with Europe's competition chief to discuss what's next. Hi, Dee.
Hey, Tyler, you're referring to the Digital Markets Act, which I will get into, but there's the markets as well. And it was a rough first week of the year for big tech, but we've seen a flight back to quality. The Mag 7, they continue to lead the broader markets. But what you're talking about, Europe's antitrust chief, Marguerite Vestager, her recent trip to the Bay Area, it's a reminder that regulation will play a bigger role this year. She's the original antitrust bulldog who has taken on big tech and actually gotten results. She was in the Bay Area last week meeting with Tim Cook and Sundar Pichai and others, making sure that they are getting ready to comply with that Digital Markets Act, which she describes as a new era of regulation. There is some skepticism, though, so I asked her how the relationship with big tech here has evolved and what makes her confident that they're going to comply.
It's difficult to say for sure because obviously there is some paying lip service. But I think in general, the atmosphere and the discussion has changed quite a lot. From the very early day when I opened the first Google case, walking up the hill in Washington, we say, oh my God, what's that woman doing? Now you have sort of a much more nuanced approach to say, well, when the digitization happens all over our industry, we cannot just let market power decide who gets the better part of this. So I think we have a much more nuanced approach. We have very active US authorities in the FTC and the DOJ. We have a very nuanced, proactive discussion in the Senate. So it's a completely different situation.
Meanwhile, guys, the efficiency drive, that continues with Google, the latest, planning to lay off hundreds of employees in ad sales. Bernstein calls it the years of efficiency with an S. And as we've talked about before, there could be an AI element at play as well. A survey unveiled in Davos this week revealed that a quarter of global CEOs expect generative AI to lead to headcount reductions. And I thought this was interesting. At Duolingo, it's a really interesting example here. The company is cutting contractors while leaning on more Gen AI to produce content. For more of our content deep dives, go to cnbc.com/techcheck/TC Weekly. Guys.
All right, Dana, thank you very much. And coming up, Peacock's $110 million NFL playoff bet. Well, it seems to have paid off. What the record-setting viewership for that Kansas City game means for the future of watching sports, as well as Comcast's position in the streaming wars. That's next. The Dow is off 306. Lodge.com. Now at session lows down 332. Welcome back, folks, to the exchange for a chilly Tuesday. Shares of Comcast, that's CNBC's parent, flat today despite making streaming history over the weekend. A record 23 million people watched the Kansas City Chiefs take on the Miami Dolphins in the first ever exclusive live-streamed NFL playoff game on NBC Universal's Peacock Saturday night with Taylor Swift in the house. It was also Peacock's biggest day ever, accounting for 30% of U.S. internet usage during game time. Think about that. Joining us now to discuss what this means for the NFL at the start of the playoffs and the streaming era is Barton Crockett, Senior Media Analyst at Rosenblatt Securities. Barton, welcome. I suppose Peacock passed the test. Not only did they pick up viewers, not only did they set records, they didn't crash.
Certainly. You know, they can take the ball into the end zone and spike it. They scored on this play. Can they uncork the champagne and say they won a championship? No. You know, Peacock is still, you know, they've guided for tracking losses around $2.8 billion this year. And the real championship is not only growing subs, but gaining profitability, and, you know, from that gaining long-term kind of viability. But I think what we see with this, with the consumer's willingness to sign up for a subscription service, put up audience numbers comparable to really anything we've seen on TV, is that the future of sports is streaming. This is where it's going. And Peacock, Comcast, they're players. They're able to put up some good scores.
Are the leagues going to find comfort in this? In other words, there was a worry that if you didn't have the traditional legacy players, and you'll still have them, Fox, CBS, ABC, ESPN, so forth, bidding for NBC, bidding for this content, and you were relying on streamers, they weren't going to be able to pay the same high prices that those other legacy providers had. This would indicate that the streamers are going to have the financial muscle, not just the ability, but the financial muscle to buy these rights.
Yeah, I mean, you've got a proof point here that the audiences on streaming can stand toe-to-toe today with television on premier sporting events. That wasn't the case a few years ago.
No.
It'll probably be more the case as time goes forward. With those eyeballs will come economics. So absolutely what you've done is you've expanded the universe of players that can bid for these sports rights, from media companies, which was yesteryear, to media companies and streaming companies today, which is great if you're a league. It's great if you own a team. Helpful for a couple of stocks I cover that are actually leagues and teams. That would be the Atlanta Braves and Formula One. So the sports story is certainly helped by that.
Mm-hmm. Let's look at the streaming services. We have a graphic showing the relative size of those services, and there are 7 on the board there. I would say 1, Disney, 2, Max. Paramount is part of a legacy company. Peacock is part of a legacy media company. And there's Peacock at 30 million subscribers, maybe ballooning some over the weekend because of that game. How many of these are really viable as we go forward here? I mean, are there going to be 7 major players, or are there going to be 3 major players? What?
Yeah, I think for players that are in the 200 million plus subscriber zone, there's only going to be a small number. Is it 7? Doesn't feel like that. Could it be 3? Yeah, that seems more reasonable. Could there be a handful of flanker brands that are in that 30 million zone? Sure. But Peacock's game, I think, is to be a little bit bigger tent than that. You know, so definitely, you know, one of the big kind of concerns has been that they're subscale. But the ability to, you know, their plan has been to leverage the TV network and invest in Peacock as kind of a flanker. And, you know, I think what happened this weekend is an argument that can work. And but they can't celebrate victory yet because clearly they're smaller and clearly they're still investing.
Yeah, and lost $2.8 billion in 2023 by all estimates. Barton Crockett, thank you very much. We appreciate your time today.
Great, thank you.
That does it for the exchange. Contessa Brewer is standing by, getting ready to join us here. I'll join on the other side of this quick break with the Dow down 320. We've got more market coverage coming right
Uh-oh, here we go again. 1, 2, 3. Did I miss any news?
Welcome to Power Lunch, everybody. Nice to have Contessa Brewer here. Thank you for joining us. I'm Tyler Matheson. Coming up, all eyes on China this weekend as Taiwanese voters elect the ruling party despite China's warnings. Plus, China's shadow all over the markets today, impacting the dollar, Apple, Nvidia.
And another controversial tweet from Elon Musk saying he wants more voting control over Tesla.
Expansion pattern.
Great ideas elsewhere. We'll get to that. First, let's get a check here on the markets. The Dow down 0.8%. You've got the S&P 500 off 0.5%, and the Nasdaq Composite off 0.5% as well. And Boeing shares also falling today. Look at this.
Duh.
They're down 23% year to date and off 8% today. It accounts for a huge chunk of the Dow's losses. The company says the 737 MAX jets will require additional quality inspections. Wells Fargo downgrading this stock this morning, Tyler.
All right, Apple also lower and hurting the major averages. It is cutting prices on the iPhone and other devices in China amid more competition. Concerns about demand in China also weighing on the stock there. So let's begin with China and the fallout from the elections in Taiwan, which went the exact opposite way Beijing would have wanted. Eunice Yoon joins us live from China right now with more. Hi, Eunice.
Hey, Tyler. Well, the person who Beijing despises, Lai Ching-te or William Lai, won, but he
William Lai?
in a crushing landslide.
Is he related to William Tell?
He got most of the votes, but not a majority. And his party, the DPP, actually lost ground in the legislature.
That's funny.
This didn't change the overall picture of what we see here in the relationship between China and Taiwan. Beijing is still very much fixated on Lai and the DPP. Which they appear to be convinced want to declare independence from China. Lai has said, though, that he has no plans to do this. And the government here has responded to the election this way, saying that the DPP doesn't represent mainstream public opinion in Taiwan. They said that the DPP win doesn't change the trend of the motherland eventually being unified. And the state media went a little bit further, saying that the DPP must accept the inevitable trend of what they describe as reunification with China. The Communist Party, of course, argues that Taiwan is very much a part of China. Now, for investors, this likely means more of what we've seen in terms of the relationship and the approach that China has taken towards a Taiwan under the DPP. This likely means no dialogue that we're going to see between Beijing and the DPP. Also, likely military intimidation, hostile rhetoric, and then there could very much be a more economic
Now we got a double bottom.
to taken against China, Taiwan,
So this is it.
as retribution for the result. Guys?
So, do you think that whatever China does, they may begin to do in the short term? Because Mr. Lai is not sworn in until, I believe, sometime in the mid-spring, maybe May. I don't know. You'll be able to tell me. Do you expect them to start doing whatever it is they're
Mr.
going to
Lai.
do now, or wait until he's actually in office?
It's difficult to say. A lot of people are saying that there is a waiting game until May 20th when William Lai is going to be sworn in. So people are kind of watching to see whether or not Beijing is going to be taking any action. There's been some discussion if the losses that the DPP had in the legislature could
double bottom.
change the dynamic in any way, because that means that the party, the KMT, that's being seen as friendlier to China,
take
might
small
have more
risk.
sway. But even that is very much unclear, because what we could see is the DPP brokering with the third party, the one that could be a little bit of a spoiler, and that they could act as some sort of a coalition government, and then Lai could still be able to have more control over his government.
Is it significant, Eunice,
went
that
below that
Lai
line.
has not uttered the word independence, apparently, that being a triggering word to
Double bottom,
Beijing?
125.
Not really, because I mean, the Chinese government just seems very fixated. Some would say obsessed with Lai and with his predecessor, Tsai.
Don't lie about it.
Especially with Lai, he even himself had said that in the past that he has been very much in favor of some form of independence in the past. So they've described him as an independence worker. They've framed the whole election as peace and war. And so because of that, it doesn't really make much of a difference whether or not he says independence at this point, or if he doesn't say independence. It's just that the Chinese government very much dislikes him.
Yeah, they know what he stands for and the words he has used in the past.
Right.
Eunice Yoon, thank you very much. We appreciate it. Appreciate you staying up for it.
Our next guest says, although China's reaction to the Taiwan election has been calm so far, there is still, as Eunice said, the potential for military activities in the near term. He warns there are uncertainties for companies that rely on China. Dewardwick McNeil is Managing Director and Senior Policy Analyst at Longview Global. He's also a CNBC contributor. Dewardwick, good to talk to you. What does this mean in the near term, you think, for this delicate balance that the United States has set up with China, especially because we've already seen today, China is pushing back, giving a smackdown to, say, Philippines president, because he congratulated the new winner of the Taiwan election.
Thanks for having me, Contessa. Look, I think what you are seeing here is that
We're at 185.
the geopolitical risk in the region remains high. I think we can all
Take profit here if you like.
A sigh of relief here in the near term that China's actions, although not its rhetoric, has remained moderate and somewhat measured. But as you pointed out, there's still a lot of risk here in the Taiwan Strait, but also in the South China Sea more generally with respect to the Philippines and the actions that's happening there. But I think China's going to have to be very careful here, Contessa. We are also in an election here in the U.S., and if things were to derail, if there were any missteps like the balloon incident from last year, there's not going to be any time to recover and repair this relationship like we had at the end of 2023.
Meaning what? That whoever would come into office next would do so having to crack down, but very publicly, against China?
Well, I think you're going to immediately have a situation where China inserts itself into the U.S. election in a way that's not advantageous to China. It will force the Biden administration to really move away from the spirit of San Francisco, as I call it, this commitment to open dialogue, to high-level meetings. And so if China is smart here, they would tread very carefully as we move through the U.S. election.
I wouldn't be threatening China, big guy.
Credit, their actions have been moderate. The rhetoric is overheated, but we can all breathe a near-term sigh of relief. But over the long term, businesses should still be concerned about the risk of a U.S.-China conflict or incident, particularly in the Taiwan Strait.
It's interesting because when I speak to high-level insurance CEOs who have businesses all around the world and they're keeping close tabs on it, the geopolitical instability is a worry for them. And what they say is you cannot disregard what's happening in the Far East, that what China is doing to set up its dominance in the world, the way it pays off other countries
so that they will disregard any claim to independence from Taiwan, that they will sever diplomatic ties with Taiwan, that it should not be disregarded. And at the same time, then you have China's premier in Davos telling the crowd of global businesses there, look, we're on track for, they said, 5.2% growth for 2023. That's the estimate that they're coming out with. Basically trying to reassure all of these global business leaders that China's a great place to find business opportunities. Is it?
Well, look, it's a mixed message for sure. And Li Cheng has certainly been the one deputized to carry the message that China is open for business. Look, what I say to companies all the time is you have to try and manage for these risks. You have to think about contingencies. I know de-risking is complex, it's hard, it may not be popular, but they should continue to try because these risks are very real. And finally, Contessa, I think, what I say is at least have a way in which you've thought about all of the possible contingencies and how this could go wrong. And I'm finding even some resistance from companies to even having contingency plans. And I think that's very dangerous, to be quite honest.
You're nibbling around the area I wanted to get your advice on, and that is, what would you advise CEOs of American businesses or global businesses to do if they are manufacturing in China, if they are selling and China is a major market of theirs? What is the posture? What is the footing that they should have? And when you say de-risk, there are lots of ways to de-risk. What are you describing there?
Well, it's a good question, Tyler. Listen, I think to the degree that if you're dependent on China for any major part of your supply chain, you have to start now. Take the space that we have now, the peace that we have now, to try and put in place ways in which you're not solely dependent, that China is your single point of failure in terms of your supply chain. For companies that rely on China as their market, this is a little tougher. But for companies that have China in their supply chain, they should start now. But Tyler, here's the thing that's important to point out to American businesses. Chinese businesses are doing the same thing. They are finding ways to duplicate and move things to Southeast Asia and other places because they also fear what may happen in the long term in this relationship. So I say to U.S. businesses, just look at what your competitors in China are doing. They're also moving some duplicate capacity in other places south of China.
Well, it's like the farmers' wives used to say, you don't put all your eggs in one basket.
Yeah.
You're welcome, Neil. Thank you. Appreciate it.
Good to see you. All right, the dollar hitting a 2-month high against the Chinese yuan. For more on that, let's get to Rick Santelli in Virginia, Chicago. Rick?
Yes, Tyler, whether you call it the yuan or the renminbi, both onshore and offshore yuan are at 2-month lows versus the greenback. You can see the chart there. And it isn't only relegated to that Asian currency. Let's look at the dollar yen. The dollar right now is at a 6-week high versus the yen. Now, with respect to the yen, the Bank of Japan missed a few chapters in the tightening cycle, and it doesn't look like they're going to enter it at all, potentially.
Market ain't looking too hot.
We all just heard the guess. There's a lot of issues there that are keeping pressure on their currency. The elections being the most recent, which had a dramatic effect on the pricing between where it was and where it is today. Now, if we look at interest rates in general, we have double-digit gains from 2s all the way out to 30s. Now, as you look at a 30-year bond, that's a 2-week chart. We've broken out to the upside. 30-year bond right now is up nearly 14 basis points on the session. And if you look at 10s and 30s, they're both hovering right now at 5-week high yield closes. And the dollar index is hovering at a 5-week high as well. And finally, 2s 10 spread. Now it's flattened, become less inverted by about 4 basis points today. It's hovering at -16. The last time it closed in positive territory, well, that was in July. But right now, it's the least inverted since Halloween. Tyler, back to you.
All right, Rick, thank you very much. Contessa?
We saw a big stock reaction a short time ago as a judge moved to block the JetBlue Spirit Airlines deal. We have more news coming out on that. Let's bring in Phil LeBeau now. Phil, what do you have?
What you have is a deal that many thought was going to face high chances of being blocked, actually being blocked. The judge ruling in favor of the DOJ take a look at shares of Spirit, because this is where we're seeing the most reaction today. Shares down.
Probably got damaged more.
50%.
Oh my God. Look at Save.
Blocks the Spirit deal. Take a look at shares.
I know
of
people that
JetBlue.
jumped into that deal.
DOJ
I said, don't do
win
it.
This case. By the way, this is 2 straight wins for the DOJ when it comes to
God.
blocking either airline alliances or, in this case, an airline merger. And the cost here for JetBlue could be significant. Even though the stock is up, this is going to be a costly decision depending on whether or not they appeal this and ultimately can reverse this at some point in the future. $3.8 billion deal with a breakup fee when they agreed to this in July of 22 of $70 million. That would be what JetBlue would have to pay as a breakup fee. And Spirit shareholders at the time were also going to get $400 million minus whatever payments were happening between July of 22 and today if the merger was blocked. So could be very costly for JetBlue. The airline's releasing a joint statement saying, we disagree with the U.S. District Court's ruling. We continue to believe that our combination is the best opportunity to increase much-needed competition and choice by bringing low fares and great service to more customers in more markets while enhancing our ability to compete with the dominant U.S. carriers. JetBlue's termination of the Northeast Alliance and commitment to significant divestitures have removed any reasonable anti-competitive concerns that the Department of Justice raised. We are reviewing the court's decision and are evaluating our next steps as part of the legal process. Take a look at the airline index. Why is it down? Do you think anything's going to change in the airline industry, at least under the Biden administration? They've made it pretty clear they're not going to approve any mergers if somebody wants to step up to the plate and propose a deal. So that's one factor, in addition to some other headwinds that are out there for the airline industry right now. Bottom line is this, guys. This is a big win for the DOJ. And again, the second time the DOJ has prevailed. They also prevailed in forcing JetBlue and American to unwind their Northeast Alliance. And so now they have that win, along with this win blocking the Spirit and JetBlue merger.
All right, Phil, thank you very much. Phil LeBeau reporting for us. Coming up, the Goldman Standard. Goldman Sachs blowing away earnings estimates. We will break down the numbers next. Plus, top executives weighing in across the network today. We will recap the key takeaways in 3-stock lunch, power lunch. We'll be right back.
asset.com.
Welcome back to Power Lunch. Earnings season heating up today with results from more big banks. Let's bring in Leslie Picker for more on Goldman Sachs and Morgan Stanley. Hi, Leslie.
Hey, Contessa. Yeah, Morgan Stanley results weighing on the stock today, currently down a little more than 5%. Most analysts have described the quarter as effectively just okay, and the stock reaction is reflective of that. There was a slowdown in net new assets into wealth management, leading to flat revenue in that division during the quarter. Here's the title of a note from Evercore ISI. They describe Morgan Stanley's quarter as, quote, similar to the Cowboys and Eagles. The potential is much better than how they ended the year. This, of course, was CEO Ted Pick's first earnings call, having taken over that role from James Gorman just 2 weeks ago. Pick was asked how he would describe his leadership style, to which he replied that he and Gorman are much more similar than not, noting that Gorman brings a, quote, positive mojo to the business. Investment banking revenue was up 5%, and CFO Sharon Yeshaya tells me that the backlog is a, quote, bright spot as they look forward. Optimism around so-called green shoots bolstered Goldman Sachs shares for most of the trading day, although they recently turned back into the red, down 0.3% right now. And that's despite declines of 12% in their investment banking division during the fourth quarter. Goldman CEO David Solomon said, though, on the call that the, quote, level of strategic dialogue has definitely increased. Asset and wealth management at Goldman was a driver of the top line there, with a 23% jump in the fourth quarter to a record $2.8 trillion in assets under supervision. Guys.
So, Leslie, we've heard optimism before about an increase in IPO and M&A activity. What's different this time?
Yeah, I think it was James Gorman who said, you know, if we did have green shoots throughout the course of 2023, someone forgot to water them. So the question is, why is it that we've been hearing so much about, you know, this pent-up activity and all of these discussions that are taking place across corporate America, but we haven't seen that real pickup in activity after several years now of depressed activity, at least relative to historical standards? One of the key reasons is, of course, the rising interest rate environment. Once rates start to level off, sources say that we'll start to see kind of that activity really start to filter through. Additionally, you've got a situation where people were worried throughout the course, at least of the first half of the year in particular, that we were going into a recession. So you don't want to do a big deal if you're about to go into this big downturn in the economy. It's hard to come up with a good price by which to transact. And so a lot of the CEOs have been kind of sitting these deals on ice, waiting for a better opportunity when the outlook looks a little bit clearer. Now, you know, all these calls have encompassed CEO comments about uncertainty that's out there. There's the geopolitics, there's what's going on with the Fed. So we'll see if there's enough clarity for more of those transactions to occur in 2024, as the CEOs have alluded to this earnings season.
Leslie Picker, thank you. Appreciate that.
Marty, our next guest is expecting a second consecutive quarter of earnings gains and says the stock market needs growing corporate earnings to do the heavy lifting this year. Let's bring in Mark Lucchini, Chief Investment Strategist at Janney Montgomery Scott. Mark, welcome. Good to have you with us. Let's pick up where Leslie left off, and that was in the discussion of the banks, particularly the big banks. How do you look at their earnings reports and analyze them, and do you think that banks, and maybe especially the big money center banks, are a target of opportunity this year, something they weren't last year?
Yeah, Tyler, I mean, I think you see a little bit of a dichotomy between what we saw reported on Friday by the big money center banks and that which Leslie was just reporting on with regard to kind of the investment banks. Just because of the composition of their portfolios overall. But turning back to the money center banks, I read it to be somewhat encouraging. Now, obviously, so much is going to depend on the evolution of the economy as to whether we see any uptick in loan demand, which remains relatively subdued at this juncture. But clearly, the money center banks benefited from continued impressive numbers coming out on their net interest margins as a consequence of the deposit flows that went into the money center banks after the banking aftermath in March of last year. And obviously, still quite healthy spreads over that which they are lending money out at. And so as a consequence, I like them from the standpoint of them being great global franchises with healthy dividend yields and maybe yields that can continue to go up. But in the meantime, less than favorable toward them overall, just given the fact that I think economic conditions are going to remain rather docile here in the United States, at least for the foreseeable future, with a non-trivial risk that we do dip into a mild recession perhaps in the second half of this year.
Last year, it seems to me, was the year of two things. One was the Magnificent Seven and their outperformance as a group. Number two was multiple expansion, the speculative premium that people are willing to pay for a share of stock. This year, you think it's going to be driven by earnings, and you think the earnings are going to come from the likes of industrials because of infrastructure spending, industrials like which?
Well, to name a name, healthcare is a sector we also like, but Caterpillar in the industrial sector. I mean, obviously an iconic company that is a real bellwether on global infrastructure and industrial activity. Not that we expect a big reacceleration of global economic growth for the foreseeable future, but nonetheless, there's obviously a pretty significant impulse permeating the U.S. economy by way of the infrastructure spending on the IRA, as well as the CHIPS Act, and even fiscally being underpinned in Europe for many of the same reasons: decarbonization, electrification, and so on. I think is a secular theme that is going to benefit the build out of onshoring, reshoring, and activity around energy transition to clean energy that is going to be a tailwind to Caterpillar for likely some time to come.
Cat.
So
I haven't looked at
pick
Cat in a
up
while.
great industrial brand and a relatively inexpensive,
It's on my watch
mid-teens
list.
kind of multiple vis-a-vis its counterparts in both the industrial space and the market overall. But I do think earnings are going to have to do the heavy lifting, because at 19 and change forward on 2024 earnings, the multiple expansion story of 2023 may
That's
be a
too
little
damn
more
much.
elusive in 2024.
All right, Mark, we have to leave it there. Thank you very much, Mark Lucchini. We appreciate it.
You're welcome, Tom. Thank you.
Just ahead, Elon
Just up
Musk
too
playing
much.
hardball. The CEO says he wants a massive stock award from the Tesla board, or else he'll build his AI products somewhere else. Power Lunch will be right back.
What the heck? He's bribed him for extra shares? Elon, don't make me mad. Well, it has had a $40 dip. No wonder they're calling it out. 3-week sell-off. Tesla. I was looking at the wrong stock. I meant Cat. Cat can pull back more. We broke the 200. Maybe around 270. I got 265 on here for some reason. Caterpillar to amplify electrification and energy solutions. They got equal weight rating, price target 270. So it's way overpriced to equal weight. It's got to come down.
BC.
Oh, it was frigid across most of the country. It was so cold. But you would think that that would boost natural gas prices.
No.
Pippa Stevens joins us now with more. Why not?
So much of these gains actually came last week, so it's an issue of buy the rumors, sell the news type event. And so now we are past the peak of cold weather, and so we are
Past the peak.
According to the meteorologist, is very much in flux, but they say that we are past the hump of the coldness is now behind us.
No, they're
And so
not.
Tonight's still very cold, but then things start to get better tomorrow. Don't quote me on that.
Wait, I feel like shouldn't she have a weather map right now?
We've had snow in April in Missouri.
What's going to happen is that the cold weather is going to blow through New York, and so Contessa will keep complaining about the cold weather.
The sun will come out tomorrow, which is why I'm in this jacket, supposedly.
Okay.
And so we are seeing prices down about 12%.
But now we were in a mild winter, and not just us. Europe too has had a much milder winter, and we talked around New Year or Christmas. We were talking about the fact that nat gas isn't really in use, and the prices that consumers are paying are lower because it's not really in use. Is that going to change?
So you bring up a very good point. So we did see a huge volatility last week on the front month nat gas contract. That was up 15%. But we're not seeing longer term optimism. And that is because, to your point, the fall was very warm, December especially, very warm. And so there was a lot of injection into storage when typically you start to see withdrawals from storage. And so what happened is that now storage is sitting about 13% above the 5-year high. And so that's while we saw the front month contract surge above that $3 per MMBTU, we didn't see further out any type of meaningful gains because inventory levels are still very high, production is at record levels. And then also a big game changer here is LNG and demand from LNG, but we've seen a number of those new terminals pushed further out into 2025. And so that's why prices haven't responded. Now, for consumers, once your utility bill goes up, as Tyler said, and it never seems to come down. And so we are still working through when prices surged above $10 a year ago. And so those increases are felt over a number of periods. So that's why we don't see an immediate one-to-one change in our utility bills.
It actually sparked a conversation.
Man,
with
these
my
expansion
general
patterns
counsel,
almost
like,
to the
do we
T
have
every
natural gas?
time.
Do we use natural gas? How much are we paying for natural gas? Which then unloaded a whole bunch of other economic. It was a very great learning opportunity. Thank you, Pippa. Next time I'm going to have.
I'd love to come.
I'll have Pippa.
All righty. Let's get to Bertha Coombs now for a CNBC News update. Hey, Bertha.
Hi, Tyler. The president has called the top congressional leaders for a meeting at the White House tomorrow. Sources tell NBC News he invited House Speaker Mike Johnson, Senate Majority and Minority Leaders Chuck Schumer and Mitch McConnell, as well as House Minority Leader Hakeem Jeffries, to discuss the national security supplemental funding. It includes money for Ukraine and Israel, but Republicans have held it up as they push for more immigration policy change.
Man, look at
A
AMC.
judge has rejected former Trump advisor Peter Navarro's bid for a new contempt of Congress trial. Navarro claimed protesters outside of the courthouse last year prejudiced the jurors. But today, a federal judge said his legal team failed to prove that claim in their filing. And the world's most popular video creator, Mr. Beast, is pitting YouTube against X. He re-uploaded a video he posted on YouTube in September to X so he can compare ad revenue between the sites. Mr. Beast says he'll share the results next week. The move comes after X announced that it would try to port creators and media personalities to the platform. And I will tell you that he's gotten over 64 million views, although he has 10 times as many subscribers on YouTube as on X. But one of the folks who reposted his post was none other than Elon Musk.
Wow, very interesting. I would think that YouTube would have an edge there because it's so familiar to
And their users, Mr. Beast subscribers on YouTube, I'm just going off of what I watch in my home. I would think
people in your home watch this.
The 10-year-old twins are watching Mr. Beast on YouTube, not on X.
Not on X.
No.
Not on X, yeah.
I've never heard of him until today, but he has over 230 million subscribers, and he's only 25. an amazing business at only 25 years old.
I'm with you, but I'd never heard of them. I'm learning something every day.
yeah,
It's like, you know,
You've got to have the kids
you have to
around.
have very specific audience is what we're talking about.
That's the only ways I know modern music is because the children introduced me to it. Like otherwise I'd be
Kids. Okay. Keeping us fresh. Thank you. Coming up, Boeing going all in. The aircraft maker ramping up its quality inspections, bringing in an outside assessment firm. We'll tell you about that next.
AMD's always been a sweetie. We got 164.46 as resistance. Barclays raised the price on it. Oh, Netflix. There's that earnings watch list. So let's go through the earnings watch list here. Tesla made its case today. Broke out of the snake. Then we got Boeing still in trouble. And it's got earnings coming out. Now earnings might be good, but the forecast ain't going to be too good. They still got a lot of planes to build. I don't know exactly how this will play out during earnings. Iran emerges from shadows with direct strike in Iraq. Now what's this? Shell suspends Red Sea shipment. We got Intel. CEO came out with this one. Let me find supports I had on this one here.
Time for today's three-stock lunch, maybe a little earlier than normal. Lots of big-name CEOs on CNBC today from Davos. So let's hear what they had to say.
Davos.
Get the trades on the stocks. Here with our trades is Malcolm Etheridge, CIC Wealth Executive Vice President and a CNBC contributor. Up first is Intel. Here's CEO
Jim's
Pat
alerts.
Gelsinger on where the company stands in its turnaround, with the stock up more than 50% in the past year. Listen in.
Part of the
I had standard deviation channel in Microsoft.
has been we're getting the process technology back.
What was I looking
at?
up?
5 nodes, 4
Intel.
years, this audacious plan to get back to leadership. And as it's coming to life, people who might have been skeptics are saying, wow, they're making it happen. And I think with that, it's sort of like the products get better.
Malcolm, first off, welcome. Glad to have you with us. What do you think of Intel?
Yeah, so I'm actually surprised he
Just
didn't
now
manage
talking
to get
about it.
AI everywhere into every single
Funny.
soundbite you guys might clip, because that is, I think, the slogan that's going to bring investors who had turned away from this name, frankly, in the last few years. Simply
200
because they weren't
SMA.
really part of the AI conversation. I do think their approach to try
And we are at a
incorporate
shoulder line.
artificial intelligence into just about everything that we as consumers touch will actually bear some fruit for them this year and going into the future.
Well, and to that point then, Malcolm, up next, Accenture, the company's CEO, Julie Sweet, on how the company is gearing up for AI.
will train 250,000 people this year in Gen AI. And since 2019, I've trained every person at Accenture, about 600,000, because obviously you have people coming in, on AI. Right, so in 2019, I became the CEO, and I said, every person, you work in the mailroom, HR, or a strategist, you need to know 6 things. Now it's 11, and they take assessments. So one of the things that I'm most passionate about is that AI can be great, and we have to bring our people along.
What's the trade on Accenture then?
Yeah, so Accenture's actually a hold for me. This company has long been seen as a picks and shovels approach in investing in whatever the macro trend is in business and technology, and at the moment it's generative artificial intelligence. But Accenture doesn't actually create any of the products and services that are leading the wave, and so my concern is that Microsoft or an Amazon who's actually building those tools could start to offer consulting and just roll it into all of the other features they're offering their enterprise clients, thus taking that market share away from Accenture.
All right, let's go, Malcolm, to Chevron. The CEO there, Mike Wirth, on the delicate balance energy companies have to strike these days.
There are 3 things that really matter when it comes to energy. It's affordability, it's reliability, and it's the impact on the environment. And
The 9.
You have to take all 3 of those into consideration as you talk about energy as a part.
That's about an $8 dip.
And we've certainly seen in Europe when reliable supply is threatened, prices respond, and the economy feels it.
Chevron down about 2% today, Malcolm. What's your trade here?
Yeah, so I understand interest based on the recent sell-off in energy, right? It certainly seems like a buying opportunity, but I would consider this one a sell. I have concerns about the situation in Guyana and whether President Maduro of Venezuela might try and create too much volatility around the annexation of the land in Guyana that he's after, which probably causes the deal with Hess to at least stall, if not potentially sack it. And so I just think that's too much of a headwind to try and catch that trade in energy that was created by the recent sell-off. As I mentioned, maybe an Exxon would be a little bit of a safer bet.
And these Guyanese properties are at the heart of Hess's, of the attractiveness of Hess.
It's the crown jewel of the whole, yeah.
Interesting. Malcolm, thank you so much for your insight today. Appreciate it.
Still ahead, Elon Musk says he wants a massive stock award from Tesla's board, or he's taking his bright ideas elsewhere. We'll get the key details when Power Lunch returns.
I got here C. I don't want to take too much risk right now. This was my alerts in Tesla today. We had 207.43, 201.24, and 191.40. And we got one more at 191.40. That'd be the strong buy. But now we jumped up. Oh, I gotta get my water.
Welcome back to Power Lunch. Shares of Boeing lower today, taking a big chunk out of the Dow. Let's bring in Phil LeBeau now to explain why.
Boeing under 200 bucks.
It's about figuring out how deep will the assessment and the audits of Boeing's quality controls go,
Well, Phil?
and what will be the ultimate outcome in terms of changes that will be made. So there are a number of different entities, both Boeing as well as others who are looking at Boeing's quality control.
I got
Here's what Boeing
196.27 for Boeing.
Yesterday, the company saying that it would be doing more quality checks on the MAX 9 production lines, including adding independent inspectors.
Good.
As part of that, the question also comes up, well, wait a second, is this going to slow down ultimate plans to ramp up MAX production? That's one reason why Wells Fargo, out with a note today, downgrading the Boeing stock, saying, given Boeing's BA's track record, I should say,
BS.
and great incentive for the FAA to find problems. Remember, the FAA is doing an audit of Boeing's production line as well. We think the odds of a clean audit are low. That's Matthew Akers from Wells Fargo. That is at the heart of why he downgraded the stock today. Also, take a look at shares of Alaska Airlines. Why? Because Alaska announced over the weekend that it was going to check MAX 9 work of aircraft before they take delivery in the future. Alaska has 65 MAX 9s. They are grounded right now as the FAA assesses if this is a bigger problem than just that one aircraft that had the door plug ripped off the fuselage. And as you take a look at shares of Boeing, keep in mind that the company today announced that it is naming essentially a quality assessment advisor. This will be an advisor who reports to CEO Dave Calhoun. We're talking about Admiral Kirkland Donald. He is the current chair of Huntington Ingalls Industries. And again, he will report what he finds to CEO Dave Calhoun as Boeing is moving quickly to try to say not only to advisors and Wall Street, but also to others who are looking at the company, regulators in Washington, we are doing a deep dive quickly in terms of where our quality is and what needs to change. So that's the latest on Boeing and the MAX 9 investigation. Guys, back to you.
Seems like there's going to be a lot more news coming out on that front. There's so much news in your world today, Phil. I wanted to ask you about this tweet from Elon Musk over the weekend that reads in part, I'm uncomfortable growing Tesla to be a leader in AI and robotics without having approximately 25% voting control, enough to be influential, but not so much that I can't be overturned. Emphasis mine. Unless that is the case, I would prefer to build products outside of Tesla. I mean, a lot of people see this as throwing down the gauntlet for the board.
Publicly negotiating, he wants more, and he's got the leverage to do it, Contessa. That's why he's doing this. And look, he's enough of a maverick that you can't dismiss this. Let's take, for example, one of his chief competitors, Mary Barra. If she said to GM, you know what, I need this, or I'm going to take my ideas and I'm going to walk, I don't think anybody would buy that. First of all, Mary Barra would never say that. I doubt she would ever say that. I doubt most CEOs would ever say this. But Elon Musk, he's enough of a maverick that you have to take what he says and not dismiss it. Not say, well, there's no way he would do that. Really? You don't think he possibly would do that?
Yeah.
Ultimately, they're going to work this out with the board. But he's publicly negotiating because he has the leverage. He is the key man risk, the biggest key man risk that is out there in the market, and he knows that. And that's why he's doing what he's doing.
Well, if they want to keep his big brain in-house, they don't want him to take
What is his stake in the company now? Do you know? He wants 25%.
I think it's about 16, 18%. Yeah. Remember, he had to liquidate a number of his shares when he was purchasing Twitter.
Mm-hmm.
Yeah. Thank you, Phil. Shares of NVIDIA hitting an all-time high thanks to bullish optimism for AI-powered chips. We get key details after a quick break.
Crypto Watch is sponsored by Grayscale. Crypto investing begins with Grayscale.
humanly possible.
NVIDIA shares bucking today's downtrend thanks to a bullish note from KeyBank despite looming export control threats. Christina Partsinevelis has more. Hi, Christina.
NVIDIA rises on down market.
So let's start with those threats. Chinese military and Chinese state researchers have reportedly purchased NVIDIA AI chips despite a U.S. ban, this according to Reuters.
Oh, really?
Separately, the Financial Times reporting that because of those
How can they
same
do
U.S.
that?
export bans that have been put in place since 2022, Chinese companies are resorting to stripping NVIDIA gaming chips down to their actual core components before being installed on new circuit boards. Both of these examples showcase how China is using workarounds to tackle their lack of high-end AI chips and actually highlights a looming risk for NVIDIA. Further export controls from the U.S., especially since 20% of its data center revenue actually comes from China. NVIDIA has repeatedly told me they are working with the government to supply compliant chips, and yet investors don't seem fazed by these China concerns at all. The stock is up, 14% year to date, positive today. It's helping the VanEck SMH on pace for its third straight monthly gain. And then you have KeyBank bumping its price target for NVIDIA to $740 from $650. Bank of America today says NVIDIA is one of the most mispriced stocks, saying the stock is moving less upwards than the drop in its earnings multiple. So why is everyone so darn bullish? NVIDIA's CFO said just last week they have data center revenue visibility well past this year, so that's bullish. They believe software revenues will continue to jump this year. They're launching a new AI chip in Q2, and they're working on supply, suggesting lead times would come down from order to delivery. All reasons why this name remains an AI darling, despite last year's 240% stock run-up.
I'd be happy with the 240%. I'd take that. Go retire. That sounds good to me. Christina, thank you.
Thanks.
All right, still ahead. A generation gap in Americans' housing picture. We will reveal the cohort or group that's got the biggest share of the country's largest homes and what it means for buyers still on the outside looking in. Our lunch is back in 2.
possible.
All right, we got 3 minutes left in the program and several more stories we need to tell you about. Let's get right to it. Corporate jets are taking flight in a big way. According to a Wall Street Journal analysis, S&P 500 companies spent $65 million on corporate jets for personal use of their executives in 2022, a 50% jump from pre-pandemic levels. And early signs suggest that that trend continued in 2023. We're not suggesting here that there's anything untidy, because most of the use of these private jets by corporate execs is stipulated in their contracts, and they may indeed be reimbursed.
But I think the point is that some shareholders, and especially those who want to see the return to shareholders improve with a focus on efficiency, might say that is an inefficient use of our capital.
Yeah, why are we having all these jets if they're going largely oriented to serve the private
SPX,
the CEO?
Exactly. Yeah.
Expansion
exactly.
pattern.
But for the private jet companies.
Yeah, good for them.
Jefferies is doubling down on DraftKings, reiterating the shares at a buy. Despite a pair of negative football weekends during the November quarter, the firm just shrugged off any short-term weakness as a buying opportunity, but you can see today it's up more than 1%. Basically, they're saying that the sports book should continue to see growth from the expansion of digital gaming around the nation, especially, and I think this is important, California and Texas remain the super states with massive population centers that still have not expanded sports. Huh? Yeah, but look, California is under massive pressure in terms of tax revenue. So how long do they remain on the sidelines with this? And also the tribes coming to the table and revisiting. We'll have to see.
Yeah.
All right, according to Redfin, empty nest baby boomers now own twice as many large homes as millennials with kids. Boomers own and occupy 28% of the 3-bedroom plus homes compared to just 14% for millennials. Redfin notes that the split was just about even a decade ago. I was shocked at the tiny little fraction that Gen Xers get.
Yeah.
Gen Xers with
of
kids.
Of the big houses.
Yes,
of the big
exactly.
Houses. A lot of people say they're going to downsize and they end up in a bigger house.
Well, because it's cheaper if it's paid off.
All right, now for the news you've all been waiting for. There is no news just yet, but there is a baby cam, ladies and gentlemen, and we're going to go to the baby cam now for a live report from Kelly Evans, an undisclosed.
Kelly had a baby.
How's it going, Kel?
It's really great. No, it's been. I'm really glad that I'm here spending quality time with everybody on the snow day.
Yeah.
Or did she?
Been real piece of cake.
You like your stress in concentrated doses, I take it.
She got 5 of them.
Yeah, so, Tyler, you could imagine earlier I saw Waddler, I saw bond yields, I saw the market, and I saw with the airlines, and I just thought, I'll just meanwhile try not to slip and break something here.
Kids, they are great, man. Is that 3 out of the 4?
Mommy! Yeah.
Good. All right, and a 5th soon to come.
Scott Wapner.
Kelly, great to see you. Thanks for watching Power Lunch.
Top that.
All right, guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. And this make or break hour begins with rates popping, stocks dropping, and now some new questions about the state of this rally. We'll ask our expert to make sense of it over this final stretch. In the meantime, your scorecard with 60 minutes to go in regulation looks like that we are red across the board. But I want to show you the intraday at the 10-year note yield because it started moving up when Fed Governor Chris Waller suggested rate cuts could come this year, but was non-committal on how many or when they might begin. What happened to stocks? They peeled back a bit on that as well. We do have some big movers out of the Dow today. Boeing shares are sinking. Apple's red on reports of iPhone price cuts over in China. As far as tech goes, NVIDIA about the only bright spot today as its stunning move continues there. NVIDIA, or that's it right there. Energy also weak as nat gas plunges big time. Does take us to our talk of the tape, whether the bulls are too optimistic on their outlooks for the markets. Let's ask one. Is John Mowry,
yes.
the Chief Investment Officer for NFJ Group, joins us.
They're not putting in this geopolitical tension. None. It's not in the market. I think it's starting to price it in right now. And here they got some kid here going to tell us exactly what the facts are.
Is higher. But that being said, you still got pockets of the market that are very attractively priced. And what gets me excited, Scott, is that some of the areas that are priced.
I had
very
hair like that
cheaply,
once.
I think work in two environments. One is that the Fed sticks the soft landing and they lower rates. But the other is that we still could slip into a recession. Don't forget that we have the longest yield curve inversion, the second longest going back historically. We still could get a recession. If you get a recession, I think you're going to want a different basket of stocks than some of the leaders today in the market.
But if you're saying that we could still have a recession, the very areas that you say are cheap would be cheap for a reason, correct?
Well, I think that the reason that you have staples cheap, that you have REITs cheap, that you have utilities cheap, all these areas where the people overpaid at the end of 2022, bracing for the recession. Now those stocks are cheap, and people had a decision last year. You could buy FANG, and then you could put your money in coupons and clip yield, and so you hollowed out this whole area, Scott, of the market. So I think all those areas should do well regardless of the environment. And look, I mean, there's a lot of uncertainty always out there, but I would rather put my chips in an area where I think that you've got multiple ways to win than just betting on what's already won.
Why would utilities do better in almost any environment, as you suggest, if rates are going to remain at, at best where they are now? I mean, after ticking down a lot, right, from 5 to 4 on the 10-year, they're sticky. They're sticky now. And you got people like Waller coming out today and saying, yeah, well, we may cut rates this year, but maybe not as fast. I'm paraphrasing, of course. Maybe not as fast or as soon as people think.
So the spread between the 2-year bond yield and the Fed funds rate is one of the highest going back historically, Scott. So if you look at that spread, it's very wide. The Fed is going to need to cut. I think that people are very hung up on, is it March or June? And to me, that's like if you're running a marathon, if you're like, am I going to have a water break at mile 2 or mile 3? It really shouldn't matter, particularly if you're a long-term investor. The reality is they will be cutting, and if they cut, that is going to allow other areas that have yield to be more interesting to investors relative to fixed income instruments like utilities, like staples, like the REITs. Alternatively, okay, if we go into a recession, those should do better relative, Scott. So I think for those two reasons, I would be bullish on those more defensive areas, plus the banks, as you know we've discussed, because they'll benefit as the yield curve moves down and steepens.
So you're not getting nervous at all as a bull in this market, and obviously, in terms of this program goes and this network goes, one of the more confident, dare I say, bulls who's come on?
Well, here's how I'd answer that. Valuation should always shape investor expectations. When valuations are very attractive, I get more bullish. So the areas
you made the case at the top, though, that they're rich.
What
overall market value? You think the market multiples justify?
Well, I think 19.5 times earnings is stretched historically. So you don't have to be a professor in economics or finance to show that. But below the surface, Scott, the Russell 2000 value, the mid-cap value, those are very cheap. And below the surface, even within those, you have to look at pockets that are very attractively
maybe
priced.
They're cheap for a reason. Like I'm trying to say, I guess the rally that we had from the end of October until the end of the year, okay, so small caps got a nice bid. People are like, oh, wow, it's going to be the year of broadening now. Forget FANG, just go, and the mega caps. Now you've gotten a license to broaden out. Maybe that was a head fake. Maybe that was nothing more than positioning. Maybe it's too soon to buy the Russell.
Or maybe it was investors saying, hey, these stocks are way too cheap. I'll give you a statistic. 33% of the Russell 2000 value has been down consecutively back-to-back years. That's the highest percentage of back-to-back stocks that have been down in the RUJ going back to the great financial crisis. If you could get a time machine and go back and buy the RUJ coming out of the 2008, 2009 crisis, that would be a gift. So you do have real stretched valuation opportunities that are way too cheap.
Coming out of them when rates were zero? Well, rates aren't zero.
Well, again, I think that investors are too hung up on where rates are today. I think you need to look at where the valuations are sitting in many of these attractively priced stocks. Scott, I came on the show and I joked about chocolate chips and semiconductor chips. Today, it's the exact opposite. You've got very stretched multiples between semis. Chocolate chips are cheap. Pepperoni's cheap. Domino's Pizza looks really interesting here. I like Domino's. My kids do too.
Oh, God.
I think investors need to be looking at a different group of stocks. I know that everyone's obsessed with AI. I know that everyone's obsessed with talking about FANG, what they did last year. These are amazing companies. But I think there's better ways to make money if I look at the market this year and if I look at the opportunities we're seeing across the cap scale.
How many cuts do you need to make your thesis on this market work?
Well, I can tell you what the market's pricing. If you look
I
at
know everybody knows what the market's pricing, and I want to know what you're pricing. What do you think?
I think 100 is totally reasonable, and I think 100 is a very prudent thing for the Fed to get to before the year end. I think it could be more than that, Scott. The reality is if they do more than that, that means we went through a recession probably. So if they keep cutting aggressively, we could slip into that recession. So, there is a soft balance between how much are they cutting and how much do they need to cut to stick the landing. But the reality is the Fed's got that hose kinked very tight, okay? And it's going to be a problem the longer they keep it kinked. And so they need to loosen that.
Jimmy says we over-raised rates. That's what I say. Because it hasn't affected anything that I look at. It's only benefited Wall Street. Trickle-down economics at its best.
A new high on the S&P 500. But what do you make of what John Mowry has to say here?
Yeah.
Which part, Scott? That he's waiting on cuts? I think that's right. That it may not matter quite so much how much or when the Fed starts. I think that's right. It was interesting today how wound up and dovish the market appeared to be in preparing for Waller's remarks, and how disappointed he was because he was maybe ever so slightly less dovish than expected. We went into this thing. I'll give you an example. For the probability of a rate cut in March was 73%. It's now around 67. So it's come down. The market is still betting on it. The market had priced in, almost 7 rate cuts. And I'll give you a quote.
7
right now. It's looking at 375. So still pretty much 6 or 7 rate cuts. The market hasn't changed a whole lot on Waller. There were expectations he would add to his dovishness. He didn't really add to it. He more put a little bit maybe stricter or stronger parameters around the rate cuts, but he did say that they're coming.
He also said, and I'm quoting here,
SunPower.
no reason for the Fed to move, well, I'm taking from his thing, no reason for the Fed to move rapidly as in prior easing cycles. I mean, isn't that a bit of a brushback to where the market seems to be priced by suggesting, yeah, we're probably going to cut this year, but we may be real offsides with where the market thinks that we're going?
I'm not sure, Scott. I think the distinction he was making there was between the prior times that the Fed has cut in an emergency situation when it looked like the economy was cratering. I think that was the distinction he was making. Look, the Fed has 3 rate cuts built in. The market has 6. As you go into next year, the differential is less, and the year after that, they're about in the same place if you look at futures going way out. What's really interesting, Scott, what is going on now, what I think is an unremarked development today, and I want to get a quote while I'm talking to you, but it is the collapse of the 210 inversion. For a very brief half a nanosecond there, we took out the 1031 low of 1605. It was back. I don't know where it is right now. I get myself a quote here, but it was like 1650, 1630, something along those lines. But the idea that you are one dovish Fed speech, one dovish inflation report away from the curve disinverting, I think that's an unremarked or little noticed development that could really both help out the economy, help out the banking sector, and make capital and lending more available to Main Street.
Oh, here we go.
Going to be important here.
Of course, the other take on that, or maybe the additional take I should,
not good.
should say is that then you'll have people putting the economy on the clock, so to speak, and saying, well, okay, we've had this happen now, the steepening of the yield curve, now we're really on recession watch.
Yeah, well, those same folks thought the 210 was going to lead to it. I'm not saying we're completely out of the woods yet when it comes to recession. I'm just saying it's been a mistake to underestimate the consumer, underestimate the strength of the economy, and to try, I think the mistake that people make is to take prior analogs and prior charts and overlay them onto what's happening right now. I think that's a mistake. I think you got to be available for new and different outcomes, because every outcome that I have followed in this pandemic and post-pandemic period, Scott, has been new and different. And
Goldman Sachs hit my alert.
Getting back to Waller, that he's saying, yeah, we used to cut really in a hurry because we were late. We don't have to do it this time because the economy's strong, unemployment is low. We do want to cut, but we don't have to get there in a hurry.
I think that's a great point. I really do.
Yeah, I really do.
Different outcomes is something that needs to be considered. You stay with me, Steve. I want to bring in Cameron Dawson now of New Edge Wealth, who's at the table with us too. You want to opine on what Steve just had to say?
Yeah, we totally agree about new and different. We're actually calling it the strange landing this year, which is one where there is no historical analog. We haven't seen this similar
I'll show it to you,
setup.
honey.
Think about it. We have fiscal stimulus, which is massive
I'll show it to
compared
her.
to not being in a recession. We have the Fed embarking on an easing cycle that, if the bond market is right, it would be the largest non-recessionary easing cycle in the last 40 years. So this cycle is so very different, and there isn't a historical parallel.
Steve?
Yeah, no, I was just going to agree. I hate to have a total agreement, Scott. I know you like different points of view here, but I like what she just said, the largest non-recessionary easing cycle. And by the way, that's why the Fed is going to move very carefully here. If you could put up, I know I didn't ask for this, an inflation chart going back to 1975, and look at what I call the twin peaks right there. What you'll see is you'll see peak number one, the Fed cuts rates, inflation comes down. Peak number two, it is peak number two.
Well, he has one point. We had Jimmy Carter back then, and now we got Brandon. If you think Brandon is making any decisions right now, he has no clue how to wipe his ass.
The name that stokes the most concern in what the Fed chair, you have to believe, is thinking about is Arthur Burns, obviously. What do you want to say?
Well, I think the longer they wait, you're pushing toward getting into that recession. So, capital, I kind of have this image of, Tom Hanks in Apollo 13 when they see gas and they're like, hey, we need oxygen. So they need to lower rates. These companies do need lower rates. And the real estate move you've seen in REITs so far, coming off of the October low of last year, that's predicated on there is going to be some relief there. So there's a lot of companies out there that are looking to refinance. That's why the RUJ jumped so much, because you do have more debt on those balance sheets. So I think that's a big deal. But I'm not getting off this desk, Scott, until we talk about EM. I don't know if you want to talk about that now, but I don't.
I want to hear from Cameron before we do that. So you have to stick around a little bit longer.
That's good.
I think that's for our benefit. Your take on this rally? I pose at the top whether the bull case is still intact, if it's a little suspect.
I'm going to show her where we're going to stop at.
Said valuations are stretched. It all then depends on earnings materializing. And as we go into this fourth quarter earnings season and get outlooks, if we don't get robust and healthy outlooks, I think that then challenges the earnings outlook for 24 and 2025 and could be a source of volatility. If you look at where the market's trading on 2025 earnings, which means 2 double-digit back-to-back years of earnings growth, we're at 17.5 times. That's near the 2020-2021 peak. So we're already very full in valuation. Doesn't mean we can't get higher because of liquidity, but we have to keep that in mind.
Well, rates coming down, economy staying good, and earnings coming in where they're supposed to be. Fix that problem, if in fact it's a problem. Do you think earnings are going to be good enough?
I think that there is potential for upside on the margin line. We're seeing companies be very good about taking costs out of the business. There's also upside. We heard from people like Goldman Sachs today and talking about upside to M&A, that animal spirits, a little bit of activity, investment activity coming back. And so there is pockets of upside, but we do think that you have to be aware that there's a deceleration in economic growth as well. Nominal GDP is decelerating in 2024, and yet revenue forecasts are expected to accelerate. That's a pretty meaningful divergence.
Steve, lastly to you, before I do move on to the highly anticipated EM conversation that Mr. Mowry wants to bring into the desk
I do.
today. So last
Hey,
time,
if there's value there, I want to hear it.
Hey,
If there's value there, I want to hear it.
There is
But go
value
ahead.
because look, a lot of people suggest that is actually the place to be investing, and not necessarily the S&P 500. But back to Waller for a moment. After Waller last time, we had many conversations, you and me, and I think many others, on the idea of, well, is he out here with a message that the Fed chair himself is comfortable with him sending? And I wonder if we should be asking that question again this time, if this is part of a concerted effort now to try and talk the market into a more realistic place.
Yes.
So I think, let me go back to the first time. The first time, Scott, I'm pretty sure he was out there freelancing. And you saw that by the way that Chair Powell 2 days later.
I agree. That is a good idea. I think it's real smart because it is overpriced. But I'm in a place where I've never seen the market before, so I kind of have to just watch and learn. Now I'm going to say it one more time here. I've never seen anything like that. And it's all about earnings. Earnings weren't good with the banks. We finally had somebody come out and say it. They just weren't good with the banks. And I've never seen anything like this. Triple top. And then big, long, wide candles. So I go back to the weekly one more time. And we've got the 9. If we sharply pull back and hit that 9, then we have a higher low. So it could be just a little bit higher than 4,700, which is only about $50 down. I think that would be a good spot to start loading up. But I did see something interesting here, and that's this candle right here and this one. And just a little bit ago, the body was equal to this one right here. At 47.57. That's only a $2 dip. That's where we are right now. It's hard to say. I mean, I was right about being overpriced and hitting the double top. And this Boeing incident didn't bring down the S&P and the SPY that much. We had that breakout yesterday. Oh, here he is. Robin.
You agree?
I would agree that defensives are unloved and underowned, and utilities are cheap. The thing with defensives, though, is that they have episodic upside volatility. So they do well for a short period of time and then tend to give it all back when people breathe a sigh of relief. So we see them more as trading vehicles versus long-term holds, because what you've seen is this long-term downtrend with brief pockets of upside volatility when people get scared.
Just give me a thought real quick before we wrap it up on the mega caps, just because they've been, uneven. There was a lot of talk about this broadening out, then it hasn't necessarily come to fruition yet. If it is going to happen, I don't know. What do you think?
I think not all mega caps are created equal, and this is probably going to be the year we'll be talking about magnificent, a number less than 7. And so what will happen is that those that have earnings growth, earnings momentum will do better versus those that just benefited.
So here's your snake and your breakout. So draw your trend line from that peak to that one. Snake breakout, pull back, boom. But I don't see where support would be on that. But I do see it here. Kinda. Huh. I gotta go get my coffee. Oh my gosh, I missed it. Oh, I did. Oh no, I was gonna do it today. Oh. Again, by taking your eye off the ball, I watched, and I told, here, I sent a message. I don't know if I sent it in here. I might have. $4.41. No, I didn't send it in here. I sent it to someone else. Oh, you stupid. I didn't put it in the room. I put it in someone else's chat. Not someone else's chat, but private message. I feel so stupid. This is what I type. I should have put this. I don't know why I didn't put it in the room. And I'm just, my gut feeling was telling me to trade LLY today. Is the CNBC pump over? I'm checking out the Lilly, and that was at 2:25 p.m. a.m. I mean 5:28 a.m. And the CNBC pump over. I'm checking out Lilly. And they haven't mentioned it once today. There every day they were mentioning it 4, 5, 6 times a day. Today would have been the day. And I just totally forgot about it. I looked at it, but I didn't think about it. Lily. Randy.
At a pretty good clip. And what if the economy is holding up pretty well? Then that would obviously throw the equation into a different answer.
That's already priced in, and I think that's the problem, is we're pricing in the good stuff. And I think the worry now is there might be surprises. In fact, there will be surprises. You go back to 2008, every single year, we've had some big surprise that nobody saw coming. And I'm sure there will be it's an election year. I can't see this year going by without significant big surprises. So to me, that's the danger you face investing in stocks right now.
What about the prior guests that we just spoke with who suggested, certainly one of them, that staples, REITs, utilities, all these unloved places of a year ago are cheap on a valuation standpoint? How do you view those?
Well, part of the reason they're cheap is they didn't have a recovery last year. If you look at what stocks did last year, even though overall stocks were up 26%, lots of sectors actually had single digit, and utilities and real estate and energy were actually down last year. And if you take utilities, which had a bad year the previous year as well, it's been 2 bad years in a row. So in a sense, they're better priced, and as a defensive investment, I think they're okay, but they're not going to make you 20% returns this year. That's not going to happen.
Maybe some people would be like, you know what, that's just fine. I mean, I don't necessarily look for 20% return. I just want some, a relatively good return. Is there an area of the market, Professor, you look at and say is particularly attractive because it is cheap enough?
I think utilities would be the place I go for that reason. I think that energy is always up and down. Energy had a great year the previous year. It gave back some of those winnings. I mean, utilities have been surprisingly down over the last 2 years because, last year you can't blame interest rates. The T1 rate actually ended the year at exactly the same level that it started the year. So from an interest rate perspective, it should have been a good year, but it did not have it. So maybe it's overdue, and that's, I think, one reason I would look at utilities going forward.
All right, let me talk about 2 stocks before we wrap it up. Apple, okay, got a bunch of downgrades already this year, at least 2, if not 3, which is rare in and of itself.
It's 3.
The stock hasn't traded all that well. Fundamental questions exist. There are technical issues with the stock. How do you view Apple from a valuation standpoint right here?
Apple's, I think, dependence on the smartphone makes them exposed to upgrade after upgrade. So I think they've built other businesses up to the point where they have some resilience built in. But it's been a long, good run for Apple. So if anybody owns Apple stock is complaining about this year, it's because they bought the stock very recently. This is a stock that's done well for its investors, and it's time to give up some of that good stuff.
I think you're muted, my friend.
Which, if I
How
recall
dare you?
correctly, you justified the valuation on numerous occasions in which we spoke throughout last year. This stock has been incredible, Professor. Now, the earnings and the guidance have been equally as stunning too. So how do we assess this here?
NVIDIA, I think, is much more difficult than Apple to work with because of that AI monster inside its engine. I did find it overvalued in the middle of last year, and I sold half my holding. I'm glad I didn't sell all of it because clearly the stock did really well after I sold it. But it doesn't make me, less nervous about the fact that you're paying for incredible success on the AI front, and that's being priced in. And I'm not sure how much more good stuff that can come from AI that can keep the stock going up.
Yeah, I don't know. That's what we said when the stock was 400. Now it's 500, and now it's on the way to 6. Professor, thanks.
650, Professor.
Thank you.
That's Professor Aswath Damodaran, again with the NYU Stern School of Business. Coming up, more on this late day move lower in stocks, move up in yields.
Jimmy says NVIDIA at 650 if China is buying them thingamajiggers. China. That's right. Do you get that kind of uncertainty in your gut today, the way the market is and the way these guys talk? I get emotionally attached because I know they're full of crap. One minute you have somebody up here and then they justify. They never show any charts. I think that would be a big improvement when they call these trades out. If they showed charts, they wouldn't be able to call these trades out. They just wouldn't be able to do it. So they go with the fundamentals. They're fundamental traders. The kind of trader I can't stand. They overpriced. They assumed that it was all gun-ho with these rate cuts. They assumed. I think that's a very dangerous assumption, is to assume. They say they predict. I predict too, but I predict on the charts. I don't predict on hope. That's the one I forgot to look at today. I was going to monitor real well. And we hit my support coin. That 50% pullback. Yep, we bounced off of it. Pretty nicely, too. Then Mara, sell into the news that we've heard that again today on some other sector. I got one more support on Mara on the 20-day. And what about Bitcoin? Bitcoin came back pretty good after this weekend. $4,200, and we had a high of 43.5. Is this Miss Smiley? No. I'm gonna go get my
Back
coffee.
to the point that we were at before recession fears were priced in. So here we are. Maybe the market has decided recession is not necessarily in the cards.
There,
but
she's
we're still
wrong.
struggling to get
Already, she's wrong.
tight in the market so far this year, which is interesting after such a ferocious rally into the end of last year.
So you use the word pause. Is it the pause that refreshes? We're just taking a little bit of a break, assessing where we are. We need more earnings to come into the system, and then we
Yes.
can spit something out.
Hey, CNBC, I got a secret. Check out the 200 on the 1 hour time frame on the SPY. As long as we maintain that 200 on the 1 hour, I think we can go higher. Because I see this, and I see this, and I see this, and I see this, and I see this. Plus I see this.
Seems realistic to you? Does it even matter? There's some who make the case it doesn't matter. The fact of the matter is that the trend is that the Fed's going to be cutting, and historically that's been good for equities.
Well, interestingly, when they start cutting rates, historically is when the market starts to struggle. I think what's been good for equities in this cycle is as yields come down, it seems supportive, particularly on the short end of the curve. It's supportive to valuations, or at least it reinforces that high valuations are okay. They're not necessarily scary. But I do think March is too soon. I think that we would need to see more deterioration.
We might have a
in the
green day
data,
tomorrow.
in the economic data, more of a slowdown before they can start cutting. Because if the market is still interpreting,
Could have a green day tomorrow, a flat. If we hold this support level off the 200, the SPY. I'm going to stick with my thesis. Only trade stocks that have cash. Wait for the pullbacks, chart them up. That means our Meta, our Microsoft, our AMD, our... I don't know if Intel's got cash now or not. If they're in debt. Amazon, Google's. The Magnificent Seven are always going to be in play. Always. Unless Mark Zuckerberg is on the list. If Mark Zuckerberg's on the list, oh my gosh. His Asian wife will not like that. They might have hot dog for dinner. Tonight we have chop suey.
the data had cooled, but there's really no harm so far that's been done or that's evident in the data that they're watching. I think that they'd be comfortable with a little bit of harm. And they did talk about months ago there needing to be some pain. It's inevitable that some pain will result from a hiking cycle like this. I don't know that we've seen that pain yet. And even the Fed themselves is expecting below trend GDP growth this year. So far, that hasn't materialized. I think that they should wait until some of that starts to materialize so that there's a buffer that if and when they do start cutting rates, there's room for the economy to reaccelerate in the near term, but not get problematic for inflation.
In the near term, as long as we can show the 10-year, again, we're like 407, you know, so we've moved up on these Waller comments theoretically. As long as rates are above or around this level, do equities have a problem or no?
I think they have a problem getting further up, right? And as yields rise, I think it does put a ceiling on upside potential in the S&P because you have to remember how we got to this point. What started to drive that rally at the end of October was the idea that they were going to cut. We had cool CPI prints, and we had this huge rally in stocks on the idea
huge rally in
of
bonds
lower.
too, right? Yields came.
Yep.
Yields were like on a waterfall.
Yep. And we had some historic days, drops in the 2-year of 20-something basis points in one day. That's what, a lot of that is what drove this stock rally. So if yields rise again, I think it works in the other direction.
All right, so we're showing your playbook here. Let's go through this. Dividend stocks because yields are coming down?
Yields are coming down. There's a lot of money in money markets. Everybody knows that. I think investors start to search for where should I put it. If yields are coming down, you're not going to be making 5.5% in a money market anymore. So people are starting to think about, okay, do I redeploy it into risk assets or into stocks, and where would I do that if I still want that income? I think dividend paying stocks can do pretty well this year.
Why do you caveat financials with the for now?
Because for now, I think there's still a big belief that we are going to have a soft landing. That's certainly a possibility. And if that's the case, then you've got yields in a place that are a little bit more attractive for financials than they were. You've got a re-steepening of the yield curve. Leisman talked about this earlier. We're probably at about 17 basis points between the 2s, 10s right now. That's a big difference from where we were 3 months ago. So some of that helping financials in the sense that you've got a more attractive NIM that could happen in the near term, right? And they'll trade on that. If you don't have recession fears that come in with certainty, cyclicals don't get hit yet. So that's why, for now, I think financials can hold up.
Real quick, and also healthcare you like, which is the best performing sector of this young year.
Yeah, well, it's very early to say that it's going to be the best sector.
Young year.
Yes, the best sector of the year. But healthcare is one of those sectors that actually plays both sides of the fence. In large cap, you've got parts of healthcare that can be very defensive and are seen that way, but you've still got biotech and pharma that have a lot of growth potential, not as interest rate sensitive, not as sensitive to all this volatility in yields.
All right, Liz Young, thank you very much.
Thank you.
All right. Up next, shares of Spirit plunging today. A judge says not so fast about that deal with JetBlue. Boeing shares are slipping yet again as well. We're going to tell you why. Closing bell. It's coming right back.
By looking at that chart, we're still bullish. By looking at that one, we're bearish. That's the IWM, and the QQQ are bullish. It's iffy there. Iffy there. Oh my gosh. I could have had a pretty good day today in a real red market. I held that put. The put went to what? 1,500? I got in it very cheap. And had 10 of them, so maybe 15 grand. And then the reversal on the SPX to the upside, I think I said 5. Well, maybe more than that. I had 2 sets of calls on them. I think it was 5. Oh, look here a second. I got some good people I follow on StockTwits, and all of them are all hung over on this bullishness, all but a few that recognize that yearly. But I ain't seen anybody call that double top out. Except Jake from, if I remember right. I'm very tired. Here's today's earnings, or this week, come in 2 weeks. Yeah.
All right, welcome back. 2 big stories we are watching in the airline space today. Let's get to Phil LeBeau with the details on both. Phil?
Scott, we're going to start with JetBlue and Spirit, and the quote of the day from Judge William Young. For dedicated customers of Spirit, this one's for you. What did he do for those customers? Basically said, you're going to be able to keep your low fares and your cost-conscious business the way that Spirit has it right now. And in a ruling that a lot of people said, look, I'm not surprised. The writing was on the wall when this was first proposed. The $3.8 billion merger between JetBlue and Spirit has been blocked. He ruled in favor of the DOJ.
Yeah.
Now, that's interesting here is the breakup fee when this was first agreed to, JetBlue agreed to a breakup fee of $70 million and potentially paying Spirit shareholders as much as $400 million, though there are some fees that have been taken off since then. So this could be costly for JetBlue. In a joint statement, the airline said, our combination is the best opportunity to increase much-needed competition and choice. As you take a look at shares of both, JetBlue actually rising a little bit after the decision came down, but man, Spirit just got hammered. And by the way, we're showing you back to July of 22 when the proposed merger was announced. They are assessing their legal options. The airline index, not a surprise that we're seeing it under pressure today. Look, there are a lot of headwinds here, but if
we got a double bottom
and saying, hey, maybe we'll see a merger. Maybe we think Alaska and Hawaii will go through. That's up next. A lot of people are saying maybe not, and that's why the airline index is down for the day. Another headwind that's out there for the airlines, it's Boeing. Let's shift gears, and I'll show you what's the latest with Boeing. An outside quality advisor was named. Admiral Kirkland Donald, who is the chair of Ingersoll Industries, has been named as the outside counsel. Huntington Ingalls Industry has been named as an outside advisor. There are 40 MAX 9 inspections that have taken place. Will we get those results in the next day or so? That's the big question. And the outlook in terms of production at Boeing is in question. There are more than a few analysts who are saying they're at 38 a month right now. Are they going to be able to make it up to 50 per month by 2025, 2026? Boeing is moving quickly to address these quality questions. It has announced a number of steps, announced them yesterday, including adding outside quality assessment teams, people who will check the work on the production line in Renton, Washington. If you take a look at shares of Spirit, keep in mind that Boeing has also said it is sending people, Scott, its own people, Boeing people, to supplement what work they already do, checking the work at Spirit Aerosystems in Wichita, Kansas. Scott, back to you.
Phil, I appreciate it. Thank you, Phil LeBeau. Summing up a couple of important stories today for us. Up next, the $35 billion deal that's shaking up the software space. We have details behind one of the biggest tech sector acquisitions in many months. We'll do it next.
Groom, G-R-O-M. What was that?
Count to 3 and trade with me, but count to 4 to make much more.
Yes, sir. Grom. I don't know why I typed it in there. I was going to type it in here. Don't grill me. Oh, good. Are you serious? I see no news. South Surfer Carolina Marks Wave. Communications. Correction. 8 million convertible notes. 4 million private placement. Now they're broke. Announcing closing of private placement. That could be some good news. I like to see closing of like an offering or I take trades like that. Well, Mike, if that's your real voice, I think you could have been a good replacement for Bob Barker. Exactly. Got to look for opportunity. I do my best in these days like this. I'm going to probably go over some good charts tonight. Let me see. 3 Black Crow scan. I'll find it. 3 Black Crows. We got CVE and Napa. CHU. Oh, Chewy. I want to look at Chewy. Let's see what this one here is. CVE. It's an energy stock. But Chewy. Let's see. Chewy is one of my favorites to trade there for a while. Kramer on Mad Dash, 111. All right, see what he's got to say here.
Let's get Kramer's bell. Carl, sometimes a piece of research catches your eye, and it just says, let's focus on this. Beeson Barclays, the dog days are over, saying that it is time to buy Chewy. That's hold to buy, in part because it looks like they're finally getting back on track in growth, but also because the stock's just gotten too cheap, even though Amazon's been gaining shares. And remember, this stock was at 118
cheaper now.
In the end of 21, when the humanization of pet cease was
1868.
highest. I like the call. I
Down a
have
couple
management
bucks.
on, and they're doing a lot more things. They're doing insurers, and they also have ads. And ads is just like Netflix. People don't mind to see ads, but it certainly boosts the valuation. So I like this call, Chewy.
There's an interesting call this morning out of the city about the low-end consumer.
watching delinquencies, excess savings having eroded quite a bit. Is Chewy highly exposed to?
Well, I think yes, from the extent that Amazon's a trade down from Chewy. It means Amazon's more mass. Chewy has a lot of the more expensive things involving a pet, but if the company...
Now, anybody that has a pet likes to feed their pet with the best food, take them to the vet, give them the shots. They take better care of, sometimes people take better care of their pets than they do their own family. I'm a great example. I mean, I've always had a pet, except once Beppy died, it's been the hardest thing I could ever do. I don't know. It takes, well, if you get a pet, you got to be dedicated. You got to use your life's got to be revolves around them. If it's a dog, now a cat, I don't know. A cat can be left alone a little bit, but I had one dog eat 3 grams or about 5 grams of wet mushrooms. He got into my cooler and run around the house for 3 days. And then Beppy got in some of my cannabis butter one time. I wonder, he looked half drunk.
It's all fake news. It's fake stuff. It didn't happen.
Yep. So yeah, I mean, you don't want to slack on their food, change their diet. One time he busted up my glasses, and that cost me about $600. He never did it again. He knew I was pissed off. So what other scanners do I have before I freak out on my dog? Upcoming earnings. Upcoming splits. See, here's the volume leader. Tesla. Earnings are coming out. $124 after the market Eastern Standard Time. Uber steps up efforts to get drivers into Teslas. We dipped below the 200 today. I had the 200 on watch, but we're still in the pivot point of the channel. I got 2 more supports. I want to get it right in here if I can, but too late. We already bounced up. I was really wanting that spot because that'd have been a 1, 2, 3B. Now, Sophie is getting close to the billionaire, where that billionaire, millionaire buys it at. He's probably watching that real close. And that TSM with Korea says we're open for business. Look at that bounce on that one. After the vote, boom. That'd have been a good one today. And most of it happened, yeah, that would have been, I should have been on that one. I was on that talking about it yesterday. Or Friday. What's that other one? Where's it? Grub. Snap. Grub. G-R-U. Is it not on anymore? Oh my gosh, look at that. No, don't tell me. I had these things. Oh my. Hello, Jim. Oh, they didn't move up too much. Huh. Wow. That's probably because we're so close to the end of the bell. Look at that. Jimmy called it snake breakout pullback, and he took 40 cents, 30. Well, it was definitely trend day. And I think it was really a good day just watching the... We did break support on the SPX. We did break this support. So that's a fact. I'm going to do a little video tonight once I snap out of this here sleepy eye thing. I think keep it... Now, you know, like I said, I was very disappointed with the banks. But you heard only 1 out of 10 analysts had the guts to say it. Because a lot of these people are holding positions in these banks. And I want to say this one more time. Maybe I'll say it over and over and over and over and over again. Jimmy nailed it. He nailed the bottom. He nailed the bottom. He nailed the bottom. Now we're irrational exuberance. So maybe put up the fibbies. It's hard to say it's going to pull back to that. There's your 1, 2, and 3 support levels right there. So maybe we'll come back and hit this and be a very strong buy. Just that first support. But I want people to remember, when I say things are cheap, they're cheap. And when I say things are expensive, they're expensive. Now we had some resistance at the 200, so it's normal to retest. But again, you know, these earnings. Look at this. Look at what the Oppenheimer maintains outperform on Citigroup, raises price target to 93. That's ridiculous. I think we need to have an investigation on Oppenheimer. That's almost 100% increase. That's bullshit. Look at those cells there. 18,000. 18,000. 3 of them all have the same number, so that's kind of funny. I bet you another one pops up here. So it's time to look at the candlesticks and see what kind of candlestick they close at. Right, that's a bullish candlestick. Right there. Long leg shadow on the bottom. Just like this here, but just thinner. I think we might have a flat green day tomorrow. Now, if we break out to the upside, we got to play the put. Just the opposite of today. So yeah, when I said they were cheap, they were cheap. That was cheap. Not so cheap. Up $100 in 2 months. So it'd come down to the previous high right here, which we did. And the next one's right here. That might be a little bit too much. $3.50, so that's a $26 dip. Dow. Dow, it's up above my Darvis box. Well, I'm gonna get out of here and take naps. Again, you know, I could have walked away with some real good money today on the SPX. As Randy as my witness. And that put, that's what tears me apart. And the call. There's no way I would have held that from up here. There's no way I'd have held that down there. Not after it broke up to the upside. Sometimes I get very confused by listening to these CNBC people. They've been around forever. That's what they do. They call trades out and they never show the charts. And they're just going on what someone else said. They get complacent. Complacent, I think is a good word to say it, because they were very complacent, and none of them were mentioned in how big the run was, but me. I said, this is out of the ordinary, and now they're saying it. A couple weeks later, they're saying it. So it's good to know what extreme greed is. Now I've said it. Extreme greed. And I'm going to pull up the map. And always ask yourself, and I do it every day, are they too high? Are we at a hard resistance? Is there more room to climb? Is there a new resistance, or are we at an all-time high? Or like that, what I say, Citigroup or whatever the heck, they raised that target price all the way, raised it all the way to $93. You got to be kidding me. In this kind of environment? That's not what I want to see. Oh. There's Brandon. Well, I can't find it now. Let's go back here. Extreme greed. Where we are now, we're in denial. Anxiety, maybe a little bit of denial. They're in denial because they're asking all these people, well, maybe they overpriced I heard 7 today. Someone said 7 rate hikes. I think just one is all it takes. If you'd have just priced in one, we'd probably still be moving up today. So I think we're in denial. And any much more selling, we'll start being in fear and despair. But it's always good to ask yourself, are we cheap? Where's everybody in fear mode right now? And maybe it's a good time to buy. When everybody's extremely greedy like they were the last week of December, and not mentioning double tops or all-time high or anything like that, you got to question. You got to look at the charts. Now, I was watching Schwab that one day a couple weeks ago or last week after I got out of Trade Ideas. I said, man, I love Schwab. And they're actually doing charts. You can go back. It's all pre-recorded. I didn't know it was pre-recorded that day, and I'm sitting here calling these trades out. I said, damn, I like the charting. Every stock they called out, they had a chart person there to chart it out. If they did that on CNBC, you'd know they'd be a bunch of fools. And today's the first day they didn't mention LLY. So that could be a catalyst for a correction. They mentioned it 4, 5, 6 times a day for 2 weeks straight. They were pumping that thing up. So somebody knows we hit a hard resistance. And I just keep going back and looking at these charts. $178 all the way to $647. I mean, that's ridiculous. And today this would have been a good payday. So you got to pay your attention. You got to keep your eyes on the ball. When they stop pumping them, and they don't mention them as much, they usually see little pullbacks happen. And then if we have like a 3 to 5 day sell-off, they'll mention them up again. But this is one I played puts on. I haven't played a call on this one. It's all been puts. And they were not mentioning Google. Goog, we have shoulder line resistance, so it can easily come back and hit the 9. This is on the weekly, so I'm going to bring up one of these support levels right above that 9 and replace it. I'll have to keep Google on watch tomorrow. It could drop $4 because that's a hard resistance, right? Shoulder line resistance. We've seen it before. Amazon. I did looked at a lot of stocks this weekend. Yeah, Amazon's going to break through eventually. Tesla's the one I missed today. I really missed that one. That was a good one. I kind of like, in a way, I like what Elon is doing. And if I was in his shoes, I'd probably get burned out on Tesla. And he really gave a good speech this weekend about that space stuff he's doing, SpaceX. I mean, they're putting a lot in the air this year. And he saves 5x on the cost that if NASA did it or if the government did it, it would be 5 to 10 times as much to do what he's doing. I heard the numbers the other day. I'm like, oh God, all the money wasted through the federal government. The more I think about it, I kind of wish, go back in time, I wish I would have became a government employee. I'd be making $50-$60 an hour. Or even a politician. I'd be worth $300 million and only in a speech. Yeah. James Howard hit the headlines. Got paid $500,000 for a half-hour speech by Harvard. Retail traders just hired politician Washboardjim. They're paying him 10 grand to speak for 5 minutes. They were pumping Russell 2000 last week. We got figs on top. I don't know. I can't fall for that, what that guy was saying about small caps. XXII used to be one here. Used to trade that one. That's cannabis, I think. Fake cigarettes. A tobacco, nicotine-free cigarette. If it didn't have no... See, smoking's a habit. I mean, it's an addiction, worse than heroin, but it's also a habit. Everybody in my family smokes but me. I'm the only one that doesn't smoke cigarettes. I never could stand it. Always made me dizzy. I never bought a pack of cigarettes for myself. I'd bum them. You know, if I was at a party sitting by a keg, I'd say, hey, can I have a cigarette? I'm out of weed. They were pumping Pfizer last week. Seen what it's done. They get them on the breakouts. Then they don't call them out later. My favorite stock right now would be Microsoft, Meta, NVIDIA, Lilly, Amazon, Google. I called Apple at 180 and we bounced to 185. Tesla. No China. Tesla. And they were pumping solar at the end of last year, and it ain't done nothing. I think it'll start doing something here once we start. Ooh, another big sell-off today. We got a 1, 2, 3. The biggest losers on my list was, percentage-wise, was Boeing, AMC, and I'm just keeping AMC on here, waiting for $2. It's FSLR. I'm going to set an alert right at 145. Netflix was on the pump. It's down $10 today. So this could be interesting. Netflix come in tomorrow. I'm going to go ahead and get out of here. If you're ever stuck in the stock, try to private message me. I don't know if I'd catch it in the chat. JP Morgan, we got to keep that one on watch. But the banks, I think, really did not do well at all. Maybe it's just writing off stuff and moving on. I was very disappointed. So we'll catch you all later. Yes, sir, Randy. Tomorrow, Eastern Time, expect high volatility.